1 minute that we are looking at things. Okay, now the Nifty has got some momentum going as well. So 50 points, we're at about 24,850 at this point in time. The Nifty heat map, it's bulk of it, most of it up in the green. Very few names are down in the red. About 5-6 names are in the red. Everything else is starting higher. Surabhi.
Market in Friday mood, it seems. It's a fair amount of green on the screen. By the way, the project financier stocks, they are all up and about. PFC, RAC, Irida, Hoodco, gains between 1.5% to 3.5%, depending on which one you are looking at. And that's, as Lata was just explaining to us, the final norms that have come out are less onerous than the draft norms. So it's a big relief and an overhang which has been removed. For the Nifty, what is taking the Nifty up 60 points? Let's find out. Nestle, Trent, there's Tata Motors. A lot of the banks are doing very well. The Bank Nifty is actually much better than the Nifty. The Bank Nifty is up 0.4%. SBI is the one which is pushing it right on top. Axis Bank is having a good morning as well. Let's see what's up with the HDFC Bank. Also minor gains coming in there. ICICI Bank is very quiet, 0.2% up. But banks looking good. Overall financials, Jio Finance also 0.5% higher. Shriram Finance, Bajaj Finserv. So financials are a solid spot. Nestle, remember, is looking at a bonus issue soon. So 1.5% up on that stock. Trent continues its good form from this week. There's a little bit of buying on something like Asian Paints as well. So that's the gainers tally. On the losing side, not too many stocks actually. Hero Moto and Bajaj Auto, which have had a good week otherwise. They're cooling off a little bit. And IndusInd Bank slightly lower as well. But otherwise, 78 points higher, Nigel. I think the bulls will take it with both hands.
Well, that's right. Surabhi, there's Northern Arc. There's a large trade that's taken place, actually. 14% equity that's up on the screen. It'll be interesting to see who exactly were the parties. Leapfrog, that's one that has close to around 16% stake. Augusta Investments, that's another one that has 16% stake. So could be a large holder that's, in fact, pressed the exit button. Large trade taking place explains why the stock is down close to around 7%. What's taking it on the chin? Sun TV, that's lower because of the promoter feud out there. ITD Cementation, that's a stock actually that's doing well. The order win that's come in there. So that's why that stock is up and about in today's trading session. On the Nifty, typically you see this. In the previous day, if you have a low close, yesterday the last tick of the day was actually minus 60 points. The next day you normally see that being made up, and that's precisely what's happened. So that's why we're up close to around 80 points. The fall that we saw in the final 30 minutes of trade yesterday was more to do with the expiry-related factor. What else is doing well? Finiotex Chemicals, that one's come on the radar. That's up close to around 4%, one of the winners on the Nifty. So good up move is what we're seeing on that one. Axis Gates, actually, that's been moving from circuit to circuit. Today as well, it's up close to around 3.5%. So good move is what we're seeing on that particular name. On the downside, Northern Arc, that one deserves special mention. 2 crore shares changing hands, I think. So on Sai Life as well. So 10% equity, that's out of the way. That stock is well down, only around 1% for such a large trade. Prashant.
No, absolutely. Axis Cades is, was up 5% yesterday, and I think it's starting higher right now as well. So 3.5% higher. We'll talk more about this one as we kind of sort of go along. But you've got a market which I think is looking much better now. The Nifty will come up on your screen, and we'll then talk about more stocks, etc. So 76 points. It's a better Friday as compared to any of the last 4 sessions that we've had. Harish Krishnan is with us, co-CIO, head of equity at Aditya Birla Sun Life Asset Management Company. Harish, good to have you with us here. Thanks very much for your time. I want to just start with at the margin all the all the blocks, etc., which you've been seeing. And the interest is such that at least twice or thrice this week we've seen these offerings upsized because of greater demand. Have you been sort of participating, and how are you viewing in this increase? It's not a new phenomenon. 2024 was very big with regards to all these offerings. This year turning out to be pretty good as well. Any specific situations you've participated or interested in, and your perspective?
Look, good morning, Prashant. So there's been a lot of action, as you rightly pointed out, with a lot of private equity, venture capital, secondary offerings that are coming through, even promoter blocks coming through. And that's kind of putting a lid in terms of the overall market move, given the fact that there has been such large supply. We're talking in aggregate of 50, 60, 70,000 crores happening in a fortnight's time of supply that comes through. What we've been far more, selective in terms of our approach out here. Names that we already own, where we have had a positive view, we do take such liquidity opportunities as an option to top up. In certain cases, which are very interesting, where we have not had much exposure in the past, we are also kind of getting into such names. But we've been very selective as far as the overall block participation is concerned over the course of the last few months or so.
Okay. All right. Harish, good to have you on this morning. So market has been range bound, but it's also been sort of gradually, quietly grinding higher, right? So would you be in the camp that believes that perhaps there's still enough fuel left in the tank? And then, would you be cautious in terms of keeping some money on the sidelines, or would you advise being fully invested? And if so, then where?
So we are reasonably fully invested as a fund house, and we've been having the stance for some time. So it's not something further now. During the phase of January, February, March, when markets did correct, asset allocation products like balance advantage fund, etc., went up very significantly into equities from about 38-40% of net equity. We are now currently at about 75% net equity. But that is, when opportunities did come through, we did increase our allocation. In terms of which are the sectors or which are the areas where we are deploying incrementally to our capital, as far as a fund house is concerned, we continue to view opportunities in private sector banks. We continue to increase allocation into resource plays, be it into cement, metals, materials, chemicals. That's an area where we have deployed reasonably large sums of capital. In terms of pharma, for example, we've increased exposure into the CDMO space, as well as the diagnostic space. That's the other area where we see some opportunities out there. And in the given the fact that the tech stocks have recently corrected in the last 6 months, we've kind of bolstered some of our exposure over there as well. So those would be the broader areas where we've kind of increased our allocation over the course of the last 6 months or so, with a 2-3 year kind of a view outlook as far as these sectors are concerned.
Hi, Harish. Good morning. Good to see you, Ben. I recall the last time we chatted, you sounded very, very bullish, and that was good to hear. Given the kind of, earnings estimates that are coming up, there are some geopolitical tensions as well. You know what Trump is going to do next. Do you still believe that you're as optimistic on the prospects for the Indian markets? And what about that Diwali? By Diwali, you said maybe we'll be singing a different tune, I think so. Do you maintain that by the end of this year, we'll be higher than what we are right now?
My comment was more from an earnings point of view, that we will see a stronger second half compared to the first half. Of course, markets do discount a bit ahead of time, but we do remain positively biased towards equities at this point of time from a 2-3 year point of view. Yes, gains have been very fast and furious in the last 2 months or so. Possibly, currently we are not even discussing anymore what would happen to the tariffs, and, when in July they come through, the 90-day window kind of comes off, how markets are going to react. If deals do get announced, how markets are going to react. So it could be a case of, selling the news at that point of time. So we would see some amount of consolidation and some kind of, correction in the markets possibly in the near term, because a lot of good things have got priced in very quickly. But having said that, continue to believe that earnings in the second half are going to be a lot better than what we've seen in the last 6-12 months, and which is setting up for a very interesting FY27 earnings print as well. So we continue to remain very positive from the earnings construct point of view, and believe that this is a market that needs to be bought on dips rather than sell on rise.
Yeah. I'm slightly pulling back to a macro question, and then we'll get micro again. I remember in one of the conversations, Harish, you'd said that currency risk in Asia, especially with the yuan, etc., perhaps is something that you'd watch out for. If you see today, as someone pointed out to me a while back, China has set its onshore reference rate at 7.1695. It's basic, and it's being the break of 7.17 is being seen as a bit of a symbolic knee-jerk appreciation. I mean, their stated goal has been a more smooth appreciation stance. Is the pressure building up for a one-step appreciation for the yuan? And it wouldn't be so bad, right, from an Indian perspective? I mean, it'd be worse if there is more depreciation. I mean, then you're essentially competing for export market share. But what about this one?
Right. So I think, the construct on currencies, at least from our understanding, has actually kind of changed quite significantly. So earlier, if we were worried, I think our focal point is where the dollar is going to be headed and stabilizing at. What the U.S. administration, and this has been well publicized by Stephen Moran and Scott Bessent as well, that they are looking at a weaker dollar. Now, this is a construct where we've seen the DXY cool off quite substantially, even as they've gone on with tariffs. And therefore, it is important to see where the dollar eventually settles at. That, I think, has got a greater bearing. So a lot of these moves of the yuan in terms of stabilizing, etc., possibly are also a function of where the dollar is going to be at. So I think there's been a change as far as a depreciation concern. For all you know, I think we are possibly headed into another regime as far as instead of a dollar weakness to get into a dollar strength. But of course, these are still very early times. I would think that in the next 3 to 6 months, we would get a better sense as to where the dollar eventually settles at.
You're saying that no, your view is the risk is dollar goes higher. That's what you're saying. Just to get that right.
So I'm saying that if earlier we had a view that, say, the rupee would go to 89, 90, and 95, and again, I'm not talking about the next 6 months, we're talking about a medium-term slope. At this point of time, there is an equal chance that the rupee can possibly go in towards 80 and maybe even 75. I think this is something which is now a reasonable probability. Earlier, these probabilities may have been very small that actually the rupee may appreciate so sharply. Again, we are not talking about, just to be clear, we're not talking about the next 6 months or the next 12 months. We're talking about a medium-term direction. And I think given what we've seen as far as the dollar is concerned, the probability that the rupee actually appreciates has actually kind of gone up quite meaningfully in the last 3-4 months than what was the case before. So the view is that should the DXY, for example, go closer to 90 or maybe even 85 compared to going to closer to about 110. Again, these some macro views, there is never any certainty about any of these happening, but it's a scenario that we would like to kind of pencil in as far as our probabilities are concerned.
Okay, got that. Harish, just one last question on one specific sector from the financial space, insurance. Do you think there are enough sort of triggers lined up for both general and life insurers this year? I mean, in a way, as someone put it, could be perhaps this, the sleepy hit. I heard those bit of a exaggeration. Sounds like an exaggeration, but sector of the year, as someone called it. What's your sense, Harish?
We would welcome if such a thing happens. It's been a long winter, so to speak, of about 5 years, where insurers have been at the receiving end. There have been multiple flux of regulations that have kind of impeded value creation out there. But purely from a fundamental standpoint, 5 years back, there were many companies who wanted to take an insurance license, be it in general, be it in life. What we've seen in the last 5 years is that the bigger firms have actually become far more bigger in terms of their market shares, in terms of their combined ratios, in terms of their profitability metrics. Possibly there is nobody who wants to start a fresh insurance company or a fresh life or general insurance company, into the sector. Now, this typically sets for a very good case for value creation to emerge over the medium term. So we are positive on the space. We have reasonably large weights and large overweights on the sector. But when exactly they kind of move, possibly there is also likely to be a change in regulator out there. So we don't know what their stance is going to be. But this is something that we think that there is reasonable margin of safety after such a prolonged period of underperformance over the course of the last 3-5 years.
Okay. All right, Harish. Good conversation this morning. Thank you very much for joining in. We look forward to the next one soon enough. Thanks very much. You have a good day. Well, let's now move on to a CNBC-TV18 exclusive conversation. Malnutrition is a bigger problem than obesity in India, says Varun Berry, Executive Vice Chairman, Managing Director and CEO of Britannia Industries. In a conversation with Mangalam, he speaks about the demand trends, the growth outlook as well for the sector. Take a look.
India is a country where, malnutrition is a bigger issue than obesity.
Yes.
Right? When you are at the bottom of the pyramid and you need bhook pyas as the most important thing, right? There's nothing wrong with our products, right?
Yes.
It's basically wheat, oil and sugar, right? Which are all basic nutrients, right? And it's the cheapest form of food. It's cheaper than any other food in the market, right? Now, you are an evolved consumer. You will have a different portfolio to choose from, right? Which will be much healthier. But we have to cater to the base of the pyramid. We cannot say that we will add some additional ingredients in this and we will take this price from, let's say, 10 to 20 rupees. That's going to be a price shock for the consumers, and we can't afford that.
Completely agree with you on that one. And that brings me to the base question of it all.
Yeah.
What does Britannia want to do now?
We want this company to perform consistently. Obviously, there are certain factors which have become more and more important with time. Making our portfolio healthier. I'm not saying healthy, I'm saying healthier. Making sure that we offer, different products to the base of the pyramid, but we bring in the right products for, people who are in SEC A and B. We want our portfolio to be enlarged. So our adjacency business, we are putting a lot of focus on. And I said earlier as well, the first stop is bakery with products which are in the adjacency space, and thereafter we will see where else we want to go. Dairy is a big play for us. We've made very good progress with milkshakes and milk drinks. Not as much progress with cheese. Cheese has been growing, but small single digit. So we want that to move to the next level.
How do you define the next level? Because 2 years ago, I asked you, where do you see the adjacencies business? You said 3 years later it'll be 35%, 5 years later it'll be 40-45%, and 10 years later you'd imagine a scenario where it is 50%. So 2 years hence, it's still at 25%. So 1 year later, will it be 35%?
Well, I hope so. Not 1 year, but maybe 2 years. Maybe we are running behind our schedule. But 2 years later, certainly. But, it should not come at the cost of biscuits.
Yes.
That's the main criteria. Biscuits have to keep growing. This is our bread and butter. This has to grow aggressively, and that needs to grow 2 times this rate of growth.
It's interesting you say biscuits is your bread and butter, but the metric that you're tracking right now in the company, what would that be? Would that be revenue growth? Would that be volume growth? Would that be distribution reach? Or I read an interesting one in your earlier conference call as well. You said volume per outlet, VPO.
See, volume per outlet is very important, right? So we've got 2 clear, things that we measure. One is volume per outlet. Second is covering areas which we haven't covered till now. And there are many small villages which we don't get to directly. So we'll work at both ends.
Could you give us some quantifiable targets for that over the next couple of years?
So our distribution targets, we will, increase our distribution by at least 100,000 outlets every year.
Got it.
On an overall basis, our volume per outlet should remain stable, right? Despite going to much smaller towns and smaller villages, which means that the volume per outlet needs to increase in urban areas. In terms of the SKUs that we sell in urban areas, we sell about 9 SKUs per outlet. Right? Now that needs to go up by at least 10%. So that 9 needs to move to 10, right? Now what would that mean? That would mean that we are selling more categories, more SKUs into each outlet that we go to. So that's how we define our target.
Is margin an outcome of a lot of the things that you're doing? Should we look at it like that? Or are you targeting a margin and then back calculate all the rest?
No, nothing works without targets. So we have a target.
Which is what?
Well,
18 to 19%, what it is right now.
Well, we cannot give any forward-looking statement. We cannot give any forward-looking statement. The target always is to make progress on where you are at. As inflationary times get behind us, we will always be endeavoring to move forward as far as margins are concerned. But I must say that we are in the top quartile of food company margins across the world.
There is the counter argument which goes like, India is such a beautiful growth market. Why worry about margins when you can keep increasing the top line? And there are companies, consumer companies, which have, not necessarily food companies, which have 25-30% margins, and they're not growing. So the street believes, what right do you have to have 25-30% margin when you're not investing in growth?
So that's a tightrope walk.
Exactly.
That's a tightrope walk, and you've got to do it really well, because I've seen a lot of companies go wrong there, right? And that's why I was talking to you about inflation, deflation, sine curve, etc. It's a tightrope walk. You got to make sure that you do not take the consumers for granted. You give them the product at the right price, and also keep an eye on competition and don't go completely out of whack. If you look at some of the companies which have gone wrong on that, you will realize that they just took their eye off the ball, and we do not want that to happen.
So your eye on the ball is maintain margins where they are with some improvement and continue to grow the core. At the same time, adjacencies grow at 2x.
Absolutely.
What does all of that mean in terms of numbers? Again, I ask you that because the last time we spoke, you said if I were to write a 5-year strategy note, of which we're 2 years into already, mid-teens growth would be a possibility. Obviously, a lot happened in the last 2 years for you to not realize that mid-teens growth. But do you think that is a possibility?
It's certainly a possibility. In a country like India, while we have seen a tough period, but once things come back, I think we'll be certainly in that zone, and not just us. A lot of our co-companies in the FMCG space, because that's where the country needs to be, right?
How far are we from that?
Well, I don't think we are very far. I think we are reasonably close to that, and I hope that that becomes the reality very, very soon.
And you can catch excerpts of that conversation all through the day on CNBC-TV18. All right, let's move on now. Time for an exclusive conversation. The shipping sector is facing concerns with respect to growing tensions in West Asia. So how does India stand? I mean, how severely exposed could we be to this? And of course, what is the way forward when it comes to development of waterways in the country, development of ports in the country? Let's talk about this and a lot more. We have with us Mr. T.K. Ramachandran, Secretary, Ministry of Ports, Shipping and Waterways, joining in for big picture perspective. So good morning. Thank you so much for joining in. It's a pleasure to have you on. So we want to start, of course, with the global developments to understand where we are. Now, it's a well-documented fact that 25 to 30% of the world's oil passes through the Strait of Hormuz, and as of now, it's operational. But, sir, what is it that sort of you have been, reading, hearing, and preparing for if there is wider disruption? We believe tanker rates have already started moving higher. If the strait is shut down, even for a couple of days or weeks, how can India ensure its energy security? What are the alternatives? I mean, storage. What are we looking at, really?
We have a series of options. Of course, much of this is what the Commerce Secretary or the Petroleum Ministry would look at. As far as shipping is concerned, our role is to ensure availability of vessels. Our role is to ensure availability of containers, ensure that the ports are up and running, and if there are alternative routes, then we explore those alternative routes. Luckily for us, we've had several of these so-called shocks over the last few years, starting with COVID, and then we had the Ukraine crisis, and then we had the Red Sea. So over a period of time, not only has the sector learned to become more resilient, we have also learned to live with the additional costs that might come with having to reroute the ships via the Cape of Good Hope and so on. So I don't think we expect much of a problem because of all this, though there will be some disruptions, also some minor increases in prices, insurance premiums, and so on.
Mr. Ramachandran, good morning, sir, and really great to have you on the program with us. Just to take that point which my colleague Surabhi asked forward, I was reading that tanker rates, VLCCs, very large crude carriers from the Gulf to China, pre-conflict they were at about 16,500. They've increased to about $48,000 now. So almost a 3x jump. Now, while a lot of the Iranian oil, bulk of the Iranian oil which goes to Asia goes to China, so that is separate, but we also get about 40% of our oil from that region. Not Iranian oil, but from that region. So obviously there are ships plying from that part to us. Have we also seen a big jump as the industry come to you?
Through that region.
Yeah, through that region. So have we seen a similar kind of jump? Anything you can tell us?
No, there are increase in rates, that much we have seen. And like I said, every time there is a disruption, there is a rerouting, and then there are increases in premium costs available. And because the rerouting happens, the availability of ships, that goes down, availability of containers goes down. So that leads to an increase in cost. And generally the industry has absorbed it. The market has absorbed it. So we haven't found that this has caused disruption in the supply chain. It manages itself somehow. Yeah.
So just one more point. This is something you had alluded to, so again, just going back to it. The rise in insurance costs. And that's already happening. I mean, if I look at some of the international sources, what they're saying is that insurers are now charging apparently 0.2% of the value of the ship. This is just in the last 2 weeks, 7-8 days since the conflict broke out, versus the earlier practice of maybe 0.125% of the value of the vessel in terms of insurance. If costs keep spiking, because there are a lot of these geopolitical conflicts all across, and the Houthi threat, etc. I mean, is the government of India prepared to sort of support industry in any form? Has industry sort of expressed any concern on this? What happens?
At least so far in the shipping sector, we haven't heard from the industry, and they haven't really come forward with any specific demands. So as and when they come up with some specific demand, we will look at them and take appropriate steps as necessary.
Got that. Ms. Ramachandran, all this sort of upheaval around the world throws up, of course, is, as in most sectors, maybe, to reduce dependency, right? Now, in the case of shipping, especially cargo shipping, we rely, I think, almost 90% on foreign vessels. Is the government taking any concrete steps to boost Indian flagged fleet and reduce this dependence?
Yes, so see, there are some short-term measures that we need to take, obviously, which have to then be constrained by the fact of availability of ships. Then there are some medium and long-term measures that can be taken, and of course, you might have heard that in the recent budget that was announced in January of this year, there have been at least 3 measures which have been delineated. One of them has to do with increasing all of them basically have to do with increasing the tonnage, Indian tonnage, so that more ships are available, more ships are flagged in India, and more ships are built in India. And you're quite right, almost 90% of our cargo at the moment is carried by foreign flags. Therefore, there is a very urgent need to be able to use Indian flag ships to move our cargo, and therefore the government's three major measures. One was the upgradation of the existing shipbuilding financial assistance policy, so that more ships are built in India. And if they are built in India, they are usually also flagged in India, which means our tonnage increases. The second scheme is for increasing the availability of finance for the industry. As you are aware, the shipping industry was not classified as infrastructure, in the harmonized master list. Now it has been announced in the budget that it will be classified, it will be part of the HML. Therefore, they have access to better tenures, longer tenures, and lower interest rates, which means the industry gains and ships can be built, etc. in India, also owned. More of ownership can happen because you have access to funds which are at lower cost. And the Maritime Development Fund, the creation of this fund which gives equity support to ownership of ships in India, I think again at 25,000 crores is going to be a big boost to the shipping industries, the size of the shipping industry. And I think basically because of the Maritime Development Fund, we expect a lot of investments to flow in. And over the long term, of course, we expect that in the medium term, the ownership of ships will increase. In the long term, building of ships will increase. So these are things that we are expecting. And finally, there is a capability and capacity building pillar, the third announcement that was there in the budget. And in this, we are hoping to increase the capacities of the existing shipyards in the country, as well as open and launch new shipyards, at least 2 to 3 greenfield shipyards, which will have huge capacities, and we will be able to build our own VLCCs and VLGCs, which we are not able to at the moment. So there is a lot of work going on all these areas, and I hope that the next time we have a crisis, we will be, really well prepared.
Yeah. Mr. Ramachandran, just a quick word, sir. How many ships as an industry do we make in India right now? And what's the ambition really? Globally, for example, US is talking about really building up their shipbuilding. I think they've been building a few less than 5 ships a year. China builds hundreds of them every year. It's by far the largest shipbuilder country. Could you give us the Indian context? Where are we now? What's the ambition?
Yeah, so it has been very bad. Of course, we have moved. We were at 0.01 or something like that, and then we moved to 0.04 and now 0.08 million tons GT per annum. So which means we are at less than 1% of the world's shipbuilding output. So that is where we stand. And 3 countries, China at 60+%, Korea and Japan. These are the top 3 countries. Between them, they manufacture or build about 85% of the world's ships, which means we have a lot of catching up to do. Even if we are able to build about 500 or 600,000 GT tonnage over reach that mark, we will be reaching the 5th or 6th position in the world. So the Maritime Amritkal vision, which was launched by the Honorable Prime Minister in 2023, has set a very clear vision for the country in terms of what we want to achieve by 2030 and where we want to be in 2047. So we want to reach the 10th position in the world by 2030 and the 5th position in looking at a CAGR of something like 8 to 9%. If we just want to retain or slightly go ahead in terms of how much of our cargo we are able to carry. But if we want to carry 20% of our cargo, we have to grow at a CAGR of not less than 17-18%. So this is what we are aiming at, and we hope to be able to touch about 6 or 7 lakh GT per annum. It's about 10 times what we are doing, or 10 or 20 times what we are doing now in the next 5 years. That is how we are looking at it.
Okay, very, very interesting. So that's how the math and the numbers stack up if we are to build Atmanirbharta when it comes to our fleet as well. So that's about ships. I want to also get your view on ports and what's the big picture there, because according to some industry estimates, when there's a broker Motilal Oswal, their estimates say that the Indian port sector should grow at a steady clip of 4 to 7%, so mid-single digits basically over the next several years in terms of how much cargo is being handled, what is the growth like. Do you agree with that assessment? Would you be satisfied with that rate of growth? And then, what happens, because we're in a world where supply chains are shifting dramatically. Trade patterns, trade routes, trade alliances are shifting, rapidly. So how can the Indian port sector ensure that it takes advantage? We, of course, have projects like Vadhavan, and long time, but I think it's 5 years into completion, so it's a while away. But what do the next 2-3 years bring for the Indian port sector?
Like you just mentioned, see, we had a capacity of about 1,600 million tons about 10 years back. Now we are at 2,600 million tons in terms of capacity. We, the major ports, for instance, did about 500 plus tonnage, million tons 10 years back. Now they do about 850. And overall, it's about 1,500. So the major ports, which is the government-owned ports, the central government-owned ports, and the non-major, and we don't call them non-major any longer because some of them are bigger than the so-called small major ports. For instance, Mundra, Pipavav, and so on. So the other than major ports is a term that I'd like to use, and which we now are tending more to use. So the other than major ports actually do about 45%. We do about 55%. So there is a lot of growth, as you can see. It's about 1.7x what was there 10 years back. This growth is attributed entirely to the ports investing in additional capacities and also to PPPs. Every port, the major port, has gone in for PPPs, and the capacity building is happening in partnership with the private sector also. And like you said, one port, Vadhavan port alone, will double our container handling capacity from 22 million tons per annum to about 45 million tons. So they add about 22, 23 million tons. And also, the overall tonnage will be about 300 million. So it will be one of the biggest ports, not just in India, because now we have ports which do 150 million tons or 180 million tons. But one of the biggest ports in the world, which will handle about 300 million tons, will be the Vadhavan port. Then, of course, there is Galathea and so on. So our aim is to ensure that every single state does a master plan for the entire coast which falls within their state and identifies places where ports can be built or expanded and upgraded, so that we have this master plan ready within the next few months. Therefore, we will be able to concentrate on certain projects which are of critical importance, strategic importance, and by 2047, we want to be at 10,000 million tons per annum, which will be one of the biggest shipping port capacities in the world. 10,000 million tons per annum is what we are expecting to reach in 2047.
Sir, just one question with regards to ports. If you look at the total port capacity, however you want to define it, within operated by the government and operated by the private sector, if you have those numbers ready, and every year, how much of it will you how much will be opened up to the private sector? Because that is the big hope we speak with listed port operators as well. Any guidance you can give us?
Yeah, I mean, we have a huge number of private PPP projects happening now. I think at last count it was about 81, and about 54,000 crores worth of PPP projects, being either underway or have been completed. I think about 34 or 35 have been completed in the last few years. And our aim is that 60%, at the moment we are handling almost 60% of our cargo through the private operators, which might be news to you. In JNPA, 100% of the cargo is handled by private operators.
Yeah.
So this jump which we have been, and it was only 30% a few years back. So this growth is happening because of the private sector involvement and the PPPs. And as you know, 30 years back, it was the shipping sector, the port sector, which first went in for PPPs, Mumbai and other places. Therefore, the port sector has a lead over many other sectors as far as PPPs are concerned. And it is our conscious attempt to ensure that we have better efficiencies, better ease of doing business, and of course, we bring in investment from the private sector and the speed of execution. So all these advantages we are seeing, and we hope to work on that and build on that.
Very good sort of guidance and sort of insights there. Just one last question. I mean, it's such a vast sector, waterways. And the government, as the Prime Minister said it, I mean, we've heard it from you earlier, we've heard it from the general thrust, right? Developing waterways, which is one of the cheapest modes of transportation, moving goods and people as well. I mean, on a lighter note here in Mumbai, for example, we've been waiting for this Mumbai-Goa connectivity.
Or even within Mumbai, if I could add. I'm glad you brought that up, Prashant. I mean, the ferry service, and I mean, there's so much chatter around it, on, off.
Yeah,
we want to know as Mumbaikars.
It is right there. I mean, the potential is there. Will we see quicker development, sir, on these projects?
Absolutely. In fact, I can go on and on about the waterways and the works that are happening. But just to keep it short, you see, we had 5 waterways 10 years back, national waterways. Now we are at 111, and about 29 of them are operational. This is in Mumbai, this is in Goa, Cochin, Kerala, Orissa, West Bengal, of course, Ganga and Brahmaputra and so on, Orissa. A lot of these waterways need to have water in order to have the ships moving or the vessels moving. So the first attempt has been to ensure that we dredge these fairways, they are called, creating and maintaining fairways. So dredging the national waterways and ensuring there is adequate depth, adequate water, so that the vessels can move, that is our first priority, and which is happening, already happened on the Ganga. We are now able to assure what is called the least assured depth. And it's like a chicken egg. Unless you have the depth ready, you cannot get the vessel moving. And the vessel will not come in unless you have the depth available. And if you have the depth available, you have to wait till the vessel becomes available. So this chicken egg situation is what we are trying to get out of. Then you require terminals which can handle the cargo and also ensure last mile connectivity. Luckily for us, we've built terminals, for instance, on the Ganga, on the Brahmaputra, at several other places. The terminals have been built. So again, then we require vessels to move on these fairways. So again, vessels, we have invested in vessels. We have several vessels being bought as well as deployed on the Ganga, Brahmaputra, for instance. Many private operators have moved them. As you know, the cruise operators, for instance, there are more than a dozen of them moving along the Ganga, and some of the most successful movements are the cruise vessel movements, the river cruise.
Right.
Just for your information, one of the longest cruises in the world, river cruises in the world, the Ganga Vilas, it has moved 3,500 kilometers from Varanasi to Guwahati and Dibrugarh beyond. So this kind of river cruise is booked till 28, and all foreign tourists, cruise tourists. So this is the kind of thing that is possible if you develop this sector. But like I said, infrastructure, vessels, and of course terminals, and ensuring. And we have a scheme for cargo, which is called the Jalwahak scheme, which gives a 35% discount to all cargo which is more than transits over 300 kilometers or more. And
so very quickly,
we have several projects for transit and all that. Yeah.
Yeah, so very quickly, sorry to cut in because we're out of time. We've hit 10 o'clock. But very quickly, the coastal transportation, transportation of people. Any new plans afoot on that? Whether it is within coastal cities like Mumbai, whether it's Goa. I mean, anything more on people transportation via the coastal routes?
That is the point I was coming to. That finally the integration between coastal and riverine movement. That is very crucial, because many vessels which can be used along the coast can also be used on the river, in the rivers, And therefore, if we integrate, we have seen that there is much more of synergy to be obtained, and the movements become more flexible, and we are able to generate more efficiencies. So that integration is what we are looking at.
Such a great conversation and so much perspective and insight across your domains. Thank you very much for coming on and patiently taking us through all of that and developing all of this. Of course, such a critical part of the move towards the overall development of the country. Waterways, of course, very, very crucial. Thank you very much once again, sir, for being here on CNBC-TV18.
Thank you so much. Thank you so much.
All right, so that's the shipping polls, waterways, sort of entire perspective coming through. 70 points higher, 24,864. By the way, Surabhi, I know what you were looking for specificity. We wanted to hop on a boat and Bandra and get to Worli.
Anything that speeds up movement in the city of Mumbai.
Okay, all right. Nagaraj Sethi is with us with technical trades and what he'd like you to do is with HDFC Securities. Nagaraj, morning. 75 points, so it's a much better day compared to the last four. What are your trades?
Hi, good morning, Prashant. Yes, rightly said. Showing some signs of recovery from the lower support. There is a support for around 24,700 levels, and the overall market trend has been a choppy. At the higher levels, market is facing a severe resistance at the lower level, showing some supports. So far now, around 24,700 is going to be a support. Once Nifty moves above the hurdle of around 25,000 level, that is going to be an initial sign of strength in the market, and that could propel the market to another 2 to 300 points higher once it moves above the 25,000 levels. At the same time, the range bound action is likely to continue, and if it slips below the support of 24,700 levels and more weakness towards the next support of 24,500 is going to be there for the Nifty for the short term. That is a setup, and in this setup, I have two stocks, as you mentioned, from the mixed side. One is from long and one is from short. And technically, the long is the Indus Tower. Chartically, if you look at the Indus Tower, has been in a consolidation phase. It was in fact outperforming during volatile broader markets, and today it has broken above the range and moved above the important hurdle. Currently trading around 397.98 levels. One can look to buy at this point of time. Initial target would be around 425. One can place a stop loss at 382. And second one is from a short side. Metal sector itself is showing some weakness. And if you look at the Hindustan Copper, that is showing some distribution type of pattern after a decent upside bounces around 265, 270 levels. It has declined in a couple of sessions and it has currently moving below the 200-day EMA. I think overall chart pattern is looking weak. If it comes down, one can look to sell at this point of time, and the target would be around 230 to 33 for the initial target, and one can place a stop loss at around 261.
Okay, all right. Interesting trades, and thank you very much for those, Nagaraj. Appreciate it very much. We take a quick commercial break here. Manisha Gupta with commodities on the other side. Stay tuned.
Welcome back. So the equity market continues to have a good Friday morning, still up almost 100 points on the Nifty. Let's now find out what's happening in the world of commodities, where at least in the crude markets, things are still very, very nervous and edgy. Let's go back to Manisha for the latest. Manisha, over to you.
Well, thank you for that. Yes, when you look at the crude oil prices, we've seen 3% of gains in the overnight markets. It's headed for a third weekly gain into there. And then there are supports coming in from the geopolitical premium. And the markets also have seen various statements being coming out. Israel, for one, says that they are intensifying their attacks against Iran. Also, there doesn't seem to be any sign of an exit strategy coming in from either side. That is keeping the crude oil prices in good favor. But the oil rally has hit some breaks in the Asian markets right now. We are trading nearly a percentage point on the lower side. That is after Trump says that he will take a call on striking Iran in 2 weeks from now. So that adds to the uncertainty, and the markets also have gone in a bit of a profit taking in Asia because of that statement that came in last evening. Also, the prices are capped by the fact that you're looking at higher supply expectations for the second half of this year and in 2026 going forward as well. Whether it is about OPEC supplies, non-OPEC supplies, you are looking at that increasing, and that is the reason production elsewhere has offset the disruption impact that the markets believe could come in from the western part of Asia. What the brokerages are saying is quite important, and they have been reiterating, changing, revising their crude outlook in sense of prices going forward. I'll start with Citi, which says that the prices could hit 78 a barrel. We're not too far away from there if the conflict disrupts 1.1 million barrels per day, that is of Iran exports. Iran as of now is exporting 1.1. But Citi also says that disruption of 3 million barrels per day could lead to prices going to $90 a barrel. They still don't believe that the prices can go to a triple digit there. So that is their worst case scenario on the higher side when it comes to crude there. JP Morgan says in an extreme scenario, if there is a closure of Strait of Hormuz, that is the only time that you will see the prices breaking triple digit and going up to $120, even $130 a barrel on the higher side. Goldman Sachs, in the meanwhile, says that the geopolitical premium already into the prices, and $10 of a war premium is what they're looking at. Once this de-escalates, you could be looking at the prices coming down yet again. Interesting report also coming in from Barclays, which says that prices can go all the way to 85 if Iran exports are cut by just about 50%. Remember, Iran is exporting 1.1 million. So half of that also, if it goes down, then the prices can go to 85. Mizuho Group, we spoke to them recently on the channel, and they said that the prices can actually look at a very big range here. $85 a barrel is their bet if there is disruption to the Iranian exports. So there are lots of ifs and buts, and the markets do not seem to be moving unless there is an actual disruption in supplies, in exports as well. But Mizuho also says that de-escalation of tensions can bring the prices down to $65 a barrel in a jiffy as well. Trading.com also has a similar range, 65 to 85, depending on what kind of a scenario do we work with. And Bank of America has actually put a long-term range as well, given the fact that you're looking at higher supplies going forward. Bank of America says that until 2030, they're looking at the prices ranging between $60 to $80. For this year, their average stands at 75 at this point in time.
All right, Manisha, thank you very much for that. So that's oil very much in focus, top of mind really from a financial market perspective. Okay, I think just a quick 30-second check as far as markets are concerned. We're up 90 points at this stage. I think volumes are still lagging, so volumes aren't very high at all, and that's been the case for the last few sessions. And I was saying this earlier, it's just something that I picked up, of course, no confirmation, that big players in the derivative market, like the Janes of the world, the Jump, the Citadels, I mean, their activity has been a little on the lower side the last few trading sessions. There's been a fair bit of attention and focus around it. Focus around these players and their role in markets every day and the volatility that we've been seeing. So we'll try and confirm it, but that's just chatter that I picked up. 90 points higher, 24,890 is where we are at. Okay, we'll take a quick commercial break here. It's our special segment. It's the economy. Lata in conversation with Neelkant Mishra of Axis Bank on India's macros and markets. Stay tuned.
Welcome to It's the Economy. India's macros, be it inflation, fiscal deficit or current account deficit, have all been steadily improving. But growth this year is slowing from the post-COVID highs that we saw. And the slowdown is coming at a time when global headwinds are getting a little worse. To size up the economy and equities, I have with me a guest who has a great record of enmeshing macros with markets. My guest is Neelkanth Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkanth, good morning. Thank you very much indeed for your time. Let me start with the introduction itself. Like I said, the other macros I'll come to. But where do you size up growth? Do you think the global headwinds can be serious? Some people worry even about domestic urban consumption.
Oh, thank you, Lata. Again, it's always a pleasure being here. On the growth side, I think that growth should improve going forward. And there are several reasons for that. One important reason is that the fiscal headwinds are easing. There is this unfortunate misconception among many that the government was somehow supporting growth in the last 2 years, and it is no longer willing to support growth. It's actually quite the reverse. So the government of India was reducing its fiscal deficit, and it had to, and it was doing the right thing. And this year, the fiscal headwinds are easier. So there was an 80 basis points consolidation. So in FY24 and FY25, fiscal deficits fell by 80 basis points each. This year, the decline is only 40 basis points. So there's still a headwind. Next year, the headwind will be even lower. About 15-20 basis points. So the drag on growth. So one way of overly simplistic, I know conceptually not 100% rigorous, but still to demonstrate what I'm trying to say, if your potential growth rate is 7% and your fiscal deficit is falling by 80 basis points, you're effectively starting at 6.2. And I think 2 consecutive years of very aggressive fiscal consolidation has shown up in a bit of a drag on growth. But I think this year, the drag is going to be a lot lower, and therefore growth should be better. Okay. On the monetary side, we have seen significant easing. The transmission was turning out to be a lot slower, and therefore this time we have seen the RBI and the Monetary Policy Committee being a lot more decisive in showing their intent, in stating in the statement itself that the economy needs support. And the first signs are clear that some of the rates on new loans are starting to fall. As this transmission picks up pace, because one or few of the banks will break rank and start cutting rates to build business, that will create deposits, that will create the pickup in the momentum, the flywheel starts to move. And the economy, as we maybe say 3-4 months down the line, should start seeing visible signs of recovery. I agree with you that as of now, the high frequency indicators are not looking that good. But if you're doing forward-looking analysis, I think things should be looking much better. On the global headwinds, I think there is a lot of uncertainty, there is a lot of noise, but I would continue to emphasize that most of the drivers of growth in India are local.
Well, you must be speaking to Amitabh a lot, or to all the bankers at Axis. I spoke to a bunch of them after the policy, more recently actually. And their point is, there is no problem of deposits actually. Paisa hai. And now the CRR cut will come. There'll be a little more of release into the system. Every, incremental deposit also, you have to keep less burden of CRR. The problem is, dein kisko? They're not very confident that there are so many retail borrowers, for if you do good diligence. So is that a feedback you're getting?
Lata, so, the way you are placing the question or framing the question, you are effectively signaling that monetary policy does not matter. That even if you cut interest rates, nothing is going to happen. And that's something I actually would disagree with. See, like in anything in economics or in anything in life, if you cut price, there will be demand. And because see, so far, February, the rate cuts became totally ineffective because liquidity was too tight. The feedback to the governor was that the CDOIS spreads, which is the cost of liquidity, They fell from 160 basis points to say 100, 110 basis points for a while. And then they got stuck there because some of the banks had been so badly scarred by persistent shortages of liquidity that they were refusing to let go. And so that's normal friction in a undesirable but still expected friction in the banking system. With this clarity that, look, we are cutting by 50 and we are telling you that in the second half, when liquidity tightens, when there is fear that RBI may have to sell dollars and therefore there may be further sucking out of liquidity, rupee liquidity, don't worry, we're giving you visibility, liquidity, we will manage. It is only now that loans, the new loans are seeing lower rates. So the rates on new loans are starting to fall. It is now that the person sitting at the margin who thought that maybe 8.5%, 9% mortgage rates were not good enough at 7.5, 7.8 says, you know what, I can handle this. And some MSME and some promising entrepreneur who was earlier struggling to get access to loans or capital says that, you know what, I think I can work with this kind of interest rates. And it is the first few who then pick on the loans, and then spending picks up, or investment picks up, or whatever, some aggregate demand goes up. And that then gets the flywheel moving. So I'm with you that on current interest rates, the demand, of course, that's where the market is, right? But if you bring down the interest rate by, say, 100 basis points, 150 basis points, there has to be more demand. Or if it is not, which I would disagree with, then we should stop discussing monetary policy.
No, the logic that lower price means more demand is a very fundamental rule in economics. That's how you draw the demand and supply curve. But I can tell you that even in the Reserve Bank, I heard this worry that are there enough good borrowers? It's good borrowers that they worry about. You may have to take a little more risk. But I'll come to that. The point is that, as you say, there has been a tax cut, there has been a rate cut, and that should hopefully engender demand. What's your view on private capex? The discussion so far I've heard is I saw the CMI data, very good, but largely public capex. There hasn't been that much evidence of private capex.
So, Lata, we've been discussing this for quite a while. In my view, private capex is an outcome. It's not an input. See, investors or companies don't invest to do a favor to the economy.
No.
They invest when they see end demand. And the end demand is triggered. So if you think about what is the input, so if private capex is output, then what is the input? Input is real estate. Input is power generation. Because if you think about your own life, my life, what are the goods or services we consume that require a lot of investment, where large materials have to be moved, and they are nothing but residential dwellings, commercial dwellings, transportation, infrastructure, and energy. It'd be hard to find things, and we don't really have semiconductors, but it would be hard to find things which are capital intensive outside of this. So if the real estate cycle is picking up, why do you think cement volume was growing in double digits in the March quarter? Because construction of housing is required, and it is going up. Why do you think capex by power producers is starting to pick up? The demand this last 3-6 months have been quite weak, but there is weather, there are several other issues. But I think that there is a lot of new investment needed, and you are seeing that in the order books. And therefore, once these things start to happen, the demand for goods, and you will see that the cement companies are doing capex, the steel companies are doing capex, the power companies are doing capex. So the cycle is turning around. The RARA investments that we saw in the 2009 to 12 phase, I suspect that phase may not come anytime soon, because at that time, the lending environment was very different. Several sectors have been opened up for the first time, and there was massive fiscal juicing that pay commission. So I suspect that won't happen, but there is enough happening right now that.
No, that's a fair point. I'm a reporter of that era, and maybe that kind of expectations are there. I take your point on that, which brings me actually to what the Reserve Bank announced on project finance. One of the things that perhaps would have deterred lending loans, project finance provisioning high. Now that's been cut. CRR has been cut. So you think banks are on a very good wicket now? I'm just bringing you down to equities. What are your favorite sectors now then?
The sector remains the same, right? So construction proxy, so we have liked cement, real estate. There are valuation issues with specific names, but by and large, that's a sector that should do better. And of course, financials. So these are sectors which I think should see a turn. You're rightly emphasized the construction provisioning norms being sort of reduced yesterday. And frankly, this is where the earlier norms introduced last year were a bit surprising because, even in policy making, you have to do mapping to where we are in the cycle. If there's no construction happening and you start increasing the construction provisioning or provisioning on construction-related loans, the cycle will never pick up. It is only when construction picks up and you start seeing that, look, the loan book is becoming bigger. This is classic counter-cyclical provisioning. So let the loan book start to build up and you see how the behavior is. And of course, the RBI knows and tracks these things diligently. And if you see risk are building up, then you raise the risk weights. But at this stage, so there are several things that are happening which are going to be supportive. My colleague Jayant published his update on banking yesterday, and he believes that the loan growth should pick up visibly, much better than what several of his peers are forecasting. And we are quite constructive. And in fact, one of the things that we are emphasizing is that the last 2-3 years were about PSUs over private, that the private banks were underperforming the PSU banks. And we think that the reverse should start happening now.
And start now. Oh, okay. That's very important. A very quick one on how do you map the macros to the markets? What kind of earnings growth are you expecting this year? Whatever index you take, either Nifty or any own set of stocks.
So we think that so labor will still not have pricing power, and therefore, if nominal GDP growth is say 10.5–11%, profit growth will be faster. We look at the BSE 200, but I would say a 12–13% kind of growth seems likely. Which means that there will still be cuts. So there will be, I think, cuts to consensus, but they will be much more moderate than over the prior year. And that should be supportive of the market overall. But I'm a lot less worried about the global macro sort of going out of hand now that we have seen the Trump administration sort of respond to market signals that the objective is not to disrupt. So while there are many big changes underway, maybe 25–30% devaluation of the trade-weighted dollar over the next 3–5 years. So see, these are things that what the US administration wants. So there will be big shifts, but those. Yesterday, we wrote about how, despite the unsustainable path on which the US debt is, the rise in 10-year bond yields in the US is likely to be gradual and not sudden. And so because you can keep talking about 20-year forecast, but what the bond market has much more confidence in is the 3 to 5 year forecast. And they're trying to build in a case where somehow the US debt becomes unsustainable is much harder. And therefore, it will be a gradual increase, but not a very sudden increase, and which means that disruptive influences on the market may be quite moderate. So I still expect a time-correcting market in India. And maybe in a few months' time, as the earnings momentum starts to become clearer, maybe the broader indices can actually start trending up as well.
Okay, thank you very much for enveloping so much into that last answer. Thanks a lot, Neelkant. Always a pleasure having you with us. And I think the market's hearing you. The Nifty Bank is up about 0.8. That's, of course, has been the best performer. But super performance coming in from the Nifty and the Sensex itself. Both up almost 1% now. Sensex is up 0.91. So there we are, almost 1% higher. We haven't seen so much green in some time now. So let's celebrate after a break. Chartbusters.
Shares of REC, PFC, Hudco, IREDA, all these financiers rise as RBI releases softer than expected project finance norms. New provisions will also only apply for loans sanctioned after the 1st of October this year.
Northern Arc trades with a cut of close to around 4% after a large trade sees nearly 14% equity worth around 440 crore rupees change hands at a price of around 197 rupees per share.
Delivery under pressure as Jefferies downgrades the stock to an underperformed rating, cuts its target to 315 from 500 earlier. The brokerage believes Meesho's insourcing could pressure Delivery's third-party express parcel business.
Shares of Sun TV fall over 4% as sources tell moneycontrol.com of a legal feud between the Maran brothers. DMK MP Dayanadi Maran and Sun TV owner Kalanithy Maran, they in fact are engaging in a dispute.
A muted debut on D Street for Oswal Pumps. Shares list at a 3% premium to issue price compared to the issue price of 614 rupees. But don't go anywhere. The management will join us shortly discussing the company's post-listing strategy. Vivek Gupta, the chairman and MD, joins us.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel D'Souza, with me is Mangala Malu, and as we speak, the market's at the high point of the day. Volume's not very, very high. Yesterday we fell on rather low volumes, but today, in fact, there's a good pickup, Mangalam, to start trade. The Nifty is up already 200 points. The Nifty Bank as well, 500 points higher. And I'll tell you what, both of them are trading above their 20-day MA. You like the look of that? Breadth of the market as well, keeping in pace. So pretty good start.
Pretty good start, you know, and in light of what the Nifty was doing yesterday, it seemed like there was a magnet that was attached to that 24,800 mark. Despite the sell-off that we saw in the broader markets, that was telling you that maybe at lower levels there was some buying for the market, and post the expiry day sort of trades that we saw, the market's now sprung back up above the 25,000 mark. It will be very crucial to see whether it sustains above this or not, because if it does, then there could be case for some short covering as we move into the expiry week, the monthly expiry week. The important part is that three of the market's heavyweights, all top three batters, doing extremely well. You spoke about the Nifty Bank up 530 points. Pull up the Reliance stock. That too is up around 1.5%. So that's supporting the cause of the frontline index. And then we have the IT index as well. There was a dip on the IT index somewhere at the start of trade. That has been bought into, and the IT index too has moved back into the green. So all three batters doing extremely well. Let's hope all three batters for Team India do well as the India-England Test series gets underway today. But all that done, we have a debut on D Street. Oswal Pumps saw a muted debut in line with what the market has been doing as well. It's opened about 3% above its issue price and now holding around those levels. Vivek Gupta, the chairman and managing director of the company, now joins in to discuss their post-listing strategy. Thanks a lot, Mr. Gupta, for joining in. Congratulations. It's an important day for you and your company in this journey. But you know, what the street wants to know from here on is what is your revenue growth plan post the ending of the PM Kusum scheme? Because nearly 9/10 of your revenue, 87%, comes in from the PM Kusum scheme, and that comes to its closure in March 2026 without any clarity on whether there would be a newer scheme here or not. So what are you doing to diversify away from that is the big question that everyone wants to know.
Yeah, thank you very much for your wishes. Definitely, जो PM कुसुम हम आगे देख पा रहे हैं, बहुत अच्छे तरीके से बहुत बड़ी ग्रोथ देख पा रहे हैं, और डेफिनेटली इन कमिंग ईयर ऑलरेडी गवर्नमेंट ने ये बहुत एग्रेसिवली स्टेप ऑलरेडी ले चुकी है, और इन द मंथ ऑफ अप्रैल मिनिस्ट्री ने एक मीटिंग कॉल की थी जिसमें हम सब वेंडर्स थे, एंड गवर्नमेंट इज गोइंग टू इंट्रोड्यूस PM कुसुम 2 इन अ वेरी एग्रेसिव वे. सो गवर्नमेंट हैज़ ए प्लान इन FY27 टू इंट्रोड्यूस दिस कुसुम 2, एंड अभी से गवर्नमेंट ने बहुत एग्रेसिवली स्टेप लिए. सो आवर ऑल इंडस्ट्री आर क्वाइट वेरी श्योर कि ये PM कुसुम जो योजना है, जो गवर्नमेंट का बहुत ही एक प्राइम प्रोजेक्ट है, बहुत ही एक aggressive project, it will go on in a very aggressive way. Thank you.
All right. Hi, Mr. Gupta. Good morning. And thanks a lot for joining in. PM Kusum 2, by when will it be unveiled?
Yeah, actually, because this PM Kusum 1, ये तकरीबन FY26 में ये फिनिश होने जा रही है, और अभी से गवर्नमेंट ने इसका इनिशिएटिव स्टार्ट कर दिया है. सो इन द मंथ ऑफ अप्रैल ऑलरेडी गवर्नमेंट ने एक मीटिंग ली थी सभी वेंडर्स की, जिसमें अपने व्यू पॉइंट गवर्नमेंट ने क्लियर किए कि वी आर कमिंग अप इन अ वेरी बिग वे इन कुसुम 2 प्रोजेक्ट, PM कुसुम 2. सो आई थिंक विद इन दिस कैलेंडर ईयर PM कुसुम 2 इंट्रोड्यूस हो जाएगी, ताकि PM कुसुम 1 के फिनिश होने से पहले ही ये स्कीम बहुत ही एग्रेसिव वे में कंटिन्यू हो पाएगी.
Alright, that is one positive, but apart from that, under PM Kusum currently, how much are your receivables from the government, and by when do you expect to receive them?
Yeah, actually, if we talk about the receivable, it is practically at present all receivables are under control, and at present we are getting all receivable within 140-150 days as expected. So definitely there is no challenges, but definitely in near future whatever government is thinking in a very aggressive way, and government will definitely is working on reducing of working capital cycle, because government want to install more and more agricultural pump.
But 140, 150 days you are talking about, that is, nearly 2/3 of your revenues which are stuck in receivables. I'm looking at your receivable days. FY23 was 66 days. FY24 was 91 days. Now it's come to 142 days. 142 days is almost half a year, sir. उसको कम करने के लिए आप क्या कर रहे हो?
देखिए, एक्चुअली क्या था कि जब हमारे जो साइकिल था 60 डेज या 90 डेज का, उस समय हम लोग गवर्नमेंट्स की कोई भी सेल नहीं करते थे और हम डायरेक्ट पार्टिसिपेशन ईपीसी में नहीं करते थे. सो 1 साल पहले हम लोगों ने ईपीसी बिजनेस में एंट्री की हम लोग, और डायरेक्ट पार्टिसिपेशन हम आज के दिन कर रहे हैं. सो ये एक वजह है कि गवर्नमेंट्स के जो साइकिल है, यहाँ पर हमारे लिए लॉजिस्टिक भी है. हम अपनी कंपनी से मटेरियल भेजते हैं, वेयर हाउसिंग करते हैं, इंस्टॉलेशन करते हैं, देन पेपर सबमिशन करते हैं. सो लॉट्स ऑफ वर्क है. तो ये पूरा साइकिल प्रैक्टिकली 120 to 150 डेज का साइकिल रहता है, जो कि एक अभी तक का जो पूरी पीएम कुसुम का एक मानना था कि ये एक रीजनेबल साइकिल है. बट डेफिनेटली क्योंकि पीएम कुसुम एक गवर्नमेंट का बहुत एग्रेसिव प्लान है, तो हमने भी रिक्वेस्ट की है गवर्नमेंट से. गवर्नमेंट भी सामने से बहुत एग्रेसिव है कि ये पेमेंट साइकिल किस तरह से रिड्यूस किया जाए, क्योंकि अभी तक इसमें बहुत चीज़ें ऐसी हैं जो गवर्नमेंट ने पीएम कुसुम में जब स्टार्ट किया था, लाइक पोर्टल्स बहुत एक्टिव नहीं थे. अब गवर्नमेंट के सब पोर्टल्स बहुत एक्टिव हैं, बहुत ऑनलाइन है. सो उस समय बहुत चीज़ें गवर्नमेंट 90 डेज़ के लिए सर्वेलेंस पे डालती थी, सब डाटा चेक करती थी. नाउ गवर्नमेंट वांट टू रिड्यूस दिस साइकिल, सो डेफिनेटली गवर्नमेंट इज वर्किंग ऑन इट. सो वी आर क्वाइट वेरी श्योर कि इन कमिंग फ्यूचर यू विल सी दिस पेमेंट साइकिल विल बी रिड्यूस ड्रास्टिकली.
Okay, all right. Mr. Gupta, a few details I wanted for you. In the coming year, what kind of a revenue growth can you do? Point number 1. And point number 2, with the capacities that you have, which are not fully utilized, peak capacity can be what? What revenues can you do at the peak? 1,500, 2,000 crores, what can it be?
Okay. देखिए, जैसे अगर आपने हिस्टोरिकली ग्रोथ देखी है कंपनी की, तो कंपनी आगे भी बहुत अच्छी ग्रोथ एक्सपेक्ट कर रही है एज पर इंटरनल प्लान्स जो भी कंपनी ने लिए हैं. सो वो प्लान्स में किसी तरह का कोई चैलेंज कंपनी फेस नहीं कर पा रही है, और बहुत क्लियर विजन आ पा रहा है. इनफैक्ट जितना कंपनी सोच पा रही है उससे ज़्यादा मार्केट में डिमांड क्रिएट हो रही है, उससे ज़्यादा मार्केट अवेलेबल है. इनफैक्ट एट प्रेजेंट वी आर टॉकिंग अबाउट ओनली इंडियन मार्केट, बट इवन ग्लोबली मार्केट इज ओपन अप. सेकेंड, इफ़ यू टॉक अबाउट योर सेकेंड पॉइंट, मुझे बताएंगे दूसरा क्वेश्चन क्या था आपका, मैं भूल गया.
सर, आपका पीक कैपेसिटी क्या रहेगा टू डू विद द करंट इन्वेस्टमेंट यू हैव मेड? पीक कैपेसिटी क्या 1,500 2,000 करोड़ क्या रहेगा?
देखिए, इफ़ यू टॉक अबाउट कि FY25 में हम लोगों की जो पंप मैन्युफैक्चरिंग कैपेसिटी थी, दैट वी यूटिलाइज अराउंड 80 to 85%. एंड विद दिस IPO प्रोसीड्स हम लोग इस कैपेसिटीज़ को अराउंड 2.5 टाइम्स तक हम इसको लेके जा रहे हैं. सो एंड विद इन दिस ईयर काफ़ी हद तक हम अपनी कैपेसिटी को अचीव कर लेंगे विद इन दिस फाइनेंशियल ईयर. और ऐसे ही करके हम साइमल्टेनियसली जो सोलर मॉड्यूल की कैपेसिटी है वो हम कमिंग ईयर्स में अचीव कर लेंगे. सो एब्सोल्युटली जो भी डिमांड्स हम लोग एंटिसिपेट कर पा रहे हैं, सो पैरेलली हम लोग अपनी कैपेसिटी बढ़ा रहे हैं. सो आई थिंक देयर वोंट बी एनी इशू टू कैप्चर ऑल दिस डिमांड.
Mr. Gupta, 2 things. One, you are increasing your capacity. Demand is coming. You are working on reducing your working capital timelines also. But all said and done, your cash flow from operations was negative 197 crores. तो क्या पॉइंट है इतना बड़ा सेल करके जब आपके कैश फ्लो फ्रॉम ऑपरेशंस नेगेटिव है, मार्जिन्स इंप्रूव हो रहे हैं, बट कैश जनरेट नहीं हो रहा है? दैट इज वन ऑफ द कंसर्न्स. एंड सेकंड पार्ट, यू स्पोक अबाउट एक्सपोर्ट्स. They account for 3 to 4% of sales. How much further can they grow from here?
Okay. देखिए, मैं आपको दोनों बात का, मैं पहले एक्सपोर्ट की बात करता हूँ. इफ़ वी टॉक अबाउट FY24, हमने एक्सपोर्ट अराउंड करीब 27-28 करोड़ के आसपास किया. पर अगर FY29 के 9 महीने में अगर हम देखते हैं, तो तकरीबन हमने 30 से 40% में लास्ट ईयर से कवर कर लिया. 35-36 करोड़ का हम ऑलरेडी एक्सपोर्ट्स कर चुके हैं, और अभी हमारा 4th क्वार्टर था. सो डेफिनेटली एक्सपोर्ट्स मार्केट हमारी बहुत तेज़ी से बढ़ रही है, बट ओवरऑल ग्रोथ ज़्यादा होने की वजह से परसेंटेज आप उस ग्रोथ एक्सपोर्ट में कम देख पा रहे हैं. एंड first question you asked, this
cash flow from operations is negative.
या देखिए कैश फ्लो में क्या है कि अगर कंपनी एक साल में लास्ट ईयर FY24 में कंपनी ने जितना रेवेन्यू किया 9 महीने में उससे बहुत ज़्यादा रेवेन्यू कंपनी ने किया, और जैसा आप हमारा रिसीवेबल साइकिल है इट इज़ अराउंड 140 to 150 डेज। ये टेम्परेरी ट्रांजिशनल कैश माइनस है आपका। अभी 2 वजह से हमारा कैश पॉजिटिव होने वाला है। आप इसी साल में देखेंगे FY26 में हमारा कैश पॉजिटिव हो जाएगा, क्योंकि जो हमारे पास प्रोसीड्स आ रही हैं, एक तो वो एक वजह है जिससे हमारे पास कैश फ्लो पॉजिटिव हो रहा है। सेकंड, जो कंपनी के इंटरनल एक्रूवल्स आ रहे हैं इस साल में, वो भी हमारे थर्ड क्वार्टर के बाद अगर आप चेक करेंगे तो कैश फ्लो हमारा पॉजिटिव होना शुरू हो जाएगा।
All right,
growth is so phenomenal, that's why this is the only transitional phase.
Mr. Gupta, thank you so much for joining in and giving us the outlook on the company. The street has bought into what you are saying right now, and as a result of which we have seen a smidge higher on the stock price as well. But more importantly, the street will closely be monitoring a couple of things. One, the extension of the PM Kusum scheme, if the second scheme comes by or not. Secondly, how your cash flow from operations and working capital improves. And thirdly, most importantly, how your business outside of the PM Kusum scheme also grows. But all those questions and all those discussions for another day after you report your last quarter's results as well. Until then, congratulations and enjoy your day today.
Thank you. I'm sir, you are most welcome. Anytime you are most welcome. Thank you.
With that, we'll take a short break, come back on the other side. We'll get you more on the markets and a lot of stock-specific action.
The Money Control Mutual Fund Summit is back in 2025 with its 4th edition, spotlighting the $1 trillion dream. A bold vision to reach $1 trillion in assets under management AUM by 2030. Join top policy makers, fund managers and market leaders as they deliver actionable insights and chart the future of investing in India. Money Control Mutual Fund Summit 2025, 23rd June, Mumbai. Register now by scanning the QR code.
Welcome back. Well, good move is what we're seeing in terms of traction from the broader markets as well. A couple of these stocks from the railway pack that got hit, they are trying to bounce back a little bit. RVNL, Ircon, pull up both those two stocks. Even a stock like Vedanta actually that's got badly beaten down in the last few days, that as well as showing glimpses of coming back. And in fact, now it's trading around its 20 DMA. So we'll keep an eye out on that name. seen a sharp correction in spite of that dividend that they're going to be giving out. But that stock is trying to pull back. I think it's at around the 20 DMA. That said, well, let's get Manas Jaiswal, technical analyst at manasjaiswal.com, who joins us on the show. Hi, Manas. Is this the real deal? 25,000 is here, but can we get past the 25,250 hump?
Good morning, Nigel. So, yes, today's move is a breakout move because Nifty has regained 20 and 10-day moving average. It has broken the key resistance of 25,000. So, I believe that at least you can set the target of around 25,250 on Nifty. And even at current levels, I think one can take a chance. One can create long position, keep your stop loss below 10-day moving average. So, your stop loss should be around 24,874. And target would be at least 25,250. However, I believe that even the medium-term outlook is quite positive, and I think after some more consolidation, you can see a breakout above 25,250, and in that case, Nifty can go up and test 25,650.
All right, some couple of stocks that you would give us, Manas, quickly.
So first one is a buy call on AB Capital, where stock has broken the key resistance of 259. So take a long position here. The stop loss should be around 256. Target would be 265. And second is a buy call on Industar, where stock has given a flag pattern breakout. So take a long position here. Stop loss should be around 395. Target would be around 410.
Take that point. Thank you so much, Manas, for joining in. With that, we'll slip into a short break, get you more on markets and individual stocks on the other side. Welcome back. You're watching us here on Chartbusters. Let's get in an exclusive conversation. We have Varun Berry, who we spoke to, and this is the MD of Britannia. He spoke about a bunch of things, the importance of learning from startups and growth prospects for the company as well.
Brands will never go away.
Got it.
Right? What's changing is not an attitude towards brands. What's changing is the attitude towards how you consume them. Right? So when I was growing up, we would buy a Good Day, for instance, and stay with a Good Day throughout the month. Today, the consumer has a huge repertoire of products, right? But yes, there is a proliferation of products which is happening through startups, and hence they are consuming those products. But once they do that, if they like it, they stay with it. If they don't like it, they come back to their base brand. But believe me, brands are very important. And if you are able to give them what they need through a known brand, they will not move away.
Have you seen any example in this lately? Because I'll give you an example of a recently started brand which was offering protein via the wafer format.
Yeah.
And it's been less than 6 months and they've reached an annual run rate of almost 100 crores. They are increasing their repertoire of products out there, etc. as well. So I'm just trying to figure out that if you know, there were some categories you believe that you had right to win over, and perhaps you were a little late to that, or maybe, you know, other brands have taken that space.
No, that's a great example. Mangalam, I think what they brought to the table was a product which was new to the market. Interesting innovation, because wafer is thought through as a very light product, and what you have inside is protein. So very interesting innovation, and I'm not surprised that they're doing so well. But a lot of these products where we've reached 100 crores in a year, and we've said, man, we should have been much more than that. So I genuinely think that these startups are great, and we need to learn a lot from them, and I hope that they do really well. And but yeah, once we've learned, once we've sort of imbibed what we need to do to make our portfolio interesting, we try to make those modifications as well. We missed that, right? We were not in wafers at that point in time. We were launching base wafers. We were not getting to that stage. But those are things that one needs to certainly look at.
Important to learn from startups, but brands aren't going anywhere. That's the word coming in from Varun Berry, the Executive Vice Chairman and MD CEO of Britannia Industries. You will hear a lot of that all day today on CNBC-TV18. With that, as we come towards the close of Chartbusters, just keep an eye out on the markets. Once again, we're seeing an up move. The Nifty, all 4 indices up above your screen at the high point of trade. The metals, they are now making a bit of a comeback as well. So the metal index has moved to the high point of trade. We wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
Good morning. It's a Friday and you are with us here on Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, and Dalal Street is in Friday mood as well after some intense pain in yesterday's session in the broader markets. We are seeing a swath of green. I am Hormus Fatakia. With me is Vinny Motiwala. Vinny, good morning. We crossed 25,000. We are still there at those levels, but the bigger takeaway is that the broader markets are doing well today.
Absolutely. Broader markets are doing well. Everyone's portfolio seems to be happy. Everyone's going to be cheering the Friday celebrations. So I hope you also will be cheering it as well, right, Hormus? We all are happy it's Friday. Markets are happy it's Friday as well. So yes, good move coming in for the mid and small cap, like Hormus is mentioning as well. We're seeing the bank, Nifty Bank, that's also seeing a very good performance coming in today's trading session. Obviously, those RBI norms that we came in terms of project financing, that's supporting some of this up move coming in from the PSU banking side, whether you look at some of these housing finance companies, PFC, REC, IREDA. We'll talk about more of that later on in the show as well to get more details on that front. And other than that, today when you're looking at sector-wise, also realty, that's also is doing well, managing to hold on to gains of almost 1.9%. Very small percent, Hormus, but commercial real estate developers, you know, project finance comes in for them as well. And those could also see some bit of a benefit coming in. But other than that, PSU Bank shining, metal shining as well. Only what's not doing well is Nifty Media. And I think Sun TV not doing well. That is also something that's bringing it down, right?
Sun TV issues of their own, and understandably so that the stock is trading lower today. Not a significant move on the downside as well, just 3.5% lower. But mind you, the stock is down already 35% from its 52-week high. So that has a factor to play as well. But since we're talking of gainers, you will also mention Endurance Technologies. Another day of strong gains today, 6.5% higher on that stock. At the top gainer on the Nifty 500 in today's trading session, nearing the day's high as well. But Premier and Vari Energies, the two solar module manufacturing companies, they are the ones that are putting up a good show as well today. Both of them trading with gains of 5.5%. In fact, Vari Energies did issue a clarification yesterday to CNBC-TV18 where they mentioned that although they have an exposure to the US market, they are focused more on the utility and the industrial side of things, while the bill that Donald Trump intends to pass in the Senate and the House, that one big beautiful bill that focuses more on housing and retail and all of those segments. So they are not they are largely insulated from that bill, and as a result of which the stock doing well for itself, as is Premier in today's trading session as well. We'll get to some more gainers and losers in just a bit, but we put the spotlight first up on autos, and that is on the back of some Vahan data for the month of June, where showing registration growth of 6% led by the two-wheeler segment. Sudarshan, who's been on top of this subject right through, is here with more details on this. Sudarshan.
So we are approaching the last week of the month of June, and as usual, like we have tried to gauge the interest on the auto registration, and that is as per Vahan website. So my key question is, will the month of June see growth for total registration of more than 6% or say more than mid-single digit growth? Because as of now, in the first 3 weeks of June, total registration has increased by 6%, and it's led by two-wheelers, which has seen an increase of 8%. So apart from passenger vehicles, which is seeing a drop of 1%, all the other segments have seen a growth. Even CV has seen a growth of 4%. Three-wheelers have seen a growth of 4% as well. Now talking about the company-wise, which are the major outperformers? In the two-wheeler space, as usual, TVS Motor and Eicher Motors are the outperformers. Eicher Motor in the first 3 weeks of June have done almost 70% of the total sales that the company had done in 2024. It's almost the same for TVS as well. And amongst the four-wheelers, Ashok Leyland from the CV space and from the passenger vehicle space, Mahindra & Mahindra Auto are the outperformers. And now talking about the underperformers, Bajaj Auto in the two-wheeler space so far has done just 60%. It's almost the same for Hero Moto as well. And even Maruti has just done 50% of the total sales that company had seen in the same month last year. Tata Motors, as usual, remains amongst the biggest underperformer. So we'll have to see how the registration pans out in the last week of June. But so far, after several months of underperformance, June is indicating that auto registration might be healthy.
Okay, auto registration might be healthy in June. Thank you so much for that, Sudarshan. But let's talk about delivery. That's also in focus today. Mangalam is joining in with us to give us more details on this one. Mangalam, we have a brokerage report here, right?
There is a brokerage report that has come in on delivery that is coming from Jefferies. They've actually underperformed, or rather they've actually cut their target to underperform, and the price as well has been cut from 500 rupees to about 300 and a little over that. The reason why they do that is because despite the outperformance that we've seen in the stock, remember, ever since they've announced the acquisition of Ecom Express, the stock has rallied about 41%. This as against the Nifty, which has rallied about 8% since then. You know, the street has been optimistic about the consolidation in this third-party logistics space. But they see a risk here. What is the risk that they see? Is that, you know, one of their bigger clients, Meesho, has been insourcing their logistics, and as a result of which their market share in the overall third-party logistics, e-commerce logistics space is likely to decline at a time when, you know, e-commerce logistics volume growth itself is likely to be much lower than what it was in the post-pandemic buzz. So, for instance, volume growth for e-commerce parcels was 30% CAGR between FY20 to FY25. Jefferies believes this is likely to grow at just 10% over the next 5 years. And in that as well, delivery, because Meesho has moved a large part of its business to its own logistics party, and at the same time will continue to do that, delivery's market share will reduce to around 34%, and that provides a bit of a downside risk out here, despite the upside that is likely from the consolidation of e-commerce express. So put all these things together, they're slightly negative on delivery, and they've cut their target price. More importantly, for delivery as a stock as well, you know, a large number of funds own it, with a fair amount of funds which are looking to sell. So that liquidity risk is always there with the stock.
And the stock too, still 27% below its IPO price of 487. Mangalam, thanks a lot for that. One of those few newly listed companies that have not managed to see their IPO price since listing. But Vinny was highlighting some of the earlier names, be it the RECs, the PFCs, and the kinds, of course, on the back of those project financing norms that were eased. And Lata has taken us through this deep dive on what it means for these companies.
Well, the draft had threatened that there will be very high provisioning of 5% on all project finance rules. But yesterday we got the final rules, and they were far simpler, far easier. If for any new project finance loan, banks and NBFCs like PFC and IREDA have to set aside 1% of the total loan as provisioning. And once it's the old rules, as I said, the draft said 5%. Once they start operating, then the provision falls to 0.4%. In the draft, it said that even when they start operating, it should be 2.5% and gradually brought down. The idea was, of course, to build provisions during good times when infrastructure projects go bad during bad times. But the point is the new rules, actual rules, are far simpler. Also, for commercial real estate, you have to set aside only 1.5% for project finance compared to the old 5%. If anything went bad and the date of commencement was deferred, then an incremental 0.37% of the loan has to be set aside as provisions for every quarter deferred. In the old draft rules, it would have been 2.5%. So all told, it's easy. Also, the new rules will apply only for forthcoming prospective loans which are signed after October 1, not for the old loans. So relief for NBFCs and banks.
Lata, thanks a lot for that, and as a result of which all of these names, be it the likes of PFC, REC, IREDA, doing well. REC is up 3.5%. PFC is now moving to the highest point of the day, almost 6% higher on a PFC in today's trading session. IFCI too trading with gains of around 5%. So good going for a lot of these names. By the way, Endurance Technologies is now at the day's high, 9% higher on that stock, and remains the top gainer on the Nifty 500. Take a look at that spike that has come in the last 10 minutes or so. The stock, by the way, the Nifty 2 now above 25,000, 220 points higher, 700 higher on the Sensex as well. Take a short break. On the other side, we come back with all things commodities with Manisha Gupta.
investing.
Welcome back. Shifting focus now to commodities. Manisha is here with us, and after talking about platinum, silver all through the week, gold felt a bit left out. So Manisha is here to talk about gold. Manisha.
Well, not exactly the gold prices though, but the notification that is come in the Indian markets yesterday by the Indian government, where you now have a restriction on various ways of gold imports. Well, just to tell you that the government has curbed imports of palladium, rhodium, iridium, alloys containing more than 1% of gold by weight. For the longest time, many of these metals had way lesser import duty than gold, which stands at 6%. So even if you had 98% of gold and just about 2% of platinum or palladium, it was coming in the name of platinum or palladium with lesser duty being paid. So that was creating a lower, not a level playing field for the Indian players here. And in any case, this was coming under smuggling there. Also, what the government has done now is they have restricted imports of colloidal metals and also certain chemical compounds. What started to happen is that once the plug, it was plugged that you can't get it in the sense of other metals, a lot of gold was coming in liquid form in sense of chemicals. Now, that is something that the government also has ensured is restricted now. This is being done to prevent gold from entering into the country disguised as chemicals, as liquids, or as under in sense of smuggled. Also, this is being done to plug loopholes which were used to get the metals inside into the country. Remember, gold and silver is at 6%, but it is much lesser when it comes to many of these chemicals, when it comes to liquids, when it comes to iridium and other alloys as well. So with the notification that is in effect from immediate effect, this is all that the government is looking to plug.
Okay, Manisha, thank you so much for that. So that is an update that is coming in and a notification that came in on gold. But let's shift focus and put the spotlight on Dreamfolks. The shares have been falling for the last couple of days, and what is this actually the reason behind this? Yesterday there were some articles that came in, newspaper articles, that seems like some of the major Indian banks and some of their clients, like ICICI Bank, Axis Bank, MasterCard, were looking to move away from that. After that, the company gave a clarification of not losing any clients, and they said that their negotiations were always a part of the business and as a process, an ongoing business process. But to talk to us more about this and help us understand this, we have Librata, who's the chairperson and MD at Dreamfolks Services, joining in with us on the phone line. Librata, good morning. Thank you so much for joining in with us. Like I was mentioning, these reports that came in yesterday, right? And they said that these concerns that came in from some of these banks were mainly because of the disruption in services that was seen. One, are there any concerns coming in on that front? Are you in negotiations or any terms and renegotiations with any of these companies as of now?
Good morning. So first I'd answer to your point on disruption which happened, right? So I think that disruption, what we are talking about, was last year, and that was a technical. So it was more of the, so if you have seen that, we have this EDC machines wherein we actually have the process of checking on the eligibility of the card. So there was a downtime, and that was one of the reasons that, why. And we have also clarified and given the reasoning at that time. So if you have also seen that, even after that, I think all the clients are still with us. And the reason is because it's been a long-standing relationship, what we have with all the banks. They all understand that what is the value we bring to them. And second, most importantly, is that we are deeply integrated with all our clients, all our banking clients. And in terms of our contracting, if you have to see the process the way it is, that we have our main contract which is 5 years. However, our commercials are annually, it's on the annual basis. So yes, there are negotiations on the commercials on the annual basis. It's an ongoing process.
Okay, so you are saying right now your negotiations are on commercial basis, what you are talking about. Is there any contract that is ending in the recent time or during this year that you are negotiating as well with any of the banks?
No. So all our contracts are in place, and all the programs are ongoing. So there is no such thing going on right now.
Okay. So there's no change in terms of contract as of now. None of your contracts are ending during this year, the 3 to 5 year time period, right?
No, and this is business as usual, So it's a common thing in a business where your contracts are under renewal. There will be RFPs coming in. The negotiations are on. So it's ongoing, and it's a business thing. So there is nothing change in the business structure.
Librata, good morning. Thank you for joining in. So you're going on record to say that there has not been a single order contract cancellation, right, from none of your existing clients?
Yes. I mean, we have not received any such information from any of our clients that, they do not want to work with us. So, yes.
And any new negotiations to onboard newer clients?
Yes, there are a lot of new clients which have been onboarded. If you see that, in our last earning calls also we clearly mentioned about not just the banking, but we also have onboarded almost nearly 30 enterprise clients with us. And not only in terms of the lounges or the travel. If you actually look at it, that, we have just announced our two big new services, which is our social club and coffee in the mall. So the reason of also adding all these new services is because we see a high demand coming in from our existing clients, because they also want a differential service for their card holders. So this is where the Dreamfolks is actually building better technology, new services coming in. So I would say that, our relationship and the way the business is actually in a very positive and a growing stage.
Librata, just circling back, I want to understand in terms of commercial side of the negotiation that goes on. Currently, what is it in terms of pricing? Are we expecting higher pricing? What are the negotiations going on, and when is it likely to be closed by as well?
So as I told you that, see, most of our contracts, the way it is either January to December or it is April to March, and most of them are actually closed. So it's an ongoing thing. So it's nothing different. And the way the price escalation happens is it depends on the, inflation there in the market. Basis that the pricing is, the price escalation also happens. Okay. So there is nothing different which is going to happen this year.
Okay. And Librata, you stick to the 20% CAGR growth that you've spoken about in the past as well for FY26 and onwards?
Yes. So the thing is that, as we also mentioned to you that, we are also getting into a newer industry sector in terms of the clients onboarding, which is the enterprises, and also the new services. So, yes, as we mentioned that, in next 3 to 4 years, you will also actually see, the new services also giving us, I would say that a good percentage coming on our top line from these services. And yes, we stand by what we have committed earlier.
Okay, so that is the non-lounge services, right? Which you're looking to further grow over the next few years as well. And how much would that portion be? I think somewhere around FY24-25, it was around 7 to 10%, somewhere in that range.
Yes,
what would it be in the next couple of years?
So next couple of years, I would say that, in next 4 to 5 years, what we see is that it's actually going to be around 50%.
Okay.
Librata, since you had mentioned for the lounge services as well, you plan to grow, or you want to have that business as a significant contributor to your top line over the next few years. Where does that stand? You stick to that earlier guidance as well that you had mentioned in your earnings call?
Yes, we stick to the same, and it's not, because lounges are not just for India. If you actually look at it, that we all also expanded our network into 100 plus countries, and the focus is, when we talk about the lounge business, yes, it is not just limiting to India, but yes, it is a global market what we are talking about.
Librata, there is a lot of talk about competition as well, right? Large conglomerates are also looking to enter into this business. What would be the possible impact on your business going forward?
So I would say the competition is not now. It's been there from the time we started this business, and when large companies also saw opportunity into this area. I do not want to name them, but there were a lot of large tech players also who wanted to enter into this space. But I think that is a differentiator what Dreamfolks brings into the market, and the value what our clients have been seeing with us. And I think that is the trust and confidence what they have always shown and are trying to be with us. So I would just want to say that it's not that competition is coming in now, but there has been, this has been always there, and this is nothing new for Dreamfolks.
Absolutely. And just the last question from my side, at least, realization guidance is what I want to understand, right? I believe it is somewhere around 1,200 per customer who's there, who enters the lounge services. Does that stay intact? Where do we expect that moving now?
As I told you that, that of course would change because as the inflation is growing, right, and it impacts the inflation. So, yes, there are changes, but, I would not be able to give you the exact figure that what it is. But I think once we actually announce our report, and you should actually look at our quarterly report because we are very confident the way the business is shaping up now.
One final question from my end as well, Librata. You mentioned you're sticking to your revenue growth guidance as well. What about margins? Because they had narrowed in the fourth quarter. We ended the fourth quarter with 6.5%, 6.3%. Do you get back to 8%, 9% levels anytime soon, say in the next couple of years?
So I just wanted to correct you there because that is not the margin what you're talking about. That's the EBITDA. So the margins were between 11 to 12 to 13% what we have guided, and I would stick to the same guidance and we'll try and maintain the same margins.
All right, Librata, thank you so much for sparing time and joining us with those important clarifications there on those news reports. And the stock too has recovered significantly from the lows of the day and has moved into the green now, as the management has clarified that there has been no contract cancellations from any of their existing clients. They've stuck to their guidance as well, all their contracts in place. And the street likes what Librata
I'm just Sudarshan is also mentioning it's 8% recovery from the lows, right? So good recovery from the day's lowest point is what we're seeing. But on that note, we're going to actually slip into a very short break. When we return, we'll discuss market technicals with Saumil Mehta of Mirae Asset Sharekhan and also discuss the trading bets. Welcome back to Trading Hour on CNBC-TV18. Nifty about the 25,000 mark. 25,010 is what the Nifty is trading at. Now, to understand the technical levels and technicals that we should watch out for, we have Somil Mehta of Mirae Asset Sharekhan joining in with us for that. Somil, good morning. And today we are seeing the 25,000 mark coming in for the Nifty. We're seeing overall the market is on that positive mood. But is this 25,000 sustainable this side? What are the levels that we're keeping an eye out on, as well as your top bets?
Good morning. Good morning to everyone. Hi. Yes, absolutely. I think I'm absolutely positive on the markets. It has broken off a small range which we've created, which Nifty has created in the last 3-4 trading sessions. A small flag, bullish flag. It has broken on the upside, but the larger range is still intact, which is the higher end is 25,200 and the lower end is 24,500. We are heading up. High top, high bottom formation has already formed. The next target for Nifty would be 25,200, 25,300 levels in the very short term. Bank Nifty as well. I think Bank Nifty will outperform from here on because the banks have just started moving up. ICICI is looking good. Axis, Kotak, all of them are looking good, and they will have the good momentum here. The support for Nifty now is slightly higher from 24,500, and now it becomes 24,700. That will become very crucial in the very short term, even in the medium term outlook, because this range was very crucial. So now, yes, buy on decline should be the strategy. 25,200, 25,300 is the target for Nifty.
Somil, just before we ask you your specific stocks, just pull up Dreamfolks. That is now up almost 2%. So that's almost a 10 to 11% recovery from the lows of the day. In fact, it's now up 3%. So almost a 20 rupee recovery that we've seen from the lows of the day after the management issued that clarification to us that all their contracts are in place and no cancellations have been seen so far. Somil, good morning. Thank you for joining in. What about specific stocks from the large caps or from the broader markets?
I have stocks from the broader markets. It's just started moving up. Broader markets were correcting for the last couple of weeks. Now it has taken support at very crucial levels. So I'll be taking SBI Life. That will be my first bet. SBI Life has broken out of a small triangle pattern on the upside. Stop loss would be 1779. Target would be 1920. The second one is MCX. MCX has also broken out of a small bullish flag pattern, taken support at 2040 daily moving average. Great setup. Stop loss would be 7840 and target would be 8200.
Okay, Somil, those are the stocks that we're keeping an eye out on. So thank you so much for joining in with us in today's trading session as well. Thank you so much for that. But on that note, we're going to slip into a very short break. And after the break, we'll discuss market fundamentals with Mukul Kochar from Investec Capital Services. So don't go anywhere.
investing.
Welcome back to Trading Hour on CNBC-TV18. Markets are managing to hold on to around those 25,000 levels, about that mark as of now as well, almost near the day's highest point. Outperformance coming in from the broader end of the market. Mid-cap up almost 1%, small cap up 1% as well. And advance decline ratio today clearly in the favor of advances versus declines. Banks also something that is supporting the up move in today's trading session. So banks also holding on to gains of almost 1% as well, Hormas.
Since you're mentioning banks, look at HDFC Bank as well. That has been the one conversation over the last few days, and that's of course because of HDB Financial's IPO. They finally announced the dates yesterday and the price band as well earlier in the morning, and it's a 12,500 crore rupee IPO. So you just took a look at how these large giant-sized IPOs have fared in the country. We had quite a few of them in the last few years itself, and the largest one on record within the country's IPO history has been Hyundai, which happened last year. That 27,000 crore rupee IPO, almost a 28,000 crore rupee IPO, listed in October of last year, a 1960 IPO price. The stock, even after 8 months of listing, is still at that IPO price. It's not moved anywhere from those levels. The high that it has made is also around about 1980, so no significant upside from the IPO price as well. And Hyundai overtook LIC as the largest IPO, and LIC when it came out in May of 2022, a large 21,000 crore rupee IPO, hyped to the skies, 949 rupee IPO price. And today too, the stock is around about that IPO price, but not before. It did make a high of 1200 plus, and from there it has corrected around 24%, and now it trades around about that IPO price as well. But one of the big value destroyers in the recent times has been Paytm, and that 18,000 crore rupee IPO that came out in November of 2021, a 2150 rupee IPO price, and it is one of those few IPOs that has still not seen its IPO price since it listed. Still down 60% from those levels, even after almost tripling from those 52-week all-time lows that it had made earlier this year. And since then, it has recovered from those levels, but still 60% below IPO price and 23% below its 52-week high as well. Back in the day, of course, Coal India for a very long time was India's biggest IPO, a 15,200 crore rupee issue, 245 rupee IPO price. And after years of underperformance, it is only recently that the stock crossed its IPO price. So still trades 60% higher. Of course, a very high dividend yield from this stock as well. And from those post-listing highs, which are in excess of 500 rupees, the stock is down about 30%. Another recent listing, Swiggy, 11,000 crore rupee IPO, 390 rupee IPO price, listed only last year. 7 months after listing, still around about its IPO price after recovering from the lows that it made. And even after it made a post-listing high in excess of 600 rupees, the stock is still down 40% from those levels. General Insurance Company was also another big IPO, almost close to 11,000 crores, 900 rupee IPO price, and the stock trades well below that. It listed in October of 2017, 60% below its IPO price. And another one of those names that has not seen its IPO price since its listing. SBI Card, of course, another one that recently crossed its IPO price, listed right at the start of the pandemic, a 10,000 crore rupee IPO that took place. And even today, the stock is above the IPO price and currently below the 52-week high that the stock had made recently. And lastly, the most recent one of them all, NTPC Green Energy, of course, a 10,000 crore rupee IPO, 108 rupee price, still at the IPO price. November of 2024 is when it listed, and from the post-listing high, which is around 150 rupees, it's down almost 33%. So, as they say in one of those very popular ads, "Bada hai to behtar hai," not necessarily.
Not always.
Not always. And you can, hopefully, HDB Financial might just change that trend. And we'll take that question forward with Mukul Kochar from Investec Capital Services, who's joining in. Mukul, good morning. Thank you for joining in today. And the big talking point, of course, has been the HDB Financial IPO. And what would be your view on this, right? It's a large IPO. What do you make of the price band that it has been put out? And will this finally buck the trend and eventually tell us that, okay, a large IPO can also generate returns for investors?
Yeah, so interesting statistics there, by the way. So on HDB Financial, we really don't have a strong view. We are not one of the banks on the issue, so I would not give a very pointed comment there. But broadly, on the IPO cycle, what happens is it's like a cycle, like anything in the market. And the larger IPOs happen towards the fag end of the IPO cycle, when there's a lot of excitement and big money comes in and bigger IPOs get absorbed. And that is when, there's overexcitement, and that is when the pricing dynamics actually fail. That's probably one of the reasons why you're seeing the returns being tepid in large IPOs. HDB Financial, just one comment, comes from a very respected house. So there will be some pricing premium based on that, but performance has been a little tepid in the recent past. So both these dynamics will be taken into account as the bankers price the issue.
Absolutely. There are factors that I have to take into account as well. I don't seem bada hai to better hai. Whoa. That dialogue of Urma's hoping that it doesn't turn out to be true even now. But Mukul, good morning. This is Vinny joining in the conversation as well. I just want to understand overall financials. We had those RBI norms that came in for project financiers side as well. What is your story, or what are you expecting coming in from the financial front? Whether you would look at PFC RECs, PSU banks, private banks, NBFCs, what interests you in the financial pack?
So the financial pack per se, definitely, barriers to entry and competitive advantages are at play, as scale is a clear sort of, differentiator here. And scale is a differentiator across multiple points. Its cost of deposits is better, for the larger banks. Then, your OPEX is better as a percentage of AUM. So they're just able to price risk better. On top of that, they also have access to the better customer pool. So what's happening is the market's understanding that, and clearly the larger banks are trading at a higher band or higher price to book than the smaller banks. Now that itself then in a circular loop gives them a competitive advantage, because since they can dilute at a higher price if they want to grow higher or at a faster rate. Their cost of raising funds is lower, or equity funds is lower. So having said that, advantage larger banks, mid-market banks, they're selective ideas where we are active, but largely, we are focused around the larger banks, because that's where the barriers to entry and the competitive advantage is clearly showing. With the mid-market banks actually trading at book or below, the story seems a little challenged. Yeah. On the government banks, a very controversial. Next 2 years, of course, earnings are going to be under stress because they've taken write-backs benefit. There's also an adverse rate cycle which they're facing. So consensus is that they will see substantial NIM pressure, and earnings growth will be tepid. I feel the contrarian view that that things may turn out better, and the worst is priced in for the next 2 years, and the market may look beyond that to FY28. And on that basis, these are still double-digit ROE banks trading at or below book. So valuation support is there. So I'm actually personally in the camp that PSU banks deserve a look.
Mukul, I was just reading a report a few days ago which spoke about a $40 billion consumption boom that is lined up in India because of the various steps that have been taken, the budget cuts, the rate cuts from the RBI. But on the flip side, there are also reports that unemployment is on the rise. But if you take a look, do you see a potential for a consumption boom in the country, especially because the macros don't seem to suggest otherwise, because unemployment being on the rise? Do you see that being confined only to the premium space, the premium consumption, or because of the fact that there has been a rate cut from the RBI and this tax boost as well that has come from the budget, you would see the lower entry level, mid-income sort of consumption also get a boom because of this?
So, again, a very hotly debated topic amongst investors. My view that we are moving towards more a savings investments economy. Market, by the way, market prices are reflecting that. You've seen returns getting better there. And if you're going to do a savings investment-led economy, it's going to come at the cost of consumption. So I tell people overall low consumption is a feature, not a bug of this economy that we're headed into. And that is what, and the second point is, we historically have been a consumption economy, less investment based economy. So in that case, all the consumption stocks are fully scaled. Yeah, some of the largest market cap companies in India are consumption companies. So these are fully scaled companies. On that scale, growth in a weaker consumption environment is lower. Multiples are exceptionally high. So these stocks will struggle to work in the medium term, next 3 to 5 years. Within the pack, of course, as you said, premiumization is a definite theme. So even if overall consumption grows lower than GDP, lower than GDP growth, because savings investment grows higher, premiumization, I think, remains a solid trend. You can see that in autos, you can see that in the hotel industry, you can see that across the board. The premiumization actually still remains a solid trend amongst a weaker consumer overall.
Okay. Premiumization is a trend that is remaining solid for a while, is what you're expecting to see going forward as well. Mukul, what's your thought coming in for something like the food delivery apps, whether you talk about Swiggy or Eternal? These are two options that we have right now. What are your thoughts on this one? If consumption improves, do you think we're going to keep clicking a bit more in terms of ordering our food online as well?
So clearly, just fair disclosure, we don't cover these stocks yet. So, but broadly, I can tell you that, e-commerce in general is reducing friction, and there is a definite play there. It opens up new avenues for the consumer in sort of, consuming at home. Definitely a solid play. Again, we believe that the trend of eating out or eating at home or ordering from outside is going to increase as overall well-being improves in India. By the way, just on the, and this is all related, just on a consumer who can consume more at a premium end. If you look at the demographic of the premium consumer in India, that demographic itself is growing at 12 to 13% CAGR. So the demographic, as in the number of people who are able to consume premium product, is growing at 12 to 13%, whereas overall population growth is much lower, maybe in the 1% handle. In that case, you add some inflation to that. Most of these companies which are sort of, exposed to more sort of different and more sort of premium consumption inherently start with a double-digit revenue growth expectation. So per se, anything about, consumption from outside, all these are similar trends, which is basically a consumer that is moving up.
Just as you spoke of premium consumption, Mukul, Vinny already placed her order for lunch on her phone. But thank you so much for sparing time and joining us today. Look forward to having you more.
All right, thanks.
Thank you so much for joining in, and take a short break here on Trading Hour. Back with more on the markets on the other side. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18. We're seeing the market at 25,030 levels approximately. But earlier on in the day, we spoke to seasoned market investor Pankaj Shibrewal of Ikigai Asset Managers. And he's sharing his view in terms of the mid and small cap. Where does he see opportunity coming in? Listen in.
7 out of 10 guests that I speak to, they still say that no, large caps offer better comfort. And there's still some overvaluation in SMIDs, as they're called.
So 3 points I would like to draw. And we mentioned in our quarterly newsletter, which I published in April, that on the headline basis, when you look at valuations, we acknowledge what people are saying, that mid and small caps are expensive to their history and versus large cap. So there's a relative margin of safety there. But I think devil lies in the details. So if you go a little deeper, what you find out that earnings growth in mid-cap especially has been faster in the last 5 years. Even in FY25, which was a slow year, mid-cap's earnings grew at more than 18-20%. And going forward also, our expectation is that mid-caps and small caps can offer better earnings growth than large caps. That's the one part. The second part important is the composition of the profit pool. So if I look at the top 100 companies, 52% of the profit is coming from PSU banks, private banks, oil and gas, and PSU sector, which are generally low P in nature. And that representation in mid and small cap is to that 15, 16%, 17%. So generally, when you look at X of these sectors, Nifty is trading at a premium to mid and small caps. So when you do a apple to apple comparison, and the third part is, when do they trade at a huge discount? Take 2018-19. You came from a huge bull run in 2017, and then you started seeing solvency issues, right? You had Yes Bank, DHFL, all kinds of skeletons were coming out, and there was a scare of solvency. This time in now last 5 years, the debt to equity and the leverage position of small and mid caps are far, far better in many cases compared to large caps also. And the last point which I want to drive, Surabhi, is that mid and small ab utne chotu companies nahi bache. Now the definition is up to 33,000 crore market cap is a small cap. Up from 33 to 1 lakh crore is a mid cap. So and they are sectoral leaders. You take tires, you take hotels, you take airlines, you take so many sectors like infra, capital goods, auto ancillaries. All these companies are classified in mid and small, but they are sectoral leaders in the sector they operate in. So I'm saying that the cycle and the texture of the market has changed. There are pockets of bubbles. I am completely acknowledging that. But it should not be painted with the same brush that everything is expensive and everything just sell and move away. I think in this market where 5,000 listed stocks, take out the top 100 stocks, you will find at least 40, 45 stocks at any point of time, which will give you that kind of a value to ride on. So I believe that you have to be a stock picker, as you rightly mentioned, and there are opportunities in the market which will make you money over a 2-3 year period.
This is very interesting because you're the second person that I've spoken to, I think, in the last 2-3 weeks, who has actually said that Indian stocks are not necessarily over expensive. I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap. And I was like, wow, that's
I won't agree to cheap, but yeah, I mean, you have to search your pockets. And I think ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters. And coming to your second point on what to do, I think over a period, what I have learned is that process of elimination is far powerful than process of selection.
On that, let me ask you, because you just said that there are still maybe some pockets where, things are a little overheated in the small and mid-cap space. So can we sort of rule them out? I mean, do you see, I don't know whether it's maybe defense or are there certain thematic areas where you do see excesses? Which ones would those be?
So, for example, one of my yardsticks is, for example, cash flows. So look at few of the EMS companies trading in India, right? Narrative is very strong.
90 times P, 100 times P.
110 times P. But when you open their cash flow statement, not all I am saying, but many of them who are trading between 25, 35, 40,000 crore market caps, the cumulative cash flow over the last 5 years, operating cash flow, is not even more than 50, 100 crores, right? That means it's a thin margin businesses, but they are hugely deploying money in working capital to drive growth. So I think that's something we need to be, just I'm giving as an example.
Something to be cautious about.
That narratives will work for a while.
Right.
But finally, top line is vanity, bottom line is sanity, and cash in bank is reality.
Is the reality.
So cash flows you can't ignore at the end of the day.
Sure.
Yes, for 1 year, 2 year, there could be aberrations on cash flow either sides. But over a cumulative 4-5 year period, cash flow is something we need to be taking cognizance of.
Welcome back. 250 higher on the Nifty, almost 700, almost 800 higher on the Sensex now. The broader market's doing fairly well for themselves as well, seeing a bit of a rebound after that sharp sell-off in yesterday's trading session. But we call time on this edition of Trading Hour. Vinny and I take your leave. Thank you so much for watching. Halftime report on the other side.
Stocks perk up after Trump says a decision on striking Iran will be taken in 2 weeks, raising hopes of a diplomatic resolution of the Israel-Iran conflict. Realty, utilities and metals are the big gainers.
RBI provides big relief to project financing banks and NBFCs by slashing the required provisioning for such loans from earlier proposed 5% to 1%. Stocks of these lenders perk up.
Sun TV slips after Dayanadi Maran accuses promoter and brother Kalanidhi Maran of fraud and money laundering and demands restoration of the company's earlier ownership structure.
Britannia MD Varun Berry is confident of the FMCG sector, which is not too far away from double-digit growth. He expects growth to return to biscuits as well, while the non-biscuit portfolio for the company will grow twice as fast. Protein and healthy snacking are two categories he's upbeat on.
Secretary of Shipping, Ports and Waterways T. Ramchandran tells CNBC-TV18 that despite increase in costs, there is no supply disruption. He adds that plans are underway to expand India's shipping and port capacity multifold.
Wonderful Friday afternoon that you're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. Why do I call it wonderful? Because for the last few days, the market was fairly jittery. Today, the direction is clear. We're above the 25,000 mark on the Nifty, and all three major indices are doing well for the frontline index. That is the Nifty Bank, the IT index, and Reliance, which is an important heavyweight, can be classified as a sector on its own, has been doing up. So all of that looking good, with the Midcap index stepping, a shade better than what the frontline index is doing. So portfolio is feeling a lot better too. So despite the uncertainty that we're seeing around the globe, Ekta, seems like maybe our markets are in fine fettle today.
Yes, absolutely, Mangalam. We have the Nifty, which is at 25,000, so it's recouped back to those levels. And as of now, we do have a lot of stocks which are on the advancing side as well. So definitely doing much better in terms of trade today. But separately, just want to point out that Brent crude has also softened a tad bit. So that's the reason why you're seeing that momentum play out in our markets, and that Trump has bought a little bit of time, around 2 weeks, to decide what his decision would be on the Iran-Israel conflict, and that is probably assuaging a little bit of concerns that maybe any kind of diplomacy is still on the table. So let's see how the day pans out. For now, the Midcap index is doing better, considering that the Midcap index has week to date underperformed the Nifty as well as the Sensex, but it seems as though it is contracting in terms of those losses at this point in time. So that's what's taking place in terms of the markets. But let's get going on the show. Let's put the spotlight on autos. Total sales show a registration growth of around 6%, led by the two-wheeler segment. Sudarshan is joining in. He's going to tell us, will June see a mid to high single-digit growth in registrations or not? Sudarshan.
So after 3 weeks of June, we have tried to find the basically interest of the Vahan registration data, how's the trend going on. And after several months of the underperformance in the month of June, in the first 3 weeks, we are seeing a growth of almost 6% in total vehicle registration. And it's being led by two-wheelers, which has seen a growth of 8% so far. And also, apart from passenger vehicle, which has seen a drop of 1%, all the segments have seen a healthy growth. Even commercial vehicle has seen a growth of 4%. Three-wheeler also has seen a growth of 4% too. Now coming to company-wise, who all are the outperformers? In the two-wheeler space, two usual names, TVS Motor and Eicher Motors, continue to outperform, and Bajaj Auto and Hero Moto remain amongst the underperformers. So first about Eicher Motors, so far, it has done 70% of the total sales that company has done in the same month last year. It's almost the same for TVS Motor too. Now for Hero Motor and Bajaj Auto, so far they have done almost 60%. In the four-wheeler space, Ashok Leyland is the biggest outperformer in the CV, and Tata Motors remains the underperformer continuously, and even in the month of June, so far Tata Motors just has done 50%. Mahindra & Mahindra continues to outperform Hero Moto. For Mahindra & Mahindra Auto, it has done almost 60%, and as far as Maruti is concerned, it has just done 50% of total sales that company has seen in the same month last year. So far in the first 3 weeks of June, total registration is looking healthy after several months of underperformance. We'll have to see how the last 1 week pans out.
Take that point, Sudarshan. Thanks a lot for that. So that's about the Vahan registration data that has come in. Meanwhile, just keep an eye out on the bottom of your screen. There is some clarification that has come in from Sun TV. They've clarified on reports of Dayanidhi Maran sending a legal notice to a promoter of Sun TV, that is Kalanidhi Maran. We've seen a smidge of a spike on the stock price. We'll just try and get some details on what the clarification entails. Remember, Money Control had earlier reported that Dayanidhi Maran had gone ahead and sent a legal notice to Kalanidhi Maran. Sun TV said the alleged matter dates back 22 years. That's what the allegation was as well. That 2003 is since when there have been allegations of fraudulent transactions, as a result of which Kalanidhi Maran, as claimed by Dayanidhi Maran, has legal control and majority stake of Sun TV. So it is a 22-year-old matter when the company was privately held and not publicly held. We'll try and get in more details on this one as it plays out. But for now, there's a smidge of a recovery on the stock. We're none the wiser because, Sun TV is just saying that this matter goes back 22 years, which isn't any different from what is being reported. But is there any truth in sight, or is there any further clarity when it comes to the legality of the situation or not, is something we will very, very closely monitor. But speaking about stocks under pressure, the other stock which is mildly under pressure today is Delivery, and that on the back of a bearish note that has come in from Jefferies. What Jefferies basically says is that the street was optimistic on Delivery ever since the company went ahead and acquired Ecom Express, and that was on hopes of consolidation in the industry. The stock has outperformed since then. It's rallied about 41% as against the Nifty's rally of 8% since this acquisition was announced. So a lot of this optimism was priced in. What wasn't priced in, however, is the risk of some of its large clients going ahead and starting their own logistics business, which would then lead to client loss for them. And that exactly is what's taking place with Meesho. Meesho's insourcing could pressure its third-party express logistics business, and that's something that will happen as Meesho expands its reliance on its own logistics vertical as well. They expect the express parcel industry to grow at 10% compounding over the next 5 years, as against 30% in the previous 5 years. But the previous 5 years were also buoyed by the post-COVID boom that we saw. And as a result of which, when the industry is slowing down as compared to the previous 5 years, and in that some of their large clients are taking share away by insourcing, they expect their marketplace share in the third-party logistics to halve to 34% by FY28, and that propels them to cut their target price from 500 to 315. Okay, we have some more comments coming in from Sun TV. They say that all acts will be done in accordance with legal obligations, but more importantly, all allegations made are undue, and they are refuting those allegations. So we'll keep an eye out on that. And there's a slightly bigger up move that we're seeing on Sun TV from the lows right now. So they're saying that all the allegations are baseless and they will be dealing with them in legal accordance. But from a valuation standpoint as well, Sun TV's market cap is close to 24,000 crores. They have cash and financial investments of close to 6,000 crores. Take that away, and you have the IPL team, which is valued at about $1.5 billion, which is nearly 50% of their market cap. So X of the cash on their books and X of the valuation of the Sunrisers Hyderabad, the base business is just around 5,000 to 6,000 crores, which a lot of people are finding attractive, which is what may have propelled, everyone to look at it from a business standpoint. So we'll watch out for how this, story really pans out. A 22-year-old story now coming to the fore.
Yes, absolutely. Well, that's on Sun TV. They are giving those statements, as you can see on your screen. The stock is down around 1.5% at this point in time. But moving on, the Reserve Bank of India has eased project finance norms for banks, NBFCs. Lata joins in to give us more details on what this means. Lata.
Well, the draft rules on project finance were very strict. Compared to that, the actual rules which were announced yesterday, that is Thursday, are relatively easier on banks. Basically, it refers to how much you must set aside as provisioning when you give a project finance loan, because in the past 10 years, during the infrastructure loans boom period, a lot of them went bust. Now, the RBI's move was in the draft rules that more money be set aside in good times so that even if they go bad, you can adjust. But to come to the rules say that banks have to keep a provision of only 1% for a project finance loan. The draft rules had set 5%. At the moment, banks keep only 0.4. So it's more than now what it is now. but it is much less than what the draft rules threatened. In case the projects were delayed, they are called DCCO deferment. What is DCCO? It is date of commencement of commercial operations. If it is delayed, then you have to keep an additional 0.37% of the total loan amount as provisioning for every quarter. The draft rules had said it should be 2.5%. Compared to that, again, it is lower. Then for commercial real estate, the new rules require 1.5% of the loan to be kept as provision. Again, the draft rules were 5%. Once the project becomes operational, see, under construction, you have to keep 1%. Once they become operational, the new rules say treat them as any loan and keep only 0.4% as provision. The draft rules had said even when they go into operation, you have to keep 2.5% as provision and then slowly bring it down over 5 years. So the point is the new rules which become applicable from October 1st are far simpler. What is more important, they apply only to prospective projects, not to projects which are already given. That was another thing which was pressuring bank stocks and the NBFC stocks. NBFC stocks which will also find relief because of this are PFC, REC, IREDA. But in the case of the NBFCs, just one point to note is they already provide more than banks because they have what you call ECL norms, expected credit loss norms. So for them, the change is really not much.
All right, Lata, thanks a lot for that. So that's the view coming in on all the NBFCs and project financiers. A lot of them higher in today's trading session. What we'll do with that is take a short break, come back on the other side. Our special offering, Clutter Breakers, where Ekta tells us about the growth story of single specialty hospitals. Very interesting. Stay tuned for that.
The Money Control Mutual Fund Summit is back in 2025 with its 4th edition, spotlighting the $1 trillion dream. A bold vision to reach $1 trillion in assets under management AUM by 2030. Join top policy makers, fund managers and market leaders as they deliver actionable insights and chart the future of investing in India. Money Control Mutual Fund Summit 2025, 23rd June, Mumbai. Register now by scanning the QR code.
Welcome back. Nearly 250 points higher for the Nifty, but we're talking about the hospital sector in our special offering, Clutter Breaker. There's been a surge in single specialty hospitals lately. Ekta's walked down to the wall to tell us about the growth of this single specialty hospitals. Ekta.
Well, single specialty hospitals are definitely gaining rapid ground in the private healthcare landscape. As of last year, single specialty hospitals made up around 30% of the Indian private healthcare market and is projected to grow around 40% by 2028 to 2.64 lakh crore. Growth is being driven by rising lifestyle diseases, greater urbanization, higher disposable income, and a boom in medical tourism. The interest is evident in the investor appetite as well. Now, over the past decade, 36% of all hospital investments have flowed into single specialty hospitals. Traditional specialties like IVF, oncology and eye care have drawn over 70% of the funding, while emerging areas such as dental and dermatology have attracted over 60% of their capital in just the last 2 to 3 years. IVF and oncology has seen the maximum private equity interest, raising $1 billion each since 2015, with the eye care segment attracting $80 million worth of investments just in the past 8 years. Now, with focused infrastructure, specialized equipment, as well as single specialty hospitals running more efficiently, they can possibly achieve EBITDA margins of around 20% at center levels and a return on capital employed of around 30% at mature centers and even 100% for some mature IVF centers. Amongst the leading segments, eye care is projected to reach around 55,000 crores by 2028, driven by aging populations, diabetes and rising screen time. IVF, supported by declining fertility rates, is expected to hit around 12,000 to 14,000 crores by 2028, with over 5 lakh cycles annually. Mother and child care is set to reach around 41,000 crores in maternity and rupees 1.7 lakh crore in pediatrics by 2028. High growth emerging areas include dental care, expected to grow to around 80,000 crores, with just 3,000 crores coming in from aligners. Urology is projected to see a 9% volume CAGR, dialysis at around 10% volume CAGR, and skin and hair care growing at around 17%. While the single specialty model is more efficient, scalable and focused, potential risks remain, such as pressure to deliver PE returns affecting quality, intensifying competition, and multi-speciality hospitals ramping up their focus on super specialities. Well, on that note, we'll take a short break, but to speak more on the surge in single specialty hospitals, we have with us Anshul Gupta of Avendus Capital in the next segment. Stay tuned. Welcome back. You're still tuned into a halftime report on CNBC-TV18. Let's continue our discussion on single specialty hospitals. We do have Anshul Gupta of Avendus Capital joining in to discuss what his perspective is on the single specialty hospital space. Anshul, hi. Thank you very much for joining in. And it's a very comprehensive report that we just spoke about in the earlier segment. But I just wanted to start by asking you about the private equity interest in single specialty hospitals. We've seen a huge interest in multi-specialty hospitals. If you had to compare the two in terms of relative growth and relative incremental investments, where would the two stand? Multi-speciality vis-a-vis single specialty.
Sure. And first of all, thank you, Ekta, for having me on the show. So to answer your question, if you look at the private equity investment in overall healthcare space in the last decade, it's been around $10 billion, of which single specialty has been roughly 1/3 cumulatively in the last 10 years. And a lot of that has increased in the last few years, where the single specialty business models are becoming more mature, becoming more scalable. And a lot of it also has to do with how the India macros are tracking. Secondly, I would also like to point out that when you look at the multi-specialty hospital space and go back 10 years in time, it was also at a stage where multi-specialty was still developing, and a lot of private equity money went into the multi-specialty sector. So just to give you one stat, about 10 years ago, the listed market cap of all the multi-specialty hospitals in India was around $3.5 billion 10 years ago. Today, that number is north of $50 billion. So a lot of that value creation and maturity of the business models that's happened in multi-specialty, we are just starting to see that happen in single specialty, and hence there is a lot more private equity interest in the sector.
Right. Anshul, I track the consumer space, and I often draw parallels between hospitality and hospitals by virtue of the business models that there are as against the end, services that they offer. And we started out with quick service restaurants, which were multi-cuisine, etc., to cash in on the trend of all the diners wanting to eat out. And thereafter, as the industry matured, everyone was looking at single, cuisines and specializations from a restaurant standpoint as well. Similarly, this is playing out in the hospitals business. What do you think is the growth headroom here? Because, on the one hand, share of stomach is very different from share of health. And secondly, as a nation, do you think we require a lot more general hospitals, multi-specialty hospitals than single specialty hospitals?
Yes, no, absolutely. Look, that's a great observation and comment. So very much, if you look at healthcare consumption, it's in many respects a branded consumer play, and particularly so in single specialty. So you could think of single specialty as a more retail-driven, convenience-driven model for most of the single specialties, if not all, of course, whereas multi-specialty is a more destination-driven model. By that, I mean a patient would travel to a particular multi-specialty hospital for a certain type of treatment or a certain type of doctor. But when it comes to services like be it eye care, dental care, or hair and skin clinics, there's a lot of preference for localization, for neighborhood and convenience. So to your question, do we need a lot more multi-specialty in general hospitals? If you really look at from a macro level, India is still significantly underpenetrated.
Exactly.
So there is still a lot of need. However, when you further break it down into the big cities, the metro cities versus rest of India, there is a stark difference, right? So when you see a lot of saturation and bed capacity availability, it will typically be in the top 7 cities of India and then maybe the next 20 cities. The moment you start going down further in the hinterlands, that quality care starts dwindling very fast, right? So on multi-specialty, there is still growth, but it's likely going to come more from tier 2 plus or from localization of multi-specialty itself. So if you pick a city like Bangalore, for example, it's very localized market, right? So people from Whitefield would not like to travel and go all the way to Electronic City for any treatment, no matter how reputable a doctor or hospital may be. So therefore, a lot of localization is happening within the multi-specialty hospitals.
Okay.
When it comes to single specialty, by definition, it's a much more localized and small format business model.
All right. Well, Anshul, I just wanted to narrow down on the competition fact of it, because now we have multi-speciality hospitals also which are focusing on single speciality, segments. Say, for example, oncology, or say Apollo, which has multiple segments which it focuses on, such as fertility, dental care, etc. Do you think that single speciality hospitals are currently under threat because multi-speciality hospitals now realize the potential, are getting on the bandwagon as well?
Sure. Ekta, I would put it, actually, I'll break it down into two parts. One is what you described as a supply side factor. So that's where multi-specialty hospitals are trying to increase their services or upgrade their services, particularly when it comes to the experience factor, right? Which is where a lot of single specialty setups score over multi-specialty hospitals. But at the same time, there are very strong demand side factors. By that, I mean the patient preferences, right? So if you take an example like birthing or child care, when a mother is looking for delivery, for her, it's a joyous experience. She need not, or the family need not prefer to go into a large multi-specialty hospital, but go to a maternity clinic, which has a better overall experience, right? Similarly, for eye care and a lot of other procedures, there's a lot of specialized equipment and technology that's very specific to that treatment, and that's not really useful for rest of the hospital or for multidisciplinary approach. So in hospitals as well, especially the large super specialty hospitals, their focus is driving more high RBOP or high revenue procedures, which are typically involving surgeries or overnight or longer term stays, whereas single specialty tends to be typically daycare or a few hours of procedure, and where patient experience become very important. So I would say it's actually the reverse. I think I, in fact, see a few more of what is under multi-speciality today, maybe perhaps coming into single specialty fold down the line. And example being, while oncology, the surgery part of oncology is very much the domain of multi-specialty hospitals.
Sure.
But things like chemotherapy, which requires a patient to just come to the center for a few hours, get the chemotherapy done and go home. So those kind of daycare procedures are better suited, and increasingly single specialties are taking bigger share of that from multi-specialty hospitals.
Okay, just a quick last question before we let you go, Anshul, and if you could just give us a brief answer. If amongst all of the specialities, which one would you put your money on in terms of the maximum growth potential that you could probably envisage, and maybe the highest amount of return for a private equity as well?
Yeah, sure. I mean, look, it's hard to single out one, but if I were to say, look at the macro factor, I would actually put eye care as one of the factors. And very quickly, stats, India is, from its macroeconomic development standpoint, maybe where China was 15 years ago from a GDP per capita standpoint. And we have seen in China a lot of these models scale up significantly, driven by aging population, higher affordability, and also more discretionary spends in procedures like getting the refractive corrections by LASIK surgeries and such. So it's not just about getting your cataracts removed, but also lifestyle choices, which is driving a lot of growth. So I would pick eye care as one of the very exciting growth sector, as well as IVF and some of the other areas like wellness, sports nutrition, sports wellness, sports medicine, and also dermatology.
Take that point, Anshul. Thank you so much for joining in. It's an interesting discussion, but a longer conversation that this warrants, and particularly interested about the prospects of sports wellness, sports nutrition as the overall rise for activity increases across the country, and a lot of that led by people who are above the age of 30, more prone to risks and injury risks, etc. as well. We'll talk about all of this on another day, but thank you so much for joining in. Take a short break, come back, get you more on the markets, perhaps get you some stuff on the commodities arena as well, as Manisha Gupta joins in. Welcome back. We have Manisha joining in with all things jewelry, I believe. She has with her Colin Shah of Kama Jewelry. Manisha.
Thank you so much for that. Well, yes, there's just so much to talk about when it comes to jewelry and gold, and of course the government notification that came in last evening as well. But Colin, as always, let me start by asking you about the gold prices, because even as everything around seems to be still uncertain and there are way too many headlines from the geopolitics side of the world, we haven't seen the gold prices run up too much. Is everything already baked in?
No, it isn't. I still firmly believe, and like I've been sharing on your program, that I see gold going up to $4,000, maybe by 26. In this journey, we'll be between 3,400, 500, slight dips at some time, selling. But long term, if you look at it, we'll continue to see this going up. So I don't see any worry over there as far as the gold is concerned. The worry is the geopolitical issue, which is causing, this whole, I think bull run to begin with. That because of de-dollarization, gold is definitely a safe haven. Every central bank in the world is buying. And the jewelry consumption has been affected globally in terms of volumes, because the price rise has been too difficult for the consumer to, I guess, absorb. But we do see that from these 3,300, 400 levels, gold going to 4,000 in the next 6 to 9 months.
Colin, you are one of the very few people that I know in India who actually dabbles with across precious metals. You do gold, you do platinum, you do diamonds, you do lab-growns as well. So I also want to talk about platinum with you, because this is where we've seen the latest major action come in. How much would you say is India's share when it comes to jewelry within platinum? What has been the kind of growth? Do you see that increasing?
See, platinum has grown. India traditional, from, the last, I guess, since independence or our ancient times, has always been a yellow gold market. And generally on our skin color type, yellow has looked, I would say, more the apt metal over the years. Now, what platinum has definitely made inroads in, and thanks to the efforts of the Platinum Guild, especially over the last decade, is they've been, I guess, greatly successful in creating these new categories. So Platinum Day of Love, and the couple rings, for example, though they were popular globally, in India as a concept didn't exist. And now, it's like a done thing that a couple exchanges platinum couple rings, and especially in South and even Northeast, West, it's picked up quite a bit. Besides that, men's, which was always, a category, half the population is men. But for some reason, this was not, I would say, served on the jewelry front properly. So platinum has ensured, especially with all the ad campaigns they've done with the cricketers and everything, that men's chains, bracelet, kadas, rings has now become like a mainstream category with every jeweler. So originally, I guess platinum maybe started as an insignificant amount of the total market, is slowly inching towards between 5 and 10% of the overall market in India, which is a significant, tonnage, I guess, if you look at it that way, even compared to any other global market, because of the simple reason that gold is so big in India. So even a small percentage of that is a significant volume in platinum.
Oh, absolutely. I get your point. India's half population is men, so obviously men jewelry should be doing quite well there as well. Colin, my next question is on the notification that came in from the government, clearly plugging those loopholes in sense of gold imports there, which has been coming in garb of platinum, iridium, palladium, even chemicals, even in sense of liquid gold there. Would you say the notification that is coming now yesterday does work on ground though?
See, it's a tough one. I'll be honest to tell you. The notification, I understand why the government did it. I guess it's to obviously curb, gold coming in liquid form. So gold, because of, I guess, the nature of what it is and the price that it carries today, and the arbitrage which you tend to make between international price, domestic price, people find new innovative ways of getting it into the country duty-free. And the government, in spite of best efforts that all of us have made, even from council, government, there's always one new way, and to plug in these loopholes, I guess the government had to do this. I hope there are clarifications because what this effectively does is it stops liquid in all forms, so especially rhodium plating, which is essential for manufacturing today. So we are hopeful that we'll make some representations over the next few weeks, and the clarifications that we need will come, and genuine business will not suffer for this notification. Right now, the way it is that if it is a non-FTA country, without a license, you can, bring the metal in. But that makes it a little challenging, I would say. So I understand why the notification came, but we'll need certain clarification so that business, especially season time, is not damaged. And while I was, just going through this, and if you give me a minute on platinum, I just wanted to say one more thing. Is like we spoke about gold and the price going up. Platinum today is at a 5-year high, like and it's grown 45% in price since January.
Yes.
So I guess it's appreciating too. So while we built these new categories, even from an investment point of view for the consumer in India, and they're always been so focused on appreciation.
And price
Platinum,
sensitivities.
yeah.
Yes. And even as it's gained up by 45% in this year, it still is trading at around $1,300 an ounce, half the price for where gold is. So clearly,
half of gold. So still a 2.5 time difference between platinum and gold, but appreciating new categories. So
So platinum it is. That's what
It
we'll
is.
keep an eye out on. But more importantly, Colin, you're selling jewelry to men. You're not wearing any on your face yourself. The next time,
he'll come out and show his hand and look at this.
all I have is just the wedding ring, which, by the way, is platinum. But I'll probably try and get a couple of studs, etc. No, I don't think so.
The other space that is actually where the money is moving is the watch segment, the high-end
Watch is the new jewelry.
where you know that you're actually wearing real diamonds in that watch. So you're not actually wearing lab diamonds. You shelled out the money. So that's a topic for a different day. But nonetheless, Mangalam, what about you?
Nothing. Just I wear the technological watch and I wear my wedding ring. No other jewelry on me. So I guess there is a lot of headroom. So since Manisha and all these guys, every time there is Dhanteras and all, they say that what are you buying for Sonal? Let me ask Sonal now, what is she buying for me? Since he's saying that men's jewelry is the next big market.
Half the population is men. So I think that's a huge market going forward.
So we'll watch out for that. But meanwhile, don't lose sight of the market. 25,000 on the Nifty once again. Nestle is the stock which is at the high point of trade. The board meets on June 26 to consider their first bonus. Remember, earlier in January, they went ahead and split the stock 1:10. So now there is another bonus coming the way of all the shareholders. Take a short break, come back, get you more on the markets and a lot of stock-specific action.
Welcome back. Well, time for an exclusive conversation now. Varun Berry, ex-Vice Chairman, MD and CEO of Britannia, tells CNBC-TV18 that they expect to be around a 25,000 crore revenue company in the next 3 to 4 years. Listen in to excerpts of that conversation as he talks about their product pipeline and their strategy versus the new age brand.
Let me tell you about my own sons. They are both in New York, right? And when we go there, we want to go to a Starbucks to have a coffee, and they don't want to. My son, older son, lives in a building where he has a Starbucks in his building, on the ground floor.
Yes.
And he told me that he's been there for 4 years, he's never been there even once. But they go to a whole lot of other coffee shops which are smaller, and they think that they are contributing towards a new brand which is trying to establish themselves. That's the thinking of the youth, right?
So let me, just circle this back, because I don't know whether you remember this or not. 10 years ago, we had this conversation, and you had given me the example of your son only, and you said that how you won back your son. Why? Because your son was having the parlay hide and seek. At that time, Good Day did not have a very exciting chocolate chips proposition. You got your teams to work, and then you had the Good Day choco chip biscuit that came out. And eventually you won your son over by offering a better product. Now, cut to this time when your son is shunning all these bigger brands, looking for exotic experiences, which may not necessarily come from bigger brands. What are you doing to win him over in the categories that you operate in?
No, so that's right. And the way to do that is exactly what we've done with Harry Potter, the Pure Magic Harry Potter. I think you've got to have very exciting products which stick to what the youth wants, and understanding what the youth wants is very important, right? As you talk about, last time we met, you said, these guys are offering clean labels and some of the large companies are not offering clean labels. So, making sure that you offer clean labels if the youth wants that. We've got a young managers council whereby there is a certain block of managers who are under 30 years of age, who are becoming like an advisory committee for us. One, they spot potential and they tell us what's happening in the world and what are the kind of products which are doing well with the youth and why. Thereafter, they even get involved with our launches. They evaluate our products. They tell us what is right, what is wrong. They evaluate our advertising. They tell us how we can sort of fine-tune it to get to the youth and to get them to buy into the product. So and that's working really well, because
what are some of the ideas that they've thrown up lately?
There are many ideas in the pipeline which we are working on. No, that
come on. I've come down all the way to Bangalore. You got to tell me a few things.
I'll tell you in private. I don't think we are 100% successful, but we are moving in that direction to make sure that we become a large company with the heart of a small company.
How much do you think revenue for Britannia would come from protein or some of the new categories that you are seeding over the last 1 year or so that your young team is talking about?
So currently small, but it's only the dairy space where we have cheese, which has got high protein, and we've got Greek yogurt, which is high protein. But as time goes by, this is going to become very important, especially with the GLP-1s coming into the market, right? I believe that in the US, 1 out of 6 consumers are on the GLP-1, right? And that leads to, making sure that you cater to their requirements, because obviously their system is modified, their likes become different. So I think this is going to become very important as we go forward. And I believe GLP-1s are going to come into India as well at 1/10 the price. So we will cater to that and make sure that we enlarge our portfolio on protein.
How would you evaluate yourself when it comes to the total foods company vision that you had, say, 10 years ago?
40%.
40% there.
Yeah.
What other categories are you seeding?
So we've seeded a lot of categories in the past. We've changed the portfolio of cake. We've brought in croissants. We've brought in milkshakes. We've brought in wafers. We've also seeded in some test markets in salty snacks. We've done some test markets with protein bars. So all of that, and some of them have gotten to a stage where they are at the next level of growth. Some of them are still at the test market stage, but we will continue to do that. And the trick now is not just to keep seeding these, but the trick is to grow at a much faster pace with the current categories beyond biscuits that you have, and that's what we are working on.
Perfect. We've always spoken at milestones. Once when Britannia hit the 1 lakh crore market cap, when it entered the Nifty, now it's nearly $2 billion in revenue. Next one happens when 20,000 crores of top line happens, hopefully very soon. 25,000 crores, when does that happen?
I would say next 3 to 4 years.
Perfect. So next 2 interviews are sorted, 20,000 and 25,000 crores. Thank you so much, Varun.
Thank you.
Always a pleasure speaking with you.
Good to see you.
All right, the company becomes a 25,000 crore revenue company in the next 3 to 4 years. That's the strategy laid out by Varun Berry. You can hear excerpts of all this conversation all day today on CNBC TV18. Take a short break, come back, focus on the markets. The Nifty comfortably over that 25,000 mark and now heading higher, led by HDFC Bank. So the Nifty Bank has been doing well, Reliance has been doing well, HDFC Bank now comes to the party at the high point of trade. And alongside that, we do have a bunch of other private sector banks which are picking pace as well. Don't lose sight of Bharti Airtel too. That's a stock which has moved to the high point of trade in just the last few minutes or so. With that, we're out of time on this edition of Halftime Report. You stay tuned to Business Lunch, which takes forward all the market action on CNBC TV18. Thank you for watching.
Stocks perk up after US President Donald Trump says that a decision on striking Iran will be taken in 2 weeks from now, raising hopes of a diplomatic resolution of the ongoing West Asia conflict. Realty, utilities and metals are the big gainers. The RBI provides a big relief to project financing banks and by NBFCs by slashing the required provisioning for such loans from the earlier proposed 5% to 1%. Stocks of these lenders have moved higher. Sun TV's future comes under a cloud after Dayanati Maran accuses promoter and brother Kalanithy Maran of fraud and money laundering, demanding restoration of the 22-year-old ownership structure. The company responds saying it is a private matter of the promoters and all legal obligations were met before it listed. HDB Financial Services sets a price band of 700 to 740 rupees a share for its 12,500 crore rupee IPO in a pleasant surprise for prospective investors who had anticipated a pricier offering. And the Shipping Secretary of Ports and Waterways, T.K. Ramchandran, tells CNBC-TV18 that despite the increase in costs, there is no supply disruption. He adds that plans are underway to expand India's shipping and port capacity multi-fold. It's a strong Friday. The bulls are looking to end the week on a high. You are watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Patakia, and the index is looking to hold on to the gains that it has been making since the start of the trading session. And the 230 points higher now on the Nifty, still holding on above that 25,000 mark. So good going for the index as well. It is the Nifty Bank too that's doing fairly well for itself, and that too has been the underperformer over the last couple of trading sessions as the Nifty Bank corrected from the record highs. But today, 550 points higher on the Nifty Bank, 1% worth of gain seen on the index there. And of course, the broader markets, those were the ones that were bleeding in yesterday's trading session. The Midcap index was down 1,000 points yesterday. It has covered up most of that ground, still 550 points higher on the Midcap index. And it is the project financiers, be it the likes of PFC, REC, IREDA, those are the ones that are leading the gains in the broader markets in today's trading session. And that is on the back of the Reserve Bank of India's project financing guidelines for these lenders and NBFCs. Lata is joining in with a breakdown of these.
The draft rules on project finance were very strict. Compared to that, the actual rules which were announced yesterday, that is Thursday, are relatively easier on banks. Basically, it refers to how much you must set aside as provisioning when you give a project finance loan. Because in the past 10 years, during the infrastructure loans boom period, a lot of them went bust. Now, the RBI's move was in the draft rules that more money be set aside in good times so that even if they go bad, you can adjust. But to come to the rules say that banks have to keep a provision of only 1% for a project finance loan. The draft rules had set 5%. At the moment, banks keep only 0.4. So it's more than now what it is now, but it is much less than what the draft rules threatened. In case the projects were delayed, they are called DCCO deferment. What is DCCO? It is date of commencement of commercial operations. If it is delayed, then you have to keep an additional 0.37% of the total loan amount as provisioning for every quarter. The draft rules had said it should be 2.5%. Compared to that, again, it is lower. Then for commercial real estate, the new rules require 1.5% of the loan to be kept as provision. Again, the draft rules were 5%. Once the project becomes operational, under construction, you have to keep 1%. Once they become operational, the new rules say treat them as any loan and keep only 0.4% as provision. The draft rules had said even when they go into operation, you have to keep 2.5% as provision and then slowly bring it down over 5 years. So the point is the new rules which become applicable from October 1st are far simpler. What is more important, they apply only to prospective projects, not to projects which are already given. That was another thing which was pressuring bank stocks and the NBFC stocks. NBFC stocks which will also find relief because of this are PFC, REC, IREDA. But in the case of the NBFCs, just one point to note is they already provide more than banks because they have what you call ECL norms, expected credit loss norms. So for them, the change is really not much.
Lata, thanks a lot for that. And it is these NBFCs that are leading the charge today in the broader markets, be it the likes of REC, PFC, or even IREDA for that matter. Earlier in the day, now Rob Subramanian of Nomura spoke to our colleagues on a whole host of measures, including the RBI's new project financing norms. Let's listen in.
I think it follows on the back of the jumbo rate cut by the RBI of 50 basis points recently that surprised the markets as well. So it looks pretty clear that the RBI is in broad monetary easing mode. And, specifically for this recent measure of easing the macro-prudential restrictions on lending for infrastructure. I think it's a very good thing. I think if you look at India's balance sheets, the corporate balance sheet is very healthy right now. Inflation is very low by Indian standards, 2.8%, and it's the time to ease policy. So a lot of people thought after that surprise 50 basis point cut, when most expected only 25, that, oh gosh, this is a big cut, the RBI is going to be done cutting rates, especially because they shifted their stance only to neutral. But our view is there's more to come. And the big reason is we feel that inflation in India is going to remain very benign. We think in the coming months it could be close to 2%. The latest reading was 2.8. And that's the bottom of the RBI's 2 to 6% target. So we have 2 more cuts this year, 25 basis point in September and December.
Rob Subaraman there speaking to CNBC-TV18. Putting the spotlight now on the auto sector, the total sales as shown, registrations have grown by 6%, led by the two-wheeler segment. Sudarshan has been on top of this. Now, will June see a mid to high single-digit growth in registrations, Sudarshan?
So in the month of June so far, the indication is that we are most probably likely to see the growth above 6%, because in the first 3 weeks of June, total vehicle registrations so far have increased by 6%. And after so many months, several months of underperformance in the month of June, we are seeing a healthy growth trend. And this healthy growth is being led by two-wheelers, which is seeing a growth of almost 8%, followed by 4% growth by both CVs and three-wheelers. One segment that is underperforming is the passenger vehicle, where registration is seeing a decline of 1% so far. Now, talking to the company-wise, in two-wheeler space, 2 companies that have been outperforming are TVS Motor and Eicher Motors. So far, Eicher Motor has seen a sales of almost 70% of what it has done in June of 2024, almost the same level it's for TVS Motor. As far as Bajaj Auto and Hero Motor are concerned, both have seen a total sales of 60% of what they have done in June of 2024. In the passenger vehicle space, M&M Auto continues to outperform Maruti, and in commercial vehicle space, Ashok Leyland is doing well, and as far as Tata Motors is concerned, it continues to underperform. So in the first 3 weeks of June, registration data is looking healthy, so we'll have to see how the last 1 week pans out.
Interesting insights, Sudarshan. Thanks a lot for that. And that partly explains also why the auto names were doing well yesterday at a time when almost all the sectoral indices were trading lower. Mahindra & Mahindra at the highest point of the day, as you can see at the bottom of your screens. Also pull up Dreamfolks Services. That stock took a bit of a beating in yesterday's trading session, and it had taken a beating earlier in the day as well until the management spoke to us today. And since then, you can see that recovery that the stock has seen, almost an 8% recovery from the lows of the day. Now, news reports had suggested that several banks and card networks are planning to shift away from the company amid service disruptions. Now, earlier we spoke to Librata Peter Kalat, who is the chairperson and managing director of the company, on this issue, and here's what she clarified on this stance.
I think all the clients are still with us. And the reason is because it's been a long-standing relationship. What we have with all the banks, they all understand that what is the value we bring to them. And second, most importantly, is that we are deeply integrated with all our clients, all our banking clients. So all our contracts are in place, and all the programs are ongoing. So there is no such thing going on right now. And this is business as usual, So it's a common thing in a business where, your contracts are under renewal. There will be RFPs coming in. The negotiations are on. So it's ongoing, and it's a business thing. So there is nothing change in the business structure.
We'll take a short break here on Business Lunch. It's now a 250-point gain on the Nifty. The Sensex 2 now extending gains, 850 points higher on that as well. Back with more on the other side. Stay tuned. Welcome back. Let's talk about the reported Sun TV family feud. It's a Money Control exclusive, and Money Control's Chandra Srikanth now joins in with more details on this. Chandra.
Sun TV shares are in focus after Money Control's report of a feud between the Maran brothers, Kalanidhi Maran, the chairman of Sun TV, and his younger brother Dayanidhi Maran, former union minister and currently a DMK leader. Now, Sun TV has clarified to exchanges that this is a family matter and will not impact the day-to-day functioning of the company. They've also said that some of these allegations in these media reports are inaccurate and misleading. Now, why is Sun TV in focus? Well, Dayanidhi Maran has sent Kalanidhi Maran a legal notice accusing him of indulging in fraudulent practices over the last couple of decades to wrest majority control of Sun TV. Remember, Kalanidhi Maran is a 75% owner of Sun TV network, one of India's most profitable listed media firms, and he's one of India's also richest entrepreneurs with a net worth of over $2 billion. Now, in his legal notice, Dayanidhi Maran has threatened to invoke action by various regulators, including the SFIO, to DGCA, to other agencies, if Kalanidhi Maran does not restore the original shareholding that was there in 2003, when the Maran and the Kalanidhi families had 50-50% in the present Sun TV. So we'll have to wait and see how this proceeds. But for now, Sun TV clarifying to exchanges after their shares were trading lower in the day that this is purely a personal matter, a family matter, and will not impact the operations of the firm.
Chandra, thanks a lot for that. Now, Air India has cancelled multiple domestic and international flights citing enhanced maintenance and operational reasons. The airline has announced full refund or complimentary refund to all the affected passengers. They've also indicated the possibilities of further disruptions on the back of enhanced checks on the aircraft, airspace restrictions and inclement weather. Now, the airline has urged travellers to stay updated on their flight statuses through its official channels. Meanwhile, Air India has also posted on social media platform X expressing sorrow over the loss of their cabin crew members of flight AI-171. They've also changed their logo from red to black in a sign of mourning. We'll take a short break here and we'll be back with more on the other side. Stay tuned. Welcome back. Now, the Israel-Iran conflict continues with central Israel left with damages to buildings after Iran fired drones and missiles. Prime Minister Netanyahu has said on Thursday that Israel was quote-unquote changing the face of the world in its operation against Iran. Meanwhile, White House Press Secretary Caroline Leavitt has said that Donald Trump will decide on whether the U.S. will get involved in the Israel-Iran war within 2 weeks.
Now, regarding the ongoing situation in Iran, I know there has been a lot of speculation amongst all of you in the media regarding the president's decision-making and whether or not the United States will be directly involved. In light of that news, I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks." That's a quote directly from the president for all of you today. So the president is always interested in a diplomatic solution to the problems and the global conflicts in this world. Again, he is a peacemaker in chief. He is the peace through strength president. And so if there's a chance for diplomacy, the president's always going to grab it. But he's not afraid to use strength as well, I will add.
Now, Harvard University's Kenneth Rogoff also spoke on the role of the U.S. in this ongoing Israel-Iran tensions and says that unsuccessful U.S. strikes could accelerate a nuclear threat.
I think the majority of people think that this is a bottomless pit if the U.S. gets into it, and that if the U.S. isn't prepared to occupy Iraq, God forbid, and even if it's successful in bringing down the regime, you're going to get something like happened in Syria or Libya afterwards. And if the U.S. strikes and it's unsuccessful, it doesn't get rid of the nuclear bomb, it will accelerate it. It's an absolutely critical moment in Trump's second presidency. This could be one of the couple biggest decisions that he has to make. There's no great answer. Iran is a big problem. There was really a strong case for Israel to do something from its perspective. But for the United States, this is a tough call, and it could lead to a lot of market volatility if the action really heats up.
Well, India's shipping sector is facing concerns with respect to growing tensions in West Asia with the threat of Iran shutting down the Strait of Hormuz, a key shipping lane responsible for 30% of the trade in the world, looming large. Now, India could face major supply disruptions in case that happens. Now, in an exclusive conversation, we spoke to T.K. Ramchandran, the Secretary of the Ministry of Ports, Shipping and Waterways, to understand where India's shipping sector stands amidst these uncertainties.
We've had several of these so-called shocks over the last few years, starting with COVID, and then we had the Ukraine crisis, and then we had the Red Sea. So over a period of time, not only has the sector learned to become more resilient, we have also learned to live with the additional costs that might come with having to reroute the ships via the Cape of Good Hope and so on. So I don't think we expect much of a problem because of all this, though there will be some disruptions, also some minor increases in prices, insurance premiums, and so on.
Moving on then, NASA has once again delayed the launch of its Axiom 4 mission to the space station. The launch, which was earlier delayed to the 22nd of June, has been put off further following the space agency needing additional time to evaluate operations at the International Space Station. The Axiom 4 mission has been described as a return to human spaceflight for India, Poland and Hungary, with Indian astronaut Subhanshu Shukla designated as mission pilot. The mission was originally scheduled for takeoff on the 29th of May, but has been delayed multiple times since then. And as we wrap up today's business lunch, we leave you with the visuals of the man's best friend giving company to NDRF personnel performing yoga in Jammu and Kashmir ahead of the International Yoga Day tomorrow. Thank you so much for tuning in. Midcap Radar on the other side.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. With me today is Ekta Batra and I am Vivek Iyer. Ekta, good afternoon. After the kind of sell-off we saw yesterday, clearly markets are cheering. It's the green screen across as we try to end the week on a very positive note. The mid-cap index is up over 1% and the small-cap index is catching up almost 0.9% higher even as we speak. So, remember today is an important day given the fact that there will be some flows that you will see, especially towards the later half of the session with the FTSE and the MSCI. But remember, HDB Financial's rupees 12,500 crore IPO has finally made its way to the D Street with the offer opening on June 24th and closing on June 27th. Our colleague Ritu spoke to G. Ramesh, Managing Director and Chief Executive Officer, HDB Financial Services. Let's listen in.
Company is about 17 years old. We've had a profitable track record for most of our journey. The first year that we were in business, which is the financial year 2008-09, we made a marginal loss, but we've been a profitable company ever since. We have a large franchise. We have presence in over 1,170 cities. We're a well-scaled company. For us, the IPO is really a milestone in our journey. Our whole focus as an organization has been on building value, right, both for our customers and for our stakeholders. The price is really a reflection of what our investors that we've been engaged with for the last few months and what our BRLMs have advised us.
Okay, but it would be fair to assume, given the regulatory uncertainty surrounding, what RBI's draft rules say about overlapping businesses between banks and their subsidiaries, is that the reason you had to take a bit of a cut over what you were expecting?
So look, the draft form of business circular, the draft came out in October, sometime in early October 2024. It's about 8 months now. I can't really speculate on what the final circular will say, so can't really address that question.
But that is the biggest question in the investor's mind. I mean, how are you going forward with this IPO with that big uncertainty still looming large? What is your understanding as far as how this could proceed if the draft were to be implemented in its current form?
So we started off as a subsidiary of HDB Bank. We have built over the years, and one of the interesting things is that though we have 19 million customers today, they've been originated by the company. We don't get any leads from anywhere. We don't get leads from our parent or any other companies. These are customers originated by the company itself. So we have an independent origination engine, an independent risk management engine. Our technology platform is independent. We have more than 1,700 branches across the country. These are independent branches. They're not part of a HDFC Bank branch. These are independent branches. And so we have an engine that's independent of our promoter. We have a lot of guidance from them, in terms of corporate governance, or whether it's risk management, or whether it is, how do we manage a business through cycles. But at operating level, we are an independent business, no deputation of staff from the bank to our company. So it's built and run as an independent company. So the company's characteristic is not going to change in any manner in the years to come.
Well, it is an independent company, and now that you're going to be public, you're going to be responsible to the shareholders. But the fact of the matter is, that HDFC Bank, if it has to bring down its shareholding, last year the bank was in talks with strategic investors. We do not know if those will fructify, if you're still in talks with them. But, what is the various sort of outcomes that you've planned for, the kind of surety that you can give to investors at this point in time?
So we are an independent business, set up and run independently. We have a board that is competent, management that's competent. So we've run that business. What the promoter will do in case a circular comes about is at this point of time speculative.
But the fact of the matter is your rating is very much linked to your parent. That impacts your cost of funds directly. If that were to change, how would life change for HDB?
So we have a portfolio of businesses. And for us, our philosophy has been how do we deliver value to the customers through their life cycle. We have a bunch of products that are built around aspirational India. So when we think of our customer, which is aspirational India, we're saying what is it that this customer needs through their life cycle, and how do we fulfill that requirement. So customers have requirements around their business, and customers have requirements on their personal requirements, consumption, or buying products for the home. So irrespective of what the customer needs, our philosophy is how do we build a suitable product or service that fulfills that requirement. And we'll continue doing that in the years to come.
Just a final question before we move on from this issue. Have you engaged in discussions with the regulator? Are you able to convince them that the businesses are separate? Because when you look at LAP, consumer finance, vehicle finances, these are overlapping businesses between the parent and you. How is the customer segment different? What sort of dialogue have you had with RBI about this?
So we work with Aspirational India. This is a customer segment that's fairly heterogeneous in the way they speak languages, the businesses they run, or what their aspirations in their life are. We have presence in over 1,100 cities. We have built the capability to deliver credit at scale to a very heterogeneous market, right? Finally, there are finite ways of delivering credit, and that's what we are focusing on. What is it that our customers need, and how can we deliver that requirement effectively? We don't do any arbitrage. We don't do any businesses that banks are prohibited from doing. I think we are quite comfortable with the fact that we are doing a business to a customer segment and delivering a product and service effectively in a very responsible and competent manner.
So that's the case you've made to RBI?
I can't tell you about, it's confidential conversation that we have.
All right, fair enough. You're also raising about 2,500 crores through the fresh issue, apart from the OFS component. You're very well capitalized at this point of time. Your total capital adequacy at 19.2%, Tier 1 capital at about 14.7 almost. What sort of boost will this give to business with the additional capital that you get, and how long do you think this will suffice for the NBFC?
So, since we are doing an IPO, we felt that it's also important to look at the next few years and make sure that we don't come into the capital markets a few months or years after doing an IPO. So we felt that this is the right time to raise capital. We expect it to last to about 3-4 years. Having said that, if the Indian economy has a huge flip up, I'm sure the investors will be kind to give us more money.
All right. Let's get into the financials then. We understand, of course, you can't make any forward-looking statements here, but FY25, your last reported numbers, it's not really been a very good year. Profits have come down. Credit cost has shot up sharply for the bank. ROA has fallen. Growth has been uneven. Would you be able to at least give investors the confidence that things will start to turn around from here on?
So, again, had a huge track record as a company of being a profitable growth company, right? So we will have events, macroeconomic events or microeconomic events that require us to adjust our portfolio and adjust our growth rates. That's something we are comfortable with as a company. We believe that we have to manage growth with profitability, right? We can't forsake one for the other, and that's what we've been doing. So some of these numbers will go up and down a little bit, but in terms of a growth path, we see a very clear opportunity ahead in terms of both the markets and our ability to service those markets.
But the large pain point has been stress, especially in the unsecured book. We've heard commentary from the Reserve Bank of India governor saying stress is starting to abate. Is that something you're seeing in your portfolio as well?
So the unsecured business is something we've been doing since about 15, 16 years. It's a business we understand well. Again, our business is not about creating a program and then spreading it across the country. Whenever we open a branch, we try and understand what is it that drives the local market in terms of the opportunity. How do we adjust our credit policy and our product delivery to the local requirement? So we are, so what we have the ability is to understand depth at scale. So there's a layer of technology on top which analyzes what's happening in the micro market. So not only are we getting signals from our own field in terms of our own origination and our own collections teams, but also what analytics is telling us about each market.
Okay.
So we fine-tune our portfolio, fine-tune our credit processes to make sure that we are covering our risks well, leading into opportunities, and that's how we refine our business all the time.
Okay, so that is HDB, and we will get you more details on the upcoming IPO. As of now, we need to take a short break. We'll get you more on the markets. A lot of stocks in focus on the other side. Stay tuned. Welcome back. You're still tuned into Midcap Radar on CNBC TV18. On to our segment Midcap Movers. We have with us Hormuz to take us through all the midcaps that are moving around at this time.
Well, all those who were seeing the broader market screen yesterday are feeling a sigh of relief after seeing the rebound that we have seen in today's trading session. And take a look at the gains as well. VEML 9% higher on that stock, and Vari and Premier too doing very well for themselves. Of course, Vari is a FTSE adjustment candidate as well today, so inflows likely to happen towards the closing of today's trading session. The easing of the project financing norms has been a boost for a lot of these financiers, be it IREDA, PFC, REC. They have done well for themselves. CLSA has also reiterated their high conviction outperform on both PFC and REC, expecting at least a 35% upside in both of these names. HUDCO too chipping in with a 3% advance. Some of the other names that have done well in today's session are the capital market names which have seen a rebound today, be it Nippon Life, be it CAMS, be it MCX, all of them seeing gains of 3 to 4%. Stocks that have done well on the back of volumes, and those also have seen gains of anywhere between 3 to 5%. Endurance Tech at one point was up 9%, and it has seen very, very heavy volumes in today's trading session. Keynes Tech, of course, on the QIP, and Hyundai Motors back above its IPO price of 1960. And lastly, some stocks that are bucking the trend in today's trading session. Some bit of red as well. Like Concord Biotech is at the lowest point of the day. Pratap Snacks is at the lows of the day. Northern Arc at one point was down 9% after that block deal, but it has recovered well. And Orient Cement has been an underperformer all through this week, another 4% down in today's trading session. Back to you guys.
Thank you so much, Hormuz, for joining us, giving us a sense of what exactly is moving as far as the broader end of the markets are concerned. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Well, welcome back to Midcap Radar. Well, it's an important day, especially for passive funds, given the fact that there will be adjustments made to the various indices. The two indices that we are looking at, the first one is the FTSE and the second one is the MSCI. Remember, FTSE today is a net inflow event as far as Indian equities are concerned, given the fact that there are almost 5 new additions to the FTSE All World Index and there are 3 additions to the All Cap Index. So which are the stocks that are impacted and which are the stocks, in fact, that are reacting? And remember, these flows typically happen towards the later half of the trading session. The last 1.5 hours is when typically you will see volumes rise for the stocks that we will be mentioning. So look at names like Hyundai Motors, that's an entrant, NTPC Green, Vishal Megamart, Wari Energies and Swiggy. All of these stocks enter the FTSE All World Index. Hyundai Motors, in fact, is seeing significant inflows of over $130 million. The stocks that are entering the All Cap Index are OneSource Specialty, Sai Life Sciences. Remember, there was a large block today, and Afcons Infra. These stocks enter the FTSE All Cap Index. The other stock that is in focus on the back of a deletion that it will see from the MSCI is actually Siemens Energy. So, Ekta, Siemens Energy, remember, it listed yesterday. It's the demerged entity from erstwhile Siemens, and it will be deleted from the MSCI Global Standard Index. Expect outflows of close to $150 million. So volumes will definitely spike in the last hour of the trading session as far as Siemens Energy is concerned.
Okay, all right. So that's an important set of stocks to watch out for. But Delivery is under pressure on the back of a bearish note by Jefferies. Manglam is here to tell us more.
Well, Jefferies has issued a bearish note on Delivery, where they've gone ahead and cut the target price, downgraded the stock to underperform as well. What they're basically believing is that, the risks that emanate from some of their key clients starting to insource their logistics at a time when e-commerce logistics players itself are likely to see lesser growth than what they've seen over the last 5 years, which was buoyed by post-COVID boom, is not particularly doing well for third-party logistics players, and particularly Delivery, which was earlier a market share, a market leader in the third-party logistics providers in when it came to e-commerce marketplaces. And the client that they're talking about right now is, Meesho. Remember, Delivery as a stock has outperformed the frontline index ever since it announced its, acquisition of Ecom Express. So there were positives that were expected from the consolidation of the industry, but at the same time, on the way down, this insourcing from some of the key clients is bearing down on the stock. As a result of which, they believe that their market share by FY28 could actually halve to about 34%. At a time when the e-commerce parcel volumes are likely to compound at 10% for the next 5 years, as against 30% as they did in the previous 5 years. They've cut their target price from 500 rupees to 315, and as a result of which the stock, mildly under pressure, though has recovered from lows. So it'll be very interesting to track where it goes from here.
Thank you so much, Manglam, for joining us and giving us a sense of what exactly Jefferies had to say as far as Delivery is concerned. Delivery, remember, opened quite lower quite sharply, but since then has recovered and now trading near the flat line. But it's a very good time to get your snippet from our latest episode of our digital offering, Market Cafe. This week, Surabhi Upadhyay sat down with Pankaj Tibrewal, founder and CIO, Ikagai Asset Manager, to unpack his investment thesis, including how he discovered Solar Industries and why, for him, the promoter behind the company matters the most.
One of the companies which is now known in the market is a company called Solar Industries, right? A very less known,
up and only up.
So a less known promoters in, say, for example, Nagpur. 2006 they came for IPO. If my memory serves me right,
2006.
2006.
Wow,
if my memory serves me correct, Surabhi, they raised about 80 plus crores, and after that they just did a small dilution in 2013-14 of 100 crores. And every 3 years, their top line used to convert into bottom line, right? And very strong promoters. But over a period, they kept on reinvesting the cash flows back in the business for growth.
Okay.
And whenever you used to meet them, you used to get a sense of passion, integrity, and skin in the game. They still hold the promoter family 75% or 74.5%. And today, the market cap is 1,50,000 crore.
And now
when we identify, it was 1,000 crore market cap.
1,000 crores to 1,50,000
crores. And last 10 years, they have been investing in defense, for example, without a single revenue coming in. So over a period of time, what you understand is that one, the promoter quality has to be extremely good. Because businesses kabhi linear line mein nahi chalte hain. There will be periods when couple of years business doesn't do anything. And we have seen that in many companies. There is a slowdown, there is some external environment problem, challenges, internal challenges. And there, when you have a conviction on the business and the promoters, then you ride that slowdown along with them.
So tell me, and solar, just for context, I mean, now we all know solar is so big in explosives, in defense warheads. In fact, in Operation Sindoor, I think many of those warheads were used on the various missile systems that were at play. And the stock has gone on to achieve wonders as well. So on that point of staying the course, even through the rough patches,
yes,
when a company is not showing growth,
yes,
when it's going through a painful period where operating cash flows are not rising, or you know, maybe there's a delay, or some of the usual fundamental parameters are not getting met, or margins are getting squeezed, how do you decide to stay on versus checking out, saying that red flag nahi, or
so one thing which you don't compromise is any governance issue and any red flags on balance sheet and cash flow. I think वो जहाँ मैं देखता हूँ मैं भाग जाता हूँ, whichever the narrative or the business story will be. I think if those are intact, even in a slowdown, I think what you have to check is that, is the promoter more in pain than you? See, you are 25% shareholder in the company. Promoter is 50, 60, 70% shareholder. He's pained more by the slowdown than you are. And I have seen that leaders of the sectors, they work harder during that slowdown and emerge stronger after the cycle from a bottom. So I think you have to get that sense during the interaction, during the conference call of the quarters, that what are they doing to come out of that slowdown and the disruption which they are facing today. And if you get the right answers, you stay on the course, irrespective of what is happening in the market. And I think there are many companies which have seen such cycles and they came out much stronger after the cycle.
So what made you take that bet on solar? Just to, you know,
I think
recap
I'm just giving you an example, but I believe that the fact that you know, year after years, they kept on reinventing themselves. They started with a supplier to Coal India. They moved to private sector. They moved internationally because they were cost efficient. Became world number 2, 3, 4 over a period of time. Then they thought that their strength is chemistry, explosive. Why not enter into defense? Privatization was happening for defense. The 8-9 years they kept on only pumping money, no outcome. But see, when the outcome comes, जब देता है भगवान तो चप्पड़ फाड़ के देता है. So I'm just saying that this is not a recommendation. I'm just showing that if you can
the
get
thought process, we just wanted to understand
that thought process and patience and staying on the course for a longer period of time gets rewarded.
Absolutely.
I mean, look at a promoter like Mr. Tapadia of Supreme Industries, 88 years old. The kind of passion he comes along with still today. And he's a leader in the PVC pipe sector today. And look at the way the company has grown over the last 20-25 years. Look at my own ex-employer, Mr. Uday Kotak. 2003-04 we got the banking license. The only private sector generation. And everything common is the leader. So get the leader right, get the balance sheet cash flows right, get and be patient with your temperament and your own thing. You will make money.
Okay, and you can watch more of that show on the timings above. But as of now, we need to wrap up on Midcap Radar. Your stocks once we're back.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, it's a good Friday that's shaping up for the day straight. We're seeing good gains coming in for the Nifty. If it's up 250 points as of now, approximately 25,000. What it's managing to hold on to. Sensex is up almost 800, more than 800 points as well. So that's holding on to gains of almost 1%. Outperformance or good performance also coming in from the broader end of the market. That's also managing to hold on to good gains. So Nifty mid-cap and small-cap both holding on to gains of approximately 1% and more than 1% is what we're seeing for the Nifty mid and small-cap. Banks, that's where we're seeing a good move coming in as well, up almost 1%. In terms of contributors for the Nifty 50 also, if you look at it, we have a lot of private banks that are managing to do well. So look at something like an ICICI Bank or something like an HDFC Bank. That's managing to be among the top contributors. And other than that, Reliance Heavyweight also is holding on to gains of almost 1.4%. So that is something that we're keeping an eye out on. Look at the list over there. And most of it are just banks coming in today. So that is where we're watching out for in terms of a good up move coming in. Nifty also led by mainly banks and Reliance and Bharti Airtel. But yes, that's how we're seeing the market setup looking like. But this is a show where we solve all your stock-related queries. And to do just that, we have our experts joining in with us. We have Sharad Awasthi of SMIFS, as well as Vaishali Parekh of Prabhudas Leeladhar joining in with us to answer all those queries. Vaishali as well as Sharad, good afternoon, and thank you so much as always for joining in with us. Vaishali, a quick check on the markets, right? Today, finally, some good mood coming in this muted week that we could say a range-bound week. 25,000 is what we've managed to cross as of now, at least. Do you think that's something that we're watching out for, and what are the next levels that you're keeping an eye out on?
Hi, very good afternoon to all of you. So yes, after a very long time, Nifty has moved beyond 24,950 and we are sustaining well above that. So important is that we should close also above that. And today, now that we are seeing overall, once again, a good participation coming in, I think I would still maintain that 24,700 should act as a support. And 25,150, which was the hurdle earlier, it continues to be the tough resistance from here on. Once we see a decisive move about 25,150, I think we are back on track for a bullish view going towards perhaps 25,400 and so on.
Okay, so 25,150, important to watch out for. If we cross past that level, could see further up moves coming in. That's a word coming in from Vaishali. On that note, let's get started with the stock-related queries. We have the first query that's coming in from Saili, who's writing to us from Hyderabad. Holding 10 shares of Geo Financial Services, prices 280 rupees per share. Wants to know whether she should continue to hold this or look to sell this. She wants both the views, short-term as well as long-term view. Right now, also, she's making, it's at 292, so just making a little bit of profit on this one. Sharad, good afternoon. And Geo Financial Services, what are you watching out for on the fundamental front? And should the viewer continue to hold this? They want to know on both fronts, whether it's short-term or long-term. What is your suggestion?
Yeah, good afternoon. So I think for Geo, in a nutshell, what we are looking at is we were initially working with a fair value of 350. It oscillated to those levels and then it has come down again, moved back. I think the big advantage that you have with Geo is that this is a company which would not typically work like a traditional NBFC where, the initial phase is a lot of legwork is required for you to move beyond a particular zone. Firstly, getting the funds on your balance sheet, then getting the advances on. I think everything is a challenge for a new NBFC. I think with a strong group backing, strong book value already in place, look at the way the BlackRock initiative has gone through. So I think this is an NBFC which would be off the blocks very fast. That is the big advantage you have. But still, the NBFC lending business or any kind of financing business is usually not as fast as a manufacturing leg where you just put up a capacity and then the things slow down. So I think it will take a bit of time. Initially, what we are working with is targets of around 350. But if you are looking at an NBFC that could grow very fast and very large over the next 4 to 5 years, I think you should continue to hold. But if you have a shorter term horizon, 1.5 year, I think you could still continue to hold with a target of around 350. But long term, certainly, I think you should continue to hold. If you can stretch your horizon to 4 to 5 years, this could be a very interesting story to watch.
Okay, interesting story to watch in the long term and short term also. The target that Sharad is talking about, 1.5 years, then 350. Vaishali, what are your targets that one should keep an eye out on, short term as well as long term, since our viewer wants to know both the perspective?
Sure. So for short term, I would say it is showing once again a good bullish candle today. And I would say for short term, keep a stop loss of 280 levels. And I think once it moves about 295 and sustains above that, we could see a trading target going towards 305. And for a long term perspective, I think the stock is already in a trend. Well, at the positional hold, it can retrace towards 260 levels. But as I said, that 303, 305 is the resistance level. Once we see this move above, I think one can expect a target of 350, 360. So view is quite positive. It is in a trend, but the levels are important to be noted.
Okay, keep an eye out on those levels over there for Jio Financial Services. Next query for today is coming in from Subramanian, who's writing to us from Bangalore. He's holding 49 shares of Suryodaya Small Finance, and this is at a price of 305 rupees per share, and also 100 shares of IOB, and this is at a price of 24 rupees per share. So for both these stocks, they want the long-term view, whether they should continue to hold or they should look to switch from this counter. Sharad, your view coming in, Suryodaya Small Finance and also IOB.
Yeah, so Suryodaya is basically the MSM microfinance space. They are lending a lot to joint liability groups. So I was expecting, that since you are lending a substantial amount to joint lending groups, maybe the NPA spike won't be as steep as it has been. But I think from 2022, they peaked on GNPAs around 5%. Again, they have gone up to 4.5%. So ideally, what we are expecting is that it seems like it's moving fast into that high credit cost cycle very fast every 2-3 years. So that's a bit of a challenge. But I think at 0.8 times price to book, most of the provision coverage already done. I think we are looking at a stage where most probably, the microfinance pain in the system has more or less peaked out. And from here on, we should see some improvement. NBFC-related relaxation from the central bank has already come in. The focus is largely on growth. So I think, yeah, it's a bit of a risky counter, but at 0.8 times price to book, I think most of the bad news is priced in. And as the recovery happens that we are expecting to see across microfinance and MSME, Suryodaya should substantially benefit from it. And, next year, you could be adding around 16, 17 rupees as earnings. And it gets around 1.5, 1.6 times price to book. Then I think you continue to hold for targets of around 300. But yeah, it's a bit risky because of the way the NPA cycle is moving in this particular bank. But I think since you're bought into it, stayed put for so long, I think the space is bottoming out. There is high probability you can continue to hold for around 300. For IOB, I think the fact that the whole NPA cycle has been very well adjusted. Net NPAs are roughly negligible at 0.37%. Most of the holding is with the government only. So most probably FY27, we might see some selling by the GOI. I believe that is what is showing up. I think it is probably something that is showing up in the valuation of IOB. So I think at 2.2 times, maybe, IOB doesn't really make sense. Even if a deal does happen, I don't think it will be at a much higher premium to the current multiple. So IOB, you can exit. Suryodaya, you can continue to hold for targets of around 300.
Okay. And Vaishali, your view coming in for IOB and Suryodaya, should they continue to hold, sell, switch to something else? And this is the long-term view that they want.
So let's talk about Suryodaya first of all. I think the recent rally, which we saw, the high that was made was 230 levels, and now it's bouncing back from the oversold. So since long term is the view, I would say the stock is still, we can call it as a bounce back rally. The range lies at 120 as support and 160 should be the near term hurdle. So once we see a decisive move above 130, that could give you a further target of 200 to 220. That is my view for now. Compared to IOB, though being oversold and looking attractive, in a banking sector, I'd rather go which is already showing a confirmed trend, something like an ICICI Bank or so. So if you're ready to shift, I think ICICI is a better option.
Okay, ICICI is a better option if you're ready to shift. That's the word coming in there for IOB specifically. And Suryodaya, we've seen Vaishali as well as Sharad give their views. Next query for today is coming in again from the financial side. Avinash is writing to us from Bangalore. He's holding 440 stocks of Yes Bank, I beg your pardon. This is at a price of 65.67 rupees. Wants to know whether to average further or should they exit the stock? Sharad, your view, averaging, does it make sense or should they just exit Yes Bank?
No, I think with finally the deal probably is going to happen. And I think when you have held through the pain, the thick and thin of everything that you have seen over the last, 5-7 years, I think it makes sense to stay put in Yes Bank now. In case most probably the deal will go through, there's a new promoter at helm. So probably, the base building process has completed at the bank. And from here on, you could expect a very sharp recovery. So we are looking at 1.3 times price to book right now. I think with a strong management in place and, strong guidances, a strong trajectory, because SBI was largely, just keeping it afloat. So I think that stage is past us. And from here on, there could be a probability that once the new management comes in with a majority stake, there could be substantial re-rating. So I think, stretch your horizon to around 3 to 4 years, because like any in banking, NBFC, it will take a bit of time. But I think you could see substantial improvement. Whether you get 65 or not, I think that's something that you will have to wait and see. But certainly, I think the price to book multiples could easily, double from here. So it starts trading at 2.5. That is the kind of upside you have. So I think doubling of prices is something I'm looking at, but extend your horizon 3 to 4 years. The new management comes in, growth rate starts picking up. I think you could be looking at 40, 45 on the stock.
Okay. And on the technicals, what should we keep an eye out on? Should they look to average Vaishali right now at these levels, or should they just exit the stock?
Well, if you have to, if this is your choice, then of course the average, but the confirmation in reversal would come only about 23. But I maintain my same view that a lot of ifs and buts, so I would rather go for frontline banks.
Okay. I just wanted to mark some of the flashes that were at the bottom of the screen a short while ago that came in from us. They're saying that they will temporarily pause calling the port of Haifa with Maersk-operated vessels. And at the moment, they're saying that we are not experiencing further disruptions to scheduled operations in the region. So this is the word coming in there. We're keeping an eye out on Adani ports on the back of that as well. You've seen them flash at the bottom of your screens just a short while ago. So that's the latest update coming in here. Maersk is saying to temporarily pause calling the port of Haifa with Maersk-operated vessels. That's the word there. But on that note, let's move on to the next query for today. We have Harsh, who's writing to us from Noida. He's holding 50 shares of Anant Raj. This is at a price of 568 rupees per share. Wants to know the short-term view on the stock. Anant Raj, short-term view, what is it, Sharad?
Unfortunately, this is something I don't track.
Okay. Okay. Short-term on the technicals, Vaishali?
Yes, so currently it is at a very crucial support level of 500. If the stock drops below 500, it's calling for further selling. But till then, I think if the support is respected, this can go towards 550, and from there on 630 would be the trading strategy. Above that, these levels, we can have a relook.
Okay. That's the word coming there for Anand Raj. Keep an eye out on those levels. But on that note, we're going to slip into a very short break. But here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store, Google Play Store, or you can just scan the QR code that will be coming up on your screens.
The Money Control Mutual Fund Summit is back in 2025 with its 4th edition, spotlighting the $1 trillion dream. A bold vision to reach $1 trillion in assets under management AUM by 2030. Join top policy makers, fund managers and market leaders as they deliver actionable insights and chart the future of investing in India. Money Control Mutual Fund Summit 2025, 23rd June, Mumbai. Register now by scanning the QR code.
Welcome back to Your Stocks on CNBC TV18. We're keeping it going with all the stock-related queries, and to solve that today, we have Sharad Avasthi as well as Vaishali Parekh, who are still with us. The next query for today is coming from Mohammad, who's writing to us from Noida. He's holding 500 shares of Persistent System. This is at a price of 5,200 rupees per share. So they're making a profit on this one. Wants to know, does it make sense holding the IT pack and holding Persistent Systems specifically, or should they book out their profits? Sharad, your view coming in for Persistent Systems, given that, obviously, there were recent notes that suggested also some bit of an improvement coming in terms of revenues from these IT companies as well. Is that what we're watching out for now? What is your outlook for Persistent specifically?
Yeah, across IT, I think, as you rightly pointed out, there should be some improvement because last quarter when the numbers came out, we were in total turmoil as to how this tariff situation would play out. So I think we are on much cooler waters right now. So most probably this time around when the quarterly numbers are out, they will have better understanding of how the international space will play out, particularly with respect to US and Europe. So I think that would be there would be some calmer nerves, so they would be more proactive in what they expect, regarding the future outlook. They will be more pronounced, and I think gradually as these problems, die down over the next 10-15 days, there is high probability that even the IT budgets, etc., in the US, etc., should substantially improve, and we should return to normalcy. That should see some improvement. Persistent, what are we expecting? We are expecting 18-19% kind of top line growth, 20-22% kind of bottom line growth. So it's already trading at 53-55 times 1 year forward. So I think it's a bit stretched at these valuations. I think it's better you switch to something like a Cyient. It has its own share of challenges, but at least you have some margin of safety in terms of the valuation at which it is available. Considering the growth rate this is going to clock. So I think within the space, it's better to switch from Persistent to something like a Cyient.
Okay, that's the word coming in there on the fundamental front. Switch to Cyient. So book out your profits from Persistent is what Sharad is saying. Vaishali, your view coming in for Persistent System. On the charts, is there an indication of a further up move that we could watch out for now? Or should they book out their profits?
No, I definitely think so that there is scope for further up move because, of course, it's a gradual up moving stock and it has, after making a low of 4,000, it's currently at 6,000. So in my opinion, the buyer should probably book partial profit and look for a further buy at around 5,800, 5,600 levels because when I'm looking at the data and I think the projection comes to around 6,800, which was a previous high, recent high, it's very likely it can retest these levels. So I would say yes, hold and book partial profit.
Okay. Hold and book partial profits. We also have some flashes coming in for HAL. They've won a bid to privately make small satellite launch rockets. This is just coming in right now. As of now, the stock is up almost 1.3% in the trading session right now. So we've seen that spike up coming in after this announcement has come. So surely keep an eye out on HAL. Let's move on to the next query for today. We have Chanchal who's writing to us from Mumbai. She wants to know the outlook for Federal Bank for short term. That's 4-month time period and Ambuja Cement 6-month time period. Sharad, your view coming in. Federal Bank as well as Ambuja Cements, both are short-term queries, less than a year time period that they want to look at entering the stock into.
So I think Federal is fully fairly valued at these prices. I can't see much upside within that time frame. Long term, obviously, the bank's done well. So I think obviously one of the banks which is always better on the credit cost cycle, the type of improvements they've brought in. But 1 year, I think maybe price to perfection. I don't see much improvement in Federal Bank on a 1 year time frame. And the second one you said was?
The second stock was Ambuja Cements.
Ambuja Cements. So I think again, 3-4 months, the way the monsoons are going, most probably you will not have much positive news from most cement companies. But beyond that, I think I'm very positive on that space. Within the group, Adani Group, I think I would be more happy to, bet on ACC if I wanted to bet. But maybe the next 3-4 months, you would not get much of limelight from this. But I certainly think the type of ground activity that you are expecting, post-monsoon, you could see some very smart recovery across cement stocks. Within the group, I think within Ambuja or ACC, if I had to choose one, I think with the type of improvements we expect, on the EBITDA per ton, ACC could be a much better candidate. The margin of safety is also obviously also much better because of the EBITDA per ton. So I think within the group, if you want to switch and you want to extend your horizon to a year, I think then maybe ACC is a good bet to switch to.
Okay. Your view, Vaishali, on both these stocks, Federal Bank, Ambuja, they are just looking for a very short term 4-month time period for Federal Bank is what they were looking at, and 6-month time period for Ambuja Cements.
Well, Federal Bank, I mean, it's quite sluggish. 4-month time period can, if all going well, it can go towards 220 to 25 at the most. And as far as Ambuja Cement is concerned, well, I think right now it's in a very strong consolidation phase, but it needs to move past 560, 570. Then you can see a further run up coming towards 620. So if time is not the restriction, look for a target of 620.
Okay. Keep an eye out on those levels, but depending on the timing, right, even for Ambuja, if time is not a restriction, then those levels do merit at 620 around for Ambuja Cements. Next query for today, we have Prabhu, who's writing to us from Chennai. He's holding 250 shares of HCC. This is at a price of 36 rupees per share. Short-term investor wants to know if he should continue to hold the stock. HCC, your view, Sharad?
HCC, I don't cover.
Okay, and Vaishali, your view?
So I'll say long-term view, when you see the stock has been beaten down right from 120 and now at 30 levels. Even if you see the shorter time period from 58, it has fallen to the lows and then now it's showing signs of bounce back. So I think it is showing signs of reversal. So in my opinion, he can average out since his cost is higher. Keep 28 as stop loss and let's see, this can go towards 38 to 40.
Okay, keeping an eye out on those levels over there. But with that, we are absolutely out of time on this edition of Your Stocks. So thank you so much, Sharad, as well as Vaishali, for joining in with us on the show and, as always, solving our viewers' queries. And viewers, thank you so much for sending us your queries. Remember, you can always send us your queries on that email address that is flashing at the top of your screens. But thank you so much for tuning in today. Hope you'll have a great weekend. But don't go anywhere. Last 1 hour of trade is still left. And to take you through that, your closing bell up next.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Nikkei is also seeing a fall. It's down 0.1%. Shanghai is managing to hold on to some bit of a muted gain.
So the levels, Nifty, lower bound support is 24,473.
Actual rules now, which came yesterday, say that you don't have to set aside 5%, you set aside 1%.
Thing on the Nifty, 24,814, almost unchanged.
We want this company to perform consistently.
At the moment, we are handling almost 60% of our cargo through the private operators.
Markets are happy it's Friday as well. So yes, good move coming in for the mid and small cap, like Hormaz is mentioning as well.
So yes, there are negotiations on the commercials on the annual basis. It's an ongoing process.
But for now, Sun TV clarifying to exchanges after their shares were trading lower in the day.
Remember, today is an important day given the fact that there will be some flows that you will see, especially towards the later half of the session.
Good afternoon, hello and welcome to Closing Bell. We are down to the last 1 hour of today and of course of the week as well, and it's not bad. Friday started with a fair amount of caution, but I think the bulls are having their say. They're saying, thank God it's Friday. Hi, Nigel.
Well, that's right. And the encouraging part, Surbhi, is that there's a broader participation, right? You have the Nifty Bank, both are doing well. And the Midcap index is keeping pace with it as well. But if you still look at it, in the last few days, we're still in that band, 25,200 on the upside. But the bulls, they'll say we're getting into weekend and we are in party mode.
No, absolutely. And actually, I'll tell you why today's day is a fairly good one. The reason being that this band that Nigel spoke of, let's pull up the Nifty. The Nifty for the better part of this week has been absolutely flat. I mean, flat was the best case scenario, but today it's doing a lot better than that. It's now creeping back to the top side of the range. Before the market cooled off, the highest levels that we had hit were close to 25,200. Now, we're not quite there yet, but at least with today's move, the index is back above the 25,000 mark. Let's see if you get a close above that zone or not. And the second aspect is the mid-cap recovery. You've got a very solid advance decline ratio today. You've got over 1,800 stocks on the advancing side. Declining stocks are just 800. There's buying in mid-caps. Let's pull up the small cap index as well, small cap and micro cap, because this is the part of the market that was battered and bruised quite a lot this week. But Friday seems to be reversing quite a bit of that. We don't know. There's no further new international input as such. Global markets are still cautious. US futures are trading down about 0.25% right now. No further updates out of Iran. We don't know what the weekend brings. So for what it's worth, Nigel, I think people perhaps have thought that we've had a fair amount of mid-cap correction. Today, the spirits seem to be on the buying side.
In the last two trading sessions, Surbhi, what we were hearing is maybe tonight the United States enters into this battle. But I think the soundbites that came out of yesterday said that they're going to be in wait-and-watch mode for a week or 2 weeks.
2 more weeks, he'll decide.
Yeah, that's what. And, the street at least says that it's pushed back a little bit. Yeah. So the hope is that there is not going to be any attack. Rather, there's going to be some kind of dialogue over the weekend.
A deal.
And hopefully we get some kind of a deal. And we know Mr. Trump loves deals. Yeah. Sometimes when he's part or not part of it, he still says that there's a deal in the works. So I think pushing back of that, attack deadline, I think the street is taking that a little bit positively. And though volumes, they're still struggling. They're still on the lower side if you compare it with the averages that we saw, say, 10 days ago or thereabouts. But how do you position yourself in the final hour of trade? Ashish Kayal joins us with some closing strategies. Hi, Ashish. Always a pleasure having you on the show. What's your view on the Nifty? Where are we headed from here? Is this the big breakout, or do you think we're still going to run into resistance at 25,200?
Hi, Nigel. Afternoon to you and all the viewers. If you look at Nifty, I would say Nifty has been climbing the wall of worry. If you look at from the lows when the Trump tariff happened, the India-Pak war happened, Iran-Israel happened, and still Nifty is at the levels of about 25,000. So this is climbing the wall of worry. I'm optimistic. I think if you get a dip from here around 24,950, 24,980 by the market, we can expect moves towards 25,300, 25,500 on the upside. Events can result into volatility, but the trend will continue, is what it's looking like. And we are already sustaining about that 25,000 mark. So the call sellers are going to possibly start covering some of their position by the closing time. So the undertone remains positive, and we can clearly see stock-specific action continuing here. Bank Nifty is also up by more than 500 points. So I think Bank Nifty can take a lead from here and might head towards 57,000. So overall, I'm optimistic on the markets.
Okay, all right, Ashish, good to know that. Let's talk about some individual stocks and maybe, throw in a specific word on some of the large cap names, because it's a good large cap day today. Reliance itself, 1.5% higher. Jio Finance is leading from the front. There's Mahindra and Mahindra. So just tell us in general, what are your trading picks for the last hour? And within the large cap universe, would you look at something, perhaps positional, something going into next week as well?
Absolutely, because the stock that you talked about, Reliance and Mahindra, both of these have been a very strong, reason why the markets are also sustaining. Reliance is one of such reasons. We can see Reliance has been consolidating since around 12th of May. It has been more than a month that Reliance has been moving in a range, and so is Nifty. So Reliance looks like breaking out on the upside. I'm expecting it to reach towards the level of 1,530 on the upside. And if that happens, the index will also move higher. On the downside, the support for Reliance is going to be today's low, which should remain intact, is around 1430 levels. And the next pick is going to be Mahindra and Mahindra. We can clearly see this auto major has given a strong breakout. I've been talking about this stock since a week now, and it has already given a strong breakout above the previous pivot highs, which it made over the month of May as well. And I think it is going to head towards 52-week high above 3,300 levels. So overall, Mahindra looks good from the auto space. 3,400 is the target for the stock. On the downside, 3,100 is a very important support. And this is on the basis of a sector rotation that we are seeing as per Stowell's pyramid. It was the financials when the interest rate started coming down. They outperformed. We saw Bank Nifty outperform. Now auto is catching up. And later, I think as per the sector rotation, it will be IT. So I think auto has a lot of room to catch up on the upside.
Okay. All right. Got that, Ashish. Thank you very much for all the trading ideas there. We will come back to you in a bit. Let's now focus on banks and NBFCs, because that's been the big story over the last 24 hours, with the RBI coming through with the final norms on project financing. And like we've been telling you since morning, the final norms are not as difficult for lenders for stocks like PFC, REC, HUDCO, as what was earlier feared, because the RBI's earlier draft was far more stringent, but the final norms don't look as bad for these lenders. We have Lata joining in to explain the details to us. Lata.
The draft rules on project finance were very strict. Compared to that, the actual rules which were announced yesterday, that is Thursday, are relatively easier on banks. Basically, it refers to how much you must set aside as provisioning when you give a project finance loan. Because in the past 10 years, during the infrastructure loans boom period, a lot of them went bust. Now, the RBI's move was in the draft rules that more money be set aside in good times, so that even if they go bad, you can adjust. But to come to the rules say that banks have to keep a provision of only 1%, what it is now, but it is much less than what the draft rules threatened. In case the projects were delayed, they are called DCCO deferment. What is DCCO? It is date of commencement of commercial operations. If it is delayed, then you have to keep an additional 0.37% of the total loan amount as provisioning for every quarter. The draft rules had said it should be 2.5%. Compared to that, again, it is lower. Then for commercial real estate, the new rules require 1.5% of the loan to be kept as provision. Again, the draft rules were 5%. Once the project becomes operational, under construction, you have to keep 1%. Once they become operational, the new rules say treat them as any loan and keep only 0.4% as provision. The draft rules had said even when they go into operation, you have to keep 2.5% as provision and then slowly bring it down over 5 years. So the point is the new rules which become applicable from October 1st are far simpler. What is more important, they apply only to prospective projects, not to projects which are already given. That was another thing which was pressuring bank stocks and the NBFC stocks. NBFC stocks which will also find relief because of this are PFC, REC, IREDA. But in the case of the NBFCs, just one point to note is they already provide more than banks because they have what you call ECL norms, expected credit loss norms. So for them, the change is really not much.
Okay, all right, Lata, thanks very much for that comprehensive explanation. Well, earlier in the day, Rob Subramaniam of Nomura spoke to our colleagues on a whole host of those measures, including the RBI's new norms. Take a look at his view.
I think it follows on the back of the jumbo rate cut by the RBI of 50 basis points recently that surprised the markets as well. So it looks pretty clear that the RBI is in broad monetary easing mode. And, you know, specifically for this recent measure of easing the macro-prudential restrictions on lending for infrastructure, I think it's a very good thing. I think if you look at India's balance sheets, the corporate balance sheet is very healthy right now. Inflation is very low by Indian standards, 2.8%. And it's the time to ease policy. So a lot of people thought after that surprise 50 basis point cut, when most expected only 25, that, oh gosh, this is a big cut, the RBI is going to be done cutting rates, especially because they shifted their stance only to neutral. But our view is there's more to come. And the big reason is we feel that inflation in India is going to remain very benign. We think in the coming months it could be close to 2%. The latest reading was 2.8. And that's the bottom of the RBI's 2 to 6% target. So we have 2 more cuts this year, 25 basis point in September and December.
All right, so that's a global view coming in on Indian financials. Gurmeet Chadha of Complete Circle Investments is with us now. Gurmeet, great to have you on. Happy Friday to you. Market finally seems to be feeling Friday because we were quiet for the most part. Midcaps were correcting, but today the flare is back. Let's start with your sort of just a quick overview on how you see things. If someone is waiting to invest, I mean, I know typically you shouldn't time, but that's exactly what investors do. Given the uncertainty around Israel-Iran, do you think the worst of it is past and you should just stick with your investments, or are you bracing for more volatility in the near future?
Thanks, Urvi. So I think if you see markets in terms of gold prices, oil prices, bond yield, I think markets are probably discounting a shorter conflict. Now, they can be right or wrong, but as far as the positioning goes and the price action goes, the market are probably expecting a early resolution to the conflict. Now, if this hypothesis gets challenged and it continues and there is more escalation, the probability is low. You will see some heightened volatility. That's point number one. Point number two, I think for an Indian investor, I think you have to think a little beyond a couple of months. So what can happen over the next 3 to 6 months will be is you can have a trade deal with US, which is one big uncertainty which markets are bracing, especially sectors like IT, exports. They've been very subdued. So I think that could see a bit of a up move there. I think banks will see faster transmission of rates. RBI again has today eased out, the project finance provisioning. So the regulator is very clear, very pro-growth. Inflation is pretty benign, likely to be benign. Crop has been good. So I think that what RBI has done few days back, I think we'll talk about this as we progress and once this volatility is behind us. It's affronted what it wanted to do over the next 3 to 6 months. So that the transmission will happen. Imagine the consumption trigger when you have home loan rates at 7%, car loan rates at 7%, PL at 9-10% on quality lenders. I think that will materially change the consumption basket also. And third is the fact that we have very little, concern with all these conflicts. Every conflict in the past has been a buy on a dip opportunity. Let's say in case there is escalation. I'm sorry if I'm being a little insensitive. I think it is a buy on dips market and it will remain a buy on dip.
Okay, all right. Hi, Gurmeet. Good to see you in this afternoon. How's the weather in Delhi? Oh, yeah, it's raining. I believe it's a little humid out there.
Much relief, Nigel. It was quite hot. Last couple of days have been better. Not so good news for AC makers, but yeah, weather is better.
All right, great. Gurmeet, I'm just looking at a clutch of stocks. You know, if I look at Bharti Airtel, rock solid. Reliance Industries is doing quite well as well. And the street, I think there's some optimism that maybe, in fact, you know, you can get some kind of a price increase, a tariff increase that could come about. Maybe, maybe not. What's your view and what's the preference from the telecom makers?
So, you know, Bharti has been one of our top picks for a while now. It's been a few years. And I think if you see the revenue mix now, the mobility business, which is India and Africa, that makes up almost 80%. And then you have Airtel Business, which is the enterprise solutions they offer to SMEs, corporates. Then you have Home, which is your home services. And then you have digital services. And payment bank is actually very small. So ARPU is at about 245. I think it's a matter of time it gets to about closer to 300. It's inching up, but it's inching up not at the pace probably the street would have liked. And that's why you see some consolidation before the move happens. More importantly, Nigel, if you see the free cash flow generation of Bharti, you know, last year was almost 40,000 crores. The capex has come down by 20%. Now in an environment where you have technically 2.5 players, you have less intensity on capex, more free cash flows, higher tariff, the stocks will probably get more re-rated. So at about 8 times, 9 times EV by EBITDA, you could possibly see, you know, maybe going up to 10, 11, because this is one sector where there is not much surprises in earnings. Even during COVID, telecom was one sector where there was not much cyclicality there. And in a market like this, where you are reasonably assured of earnings and free cash flows, less capex, I think it makes it ideal. So I see more legs in Bharti and we are invested in it for the long haul.
Okay. There's such a flurry in the mid-cap market. Gurmeet, just hang on 1 second. I'll quickly spot some stocks and then we'll go back and talk about this. Premier Energies and Waaree, both of them, between 5 to 9% higher. I mean, it's a totally different market. Yesterday, you had mid-cap sulking. The index was down 2%. Small caps were down. Everything was down. Today, the entire sentiment is different. Look at Mishra Dhatu, 8%, 7% actually. Something like Technocraft is up 8.5%. Go Digit 6%. BEML, which is obviously seen as a big sort of quasi-defense infrastructure sort of a play, it's up about 8.5% as well. Big move. Nava as well, actually, since I spotted Go Digit, even Nava from the insurance pack, up 5-6%. Really, really strong day. Strong afternoon, at least, for a lot of these mid-caps. Gurmeet, I don't know if you've heard anything new on Waaree or Premier, or I don't know, maybe it's just overall mid-cap enthusiasm. Any of the names that I was spotting right now, any interest?
So we are right up there in the value chain, but we prefer stocks which are slightly out of favor and give you valuation comfort. So we have a Tata Power, hasn't done much, but you know, trades at about 25 times forward. You should see some restructuring at some point of time between the renewable business and non-renewable, as well as the distribution. And so it's a completely integrated company in generation distribution. And then they are in solar panels and EV charging as well. And stock hasn't done much. So there's reason. I think Power Grid, I think, to me, surprises me with very subdued, 14-15 times earning, great dividend yield. And transmission capex could be 6-7 lakh crores over the next 3-4 years, has more than 60% market share. And government holdings around 51%, so not much supply pressure either. And then we have some, you know, cable and wires names, transformer names. We have CG Power also, not purely power, but power plus semiconductor play. So we have up the value chain. We are more focused on power equipment and transmission right now than on generation. And I think energy, along with manufacturing, I think is a very secular theme. So you've got to be a little patient. I think the risk reward is extremely favorable.
All right, great, Gurmeet. Stay with us. You know, there are some Sensex adjustments, rebalancing, as well as FTSE All-World Index adjustments that will take place today. Vivek joins us to help us refresh all of those details. Vivek.
Well, that's right. So Sensex will wear a new look come Monday. FTSE, you know, will see some adjustments, as well as one stock that will get deleted from the MSCI. So come Monday, you know, Sensex will have 2 new entrants, which is Trent as well as Bharat Electronics, and they come in at the expense of Nestle as well as IndusInd Bank. Trent as well as Bharat Electronics during the course of the day today would have received a little over $300 million each of inflows. This on account of the adjustment that is taking place, and also Nestle as well as IndusInd Bank are seeing outflows. Nestle of over $220 million and IndusInd Bank of over $130 million. As far as FTSE is concerned, remember in this particular rejig, it is mainly the newer entrants, the newer IPOs that are making the way into the FTSE All-World and All-Cap Index. Within the All-World Index, Hyundai Motors, NTPC Green, Vishal Megawatt, Waaree Energy as well as Swiggy are making their way into the FTSE All World Index, while OneSource Specialty, Sai Life Sciences and Afcon Zinc are making their way into the FTSE All Cap Index. No deletion, so it's a net inflow event as far as FTSE is concerned this time around. And lastly, keep an eye out for Siemens Energy, especially in the last hour as we speak. Volumes could be quite high. This on account of the fact that the demerged entity that got listed yesterday will get deleted from the MSCI Global Standard Index. IIFL Capital estimates outflows of around $150 million over here.
Okay. All right. Got that, Vivek. Thanks very much for that list. Those are the stocks that are on the move. Gurmeet, just before you came in, we were discussing the new RBI norms, project financing. You know, the good news from the Reserve Bank keeps coming. And as you said, it will really start showing up when you have cheap home loans, car loans, etc. So how would you play this new reality of cheaper money in India, ample liquidity? What kind of lenders, or should it be through other facets like, I don't know, consumer durable stocks or real estate plays? How to play the new reality with respect to monetary policy?
Yeah, so I think I would still prefer banks over NBFCs. Reason being, banks, the earning growth is catching up, not with as much as the price action. And if you see, for example, post RBI policy, hardly any price action in the likes of, let's say, an ICICI, HDFC, SBI, etc. Also, they're sitting on good treasury gains with the way 10-year is now 6.30. I think in 6 months, 12 months, you will see 10-year at sub 6. So I think both net interest income, treasury income and fee income, banks will see all cylinders firing. And I think consumption will pick up. One NBFC space we like is gold-based lending now, because that's where probably the rise in gold prices, the delinquencies come down. And I think that could be a proxy play to consumption also. So something like a Muthoot maybe. So I think that's the right way to play it. And I think urban consumption is making a bit of a comeback. So you can see that little bit visible in likes of hotel stocks, Trent. You know, it's a bit of a comeback by, quick commerce players like Eternal or Swiggy, etc. So I think the consumption basket is completely right now under-owned, hasn't done well. Look at the Tata Consumer, look at most stocks in this space. I think that can make a bit of a comeback, and obviously two-wheelers. So two-wheelers and four-wheelers. So I think the subdued part of consumption, more discretionary, less maybe non-discretionary, can make a bit of a comeback.
Speaking of financials, Gurmeet, just taking a chance here in case you had a look at HDB Financial. I mean, I'm not asking for a specific subscribe or not subscribe, but just, any general sense of the business and valuations now that we know the price band.
No, I'm happy.
One more thing, Gurmeet, one more thing. This unlisted market, some of these frontline names as well, some of that bidding is getting a little bit excessive out there. For example, I think maybe the people who have bought in the unlisted market, even this one, bought it at a higher price. And the likelihood now is that, they'll be burning their fingers. Similar is the case with a couple of other names as well. So if you could, answer the question, Surbi, and also give out a message about how you're approaching this. Because, the last thing you want is retail audience to get hurt.
Yeah. 200%, Nigel, and I think we had that discussion. I think HDB, I'm happy HDB, they have priced it well. I know, because what we've seen in the past that, NBFCs are priced at 4 or 5 times book, and everybody starts drawing parallels with Bajaj Finance. We saw that parallels being drawn with a lot of other NBFCs also, which were fetching, and we saw what happened a couple of years back. So I still believe that this competitive pricing, it may still list it a little better, but this is a lesson for all retail investors. There's absolute FOMO in unlisted space, because there's no price. The price is decided by few brokers, large brokers, and in terms of demand, supply, availability, and a lot of times the volume is thin. Even in some of the capital marketplace, you have suddenly started giving 60, 70, 80 multiples. And mind you, these are very cyclical businesses. While long-term story is great, I think whether it is NSE or depository or everyone, I think the long-term story is great. But you can have, let's say, 2 soft quarters, the earnings can drop 20, 30%. We saw that with CDSL last quarter. So it is not same as banks, right? And you have to be mindful of paying valuations. Right now, I think the retail especially needs to do a lot of homework in terms of, doing this unlisted space. I think there's a lot of FOMO, especially with respect to capital marketplace.
And an HDB? Any specific take?
Sorry?
On HDB Financial, any specific take, advice, general sense on the business?
I think it's a good business. So we're happy that, as I said, it's been at around 700-800, even in unlisted market for last couple of years. only last 3 months, because the broader movement happened in most unlisted stock exchanges. So they had some issues during COVID on NPAs. I think they've worked back. They've slowed down on a lot of lending they were doing, especially the high risk lending. I think the book is looking much better, and the parentage is HDFC. So eventually on asset quality, you will not see many shocks. So this is one which will be a very steady compounder in my view, and at this price band, it looks good to me, to be honest.
Okay, all right. Thanks very much, Gurmeet. Great conversation as always. We'll leave you to kickstart what should be hopefully a great weekend for you. And we look forward to the next conversation soon. Have to take a break right now. But actually, we'll leave you with a slice of the conversation that our colleague Ritu had with G. Ramesh, Managing Director and Chief Executive Officer of HDB Financial Services. Of course, she quizzed him on their business plans, need for capital, and growth prospects going forward. Take a look. We'll take that break and come right back.
So we have an independent origination engine, an independent risk management engine. Our technology platform is independent. We have more than 1,700 branches across the country. These are independent branches. They're not part of a HDFC Bank branch. These are independent branches. And so we have an engine that's independent of our promoter. We have a lot of guidance from them, in terms of corporate governance, or whether it's risk management, or whether it is, how do we manage a business through cycles. But at operating level, we are an independent business. Since we are doing an IPO, we felt that it's also important to look at the next few years and make sure that we don't come into the capital markets a few months or years after doing an IPO. So we felt that this is the right time to raise capital. We expect it to last to about 3-4 years. Having said that, if the Indian economy has a huge flip up, I'm sure the investors will be kind to give us more money. Had a huge track record as a company of being a profitable growth company, right? So we will have events, macroeconomic events or microeconomic events that require us to adjust our portfolio and adjust our growth rates. That's something we are comfortable with as a company. We believe that we have to manage growth with profitability.
Welcome back. Well, the markets continue to hold with gains of close to around 250 points. Trent is the one that's bucking the trend now. It was quiet for majority of the trading session. That's moved to the high point of the day. Bajaj Finance, those bonus shares, they got credited. Some of that got sold in the last two sessions. Today, it's finding its feet. So that as well is good news on that particular front. From the broader markets, we have, those markets that are keeping in step out there. A stock we don't talk about too often. Ratan India Enterprises up close to around 8%. Ratan India as well up close to around 10%. So just spotting it because of the kind of volumes. But otherwise, big move is what we're seeing on a couple of these names. Well, Jitendra Goel, Kotak Alternate Managers, joins us on the show. Hi, Jitendra. Good to see you in. What's your view? How are you feeling about the markets? You're getting a bullish case that's playing out, which suggests that maybe, in fact, you could even get a double-digit return on the Nifty from here. While, you have another part of the market that says, well, there's too much of bad news that's coming in there on the geopolitical front, on what Trump has to say, and also valuations are not supportive. What is your comment?
Hey, hi, Nigel. A couple of things. See, we are in midst of this geopolitical crisis. But on the other hand, if I see the policymakers, they are loosening their policies, right? So right from your monetary to fiscal side, all the developed markets, despite their inflation is much higher than 2% targets, we have seen that the monetary policy generally is on the easing side. Also on the fiscal side, we are seeing right from Germany to US, everywhere in the developed markets, fiscal easing is on card. So net, one side, we are concerned about geopolitical stress, but on the other side, the policymakers and central banks are loosening their policies. And this is actually leading to some kind of support for the global markets. On the other hand, if I look at India, that's the other way story, right? So last 1 year, if I see, India has been consolidating. MSCI India hasn't delivered to the extent what other markets have delivered. And we have underperformed because last few years, we have been showing a very, very resilient and a very strong performance. So after this consolidation, we feel that the earnings season is going to look a little better than what we saw in last year. So we expect that earning acceleration is on card. And if I look at the macro perspective, also the GDP numbers for India, probably we might see some kind of surprise in coming quarters. The kind of stimulus the RBI has given with repo rate cuts and interest rate cuts. So net, our inflation is undershooting while our growth is outpacing the expectations. And hence, we think we are in a sweet spot. We think market is in a buy on dip as a lot of support coming from fiscal as well as monetary side globally. And from India perspective, also, the government has started to pick capex. And if you see the private side as well, the balance sheets are significantly strong. ROEs are one of the best in the world, and net debt to EBITDA is falling below 1 time. So I think private sector is also now going to see some kind of spending, boom. So I think we are in a very good spot. Barring valuations, where I feel that it's very widely covered that India's valuation is expensive. But at the time when our inflation is undershooting and growth is outpacing, valuation will remain elevated in our view.
All right, that's an important point, Jitendra. I just wanted to ask you about the point you made on the BSE 500 ROEs. How much have they improved in the last few years? And I think they're the second best after the US market. Is that correct?
Yes, you are right. So if I look at the global, probably top 10 economies in the world, I think after US, India is the best ROE somewhere around 15 odd percent. And the third best would be Europe, which is around 11 odd percent. So India offers such a attractive ROEs. If I look at BSE 500, secondly, the corporates are flushed with cash, right? And at the time when your 10-year yield is heading towards 6% or even below in the next 12 months, I think we will see good capex spree coming in from private sector. You look at any industry, right from your consumer sectors or cola, for example, footwears, innerwear, defense, transmission, power. You see all these companies, private sector is now coming out and started to spend. Right. So I think ROEs are very attractive, and not even ROEs. If I look at even the consumption margins, right from your FMCG companies in the last 10 years, their margins have also gone higher by around 400 basis points to even as high as 800 basis points. So margins are high, ROEs are very attractive, cost of funds are falling, and cash is amply available. So I think we are going to see a very good investment cycle also going ahead. The question is demand, right? So demand is also a function of how much government is going to spend. So 10 years government has been continuously spending on infrastructure. And now I feel that industry, I think we will see some acceleration in growth going forward.
Jitendra, hi. So you're sounding fairly optimistic. And if one were to then reflect that in the portfolio and create a portfolio accordingly, then give us, say, your top 2 or 3 sectoral calls, or basically 2, 3 areas or themes that you would be most bullish on. Jitendra?
Yeah, I can hear you.
Yeah, I was asking you for your top 2, 3 sort of thematic calls that you'll go with from a portfolio perspective, given the optimism, given the reasoning that you just shared.
Surabhi, yes, it's very clear that the past winners are not going to be future winners. India is now changing, the complete trajectory. Once we move from 4 trillion to 7 trillion, the sectors which are going to drive this transformation are going to be very different. So first, I feel that in the very near term, I think India's interest rates are going to be much lower going forward. Plus, the hedging cost is also coming down. So net-net, I feel that interest rate sensitive stocks are near-term bets, and we have been betting on this for the past few years. So NBFCs and real estate probably is a structural kind of an upcycle. We will see that this cycle is going to continue. So that is one. Second, we think electronic, EMS players, manufacturing sector. I think there we are seeing very good traction happening, and some stock, sectors, and this particular sector is showing even margin expansion and improvement. So I think these are the 2 major sectors that we feel that are structurally very well positioned. Power transmission development, I think that's well researched and well talked about sector, but here we are not finding very good value play. But once the dip happens, probably T&D space is also looking fantastic from investment perspective. So I think these are the sectors that are looking pretty attractive in our view. Hotels, travel, tourism, these are all that we have discussed last time as well. So net-net, I feel one thing that people can even look at is the consumption side, right? So today that's completely avoided sector. People don't like to talk more about consumption. But if I look at last few years, the certain sectors such as airlines or hotels have done better, and FMCG sector has been a laggard. But going forward, I think next 12 to 18 months, we believe that the low-cost housing sector may start to deliver. So the sectors or NBFC sectors, which is linked to low-cost housing, I think they will perform. Secondly, I think next year, second half, we have to position for 8th pay commission beneficiary. Now, remember, 1.1 crore people are going to see salary hike, including pensioners who are working in central government jobs. So still 12 to 18 months away, but market is not going to wait for that. So slowly, gradually, we should lap up some of the consumer discretionary companies if you have a 3-year view starting from second half of this year. So I think Diwali is going to come in, interest rates are falling. Some consumer discretionary companies are also a very good bet from a 3-year perspective.
Thank you, Jitendra, for joining in and giving us your view on the markets. As you said, still there are select sectors and themes that will do well in this market. Maybe the headline index appears to be valuation-wise expensive, but ROEs with the broader markets are improving, the balance sheets are in far better shape, and you believe that we'll get that early teens growth in terms of earnings on Nifty, and broader markets could outpace that as well. Thanks a lot for joining in. Wishing you a good Friday evening, Jitendra, and a rocking weekend ahead as well. But for the time being, we'll slip into a short break, come back, we'll get you technical picks with the news that the markets are at the high point of the day. Bazooka move actually on the Nifty. Going into the weekend, at the high point of the day, the volumes as well have picked up, and that's encouraging. This move is coming on good volumes now. You can see a massive pickup in volumes, and that's very, very encouraging. In fact, in the broader markets as well, quite a few stocks are moving around. Vishal, Megamart, that's moved to the high point of the day. Z Entertainment as well has seen a bit of a spike up. Swiggy, swigging it away. That stock is up close to around 4%. You should pull up some of these names. All of them spiking up. Even a big underperformer like Tejas Networks. Take a look at the intraday chart out there. That's a rank underperformer. Seeing some buying interest from the day's low. Sharp uptick is what you're seeing on Tejas Networks as well. Just all of this in the last few minutes. Ashish Kayal joins us to help us out with a quick technical check. Ashish, I wanted to review if you have any on Tejas Networks, first of all. That's been a big underperformer. I think it went down to that 670 odd ballpark. It's seen, more than 1,000 rupees as well. How is it looking on the charts?
If you look at it at the charts in last 10 minutes, I think it just spiked up from 687 to 702 odd levels and currently at around 700. I think it needs to close above that 700 levels to sustain higher volumes are picking up here, and then the stock can move towards the level of around 740. One can maintain a strict stop loss of around 680. The risk reward looks good, 1:2. So 740 is the target, 680 is the stop loss. Volumes are picking up, so I think the stock can move up.
Okay, you think the stock can move up even from your big spike out there. But Ashish, I just thought I'll ask you about that one because it spiked up. Quick check on the Nifty. Is this the big breakout? 300 points higher out of nowhere. I'm hoping our boys do well as well in that test match that starts against England, against all odds. But besides that, no, we'll wait back for the test match. But on the Nifty, where are we headed from here on? And give us your fresh picks as well.
Yeah, I think Nifty is already hitting sixes despite of all the events. And I just now talked about that we might be headed higher from here on towards 25,300, 25,500. And post that about just 30 minutes before when I talked about Nifty has already spiked up by another 100 points. Do not try to catch a top here. I think we are moving up. We are climbing the wall of worry. Events are not driving the market. It's moving on its own mode and it's now heading higher. If there is any kind of weekend risk, that can be there. But if you look at the overall open interest data, also the call sellers are started panicking. They have started covering their positions. And I think Nifty is headed towards 25,300, 25,500 from here on. Any dip from here, use as a buying opportunity.
Okay, brilliant. Okay, all right. And that's the important point you made. The call writers got very, very confident and they seem to be getting stumped out, quick stumping there in terms of those call writers. But what about individual stocks?
From individual stocks, I picked up something from the mid-cap space. We already talked about M&M and the other stock, Reliance from the large cap. From the mid-cap space, I think mid-cap and the large cap is SBI Life. It is just trying to break out above from here on. So SBI Life can be a good catch here. One can maintain a stop loss of 1760, expecting a target of 1920 on the upside. And the another stock is MCX. MCX is not stopping anywhere. We can clearly see with the bullions going up, a lot of interest into the trading activity of gold and silver has kicked in. And MCX volumes are also picking up as a stock. And we can think the stock is headed towards 8,500 on the upside. Maintain a stop loss of 7,500 on the downside for MCX.
Okay. All right, Ashish. Thanks very much for all of those trading strategies. You have a good weekend and we'll connect again soon. With that, let's move on. We're down to sort of 2/3 of the month is pretty much over and we're looking at the auto sector now and perhaps what the sales numbers for June could look like. We've got some data out of Vahan and our colleague Sudarshan is now joining in to tell us what the highlights are. It seems that there is a growth of about 6% led by two-wheelers. But let's go across to Sud for more details. Sud, what are you picking up?
So in the month of June so far, the indication is that we are most probably likely to see the growth above 6% because in the first 3 weeks of June, total vehicle registrations so far have increased by 6%. And after so many months, several months of underperformance in the month of June, we are seeing a healthy growth trend. And this healthy growth is being led by two-wheelers, which is seeing a growth of almost 8%, followed by 4% growth by both CVs and three-wheelers. One segment that is underperforming is the passenger vehicle, where registration is seeing a decline of 1% so far. Now, talking to the company-wise, in two-wheeler space, two companies that have been outperforming are TVS Motor and Eicher Motors. So far, Eicher Motor has seen a sales of almost 70% of what it has done in June of 2024, almost the same level it's for TVS Motor. As far as Bajaj Auto and Hero Motor are concerned, both have seen a total sales of 60% of what they have done in June of 2024. In the passenger vehicle space, M&M Auto continues to outperform Maruti, and in commercial vehicle space, Ashok Leyland is doing well, and as far as Tata Motors is concerned, it continues to underperform. So in the first 3 weeks of June, registration data is looking healthy, so we'll have to see how the last 1 week pans out.
Got that. Thanks a lot for that, Sid. So we'll keep an eye out on that one. But Dreamfolks, that stock, in fact, was under pressure earlier today. We got a clarification actually coming in from the management after news reports suggested that several banks and card networks are planning to shift away from the company amid the service disruptions. Earlier today, we spoke to the chairman and MD of Dreamfolks Services on this, and she gave out some clarification. Let's hear her out.
I think all the clients are still with us. And the reason is because it's been a long-standing relationship. What we have with all the banks, they all understand that what is the value we bring to them. And second, most importantly, is that we are deeply integrated with all our clients, all our banking clients. So all our contracts are in place, and all the programs are ongoing. So there is no such thing going on right now. And this is business as usual, So it's a common thing in a business where, your contracts are under renewal. There will be RFPs coming in. The negotiations are on. So it's ongoing, and it's a business thing. So there is nothing change in the business structure.
All right, so that was a clarification from Dreamfolk coming in. They don't see a disruption or a threat to their business because for the airport operators looking at perhaps getting into services like lounges, etc. as well. Well, with that, let's get you a snippet from the latest episode of Market Cafe. This week I sat down with seasoned investor Pankaj Tibrewal, someone who is seen as a big celebrated fund manager in India when it comes to mid-caps. So I asked Pankaj exactly that question, that the narrative in the market is that large caps seem to be a much better place to be in, going by safety and valuations, and the argument that mid caps are perhaps still overvalued. Pankaj doesn't quite agree, and he explains why in this conversation. 7 out of 10 guests that I speak to, they still say that no, large caps offer better comfort, and there's still some overvaluation in SMIDs, as they're called.
So 3 points I would like to draw. And we mentioned in our quarterly newsletter, which I published in April, that on the headline basis, when you look at valuations, we acknowledge what people are saying, that mid and small caps are expensive to their history and versus large cap. So there's a relative margin of safety there. But I think devil lies in the details. So if you go a little deeper, what you find out that earnings growth in mid-caps especially has been faster in the last 5 years. Even in FY25, which was a slow year, mid-caps earnings grew at more than 18-20%. And going forward also, our expectation is that mid-caps and small caps can offer better earnings growth than large caps. That's the one part. The second part important is the composition of the profit pool. So if I look at the top 100 companies, 52% of the profit is coming from PSU banks, private banks, oil and gas, and PSU sector, which are generally low P in nature. And that representation in mid and small cap is to that, 15, 16%, 17%. So generally, when you look at X of these sectors, Nifty is trading at a premium to mid and small caps. So when you do a apple to apple comparison, and the third part is, when do they trade at a huge discount? Take 2018-19. You came from a huge bull run in 2017, and then you started seeing solvency issues, right? You had Yes Bank, DHFL, all kinds of skeletons were coming out, and there was a scare of solvency. This time in now last 5 years, the debt to equity and the leverage position of small and mid caps are far, far better in many cases compared to large caps also. And the last point which I want to drive, Surbhi, is that mid and small ab utne chotu companies nahi bache. Now the definition is up to 33,000 crore market cap is a small cap. Up from 33 to 1 lakh crore is a mid-cap. So, and they are sectoral leaders. You take tires, you take hotels, you take airlines, you take so many sectors like infra, capital goods, auto ancillaries. All these companies are classified as mid and small, but they are sectoral leaders in the sector they operate in. So I'm saying that the cycle and the texture of the market has changed.
Okay.
There are pockets of bubbles. I am completely acknowledging that, but it should not be painted with the same brush that everything is expensive and everything just sell and move away. I think in this market where 5,000 listed stocks, take out the top 100 stocks, you will find at least 40, 45 stocks at any point of time, which will give you that kind of a value to ride on. So I believe that you have to be a stock picker, as you rightly mentioned, and there are opportunities in the market which will make you money over a 2-3 year period.
This is very interesting because you're the second person that I've spoken to, I think, in the last 2-3 weeks, who has actually said that Indian stocks are not necessarily over expensive. I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap. And I was like, wow, that's
I won't agree to cheap, but yeah, I mean, you have to search your pockets. And I think ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters. And coming to your second point on what to do, I think over a period, what I have learned is that process of elimination is far powerful than process of selection.
On that, let me ask you, because you just said that there are still maybe some pockets where, things are a little overheated in the small and mid-cap space. So can we sort of rule them out? I mean, do you see, I don't know whether it's maybe defense or are there certain thematic areas where you do see excesses? Which ones would those be?
So, for example, one of my yardsticks is, for example, cash flows. So look at few of the EMS companies trading in India, right? Narrative is very strong.
90 times P, 100 times
100,
P.
110 times P. But when you open their cash flow statement, not all I am saying, but many of them who are trading between 25, 35, 40,000 crore market caps, the cumulative cash flow over the last 5 years, operating cash flow, is not even more than 50, 100 crores, right? That means it's a thin margin businesses, but they are hugely deploying money in working capital to drive growth. So I think that's something we need to be, I'm giving as an example.
Something to be cautious about.
That narratives will work for a while.
Right.
But finally, top line is vanity, bottom line is sanity, and cash in bank is reality.
Is the reality.
So cash flows you can't ignore at the end of the day. Yes, for 1 year, 2 year, there could be aberrations on cash flow either sides, but over a cumulative 4-5 year period, cash flow is something we need to be taking cognizance of.
Welcome back. I think that rebalance is taking place. BEL has moved to the high point of the day. So I think we should get the intraday chart on that one. Nice sharp spike is what you're seeing on BEL. Amrish Palika is joining us on the show. Hi, Amrish. Before we get to any of these other stocks, I wanted to ask you about the stock I asked you yesterday, Dreamfolks. There was some uncertainty with regard to a couple of contracts. The management has come on the channel. They've given a clarification. But from the days again, the stock has come off. What's your view on it?
Yeah, I think the MD has stuck her neck out and confirmed that nobody's moving out. But I think still the market is not buying that statement. So if she's proven right in the next couple of months and the earnings are supportive, then I think we can see a very decent upside. But for whatever reasons, the fears of Axis, ICICI, MasterCard moving out, in fact, comes true. I think it'll be difficult for the management to give any further clarification going ahead. I mean, I'm just giving an example of EasyTrip. I mean, whatever clarifications they come out with, I mean, how many people believe it? I think that's going to be an issue going ahead.
Okay, that's Dreamfolks. All right, so not too convinced, got that point. Amrish, what's the pick for the day?
It's Gland Pharma. So it's one of the largest and fastest growing injectables manufacturing company. Global footprint is in about 60 countries. Large range. It's across sterile injectables, oncology injectables, as well as ophthalmic. Q4 numbers were a tad bit lower than expected, but the management commentary was positive. And that's one of the reasons why we have seen a positive trend post the earnings. They launched about 31 new products in US in FY25. And their cartridge capacity, they are increasing from 40 million to 140 million units per year. This should happen next year. Net cash position about 2,300 crores, which is about 8 to 9% of market cap. GLP-1 and biologics would be the growth drivers going ahead. And already they have a strategic tie-up with Dr. Reddy's. And US pipeline also has been decently good. Zenzi, which was acquired in 2022, was in fact pulling down their overall performance earlier. But if you see the last couple of quarters, it's been performing well. And Q4, if you look at the gross margins of this vertical, it was about 79%, which is quite positive. So expected the consolidated EPS is about 72 for FY27. And with this, my target price is about 2,350.
Okay, so Gland Pharma is the key pick. Any word on some of these insurers? Go Digit, they're having a good session. I mean, in insurance, would you like anything?
Yeah, insurance. In fact, I mean, I would surely go in with HDFC Life at this point of time because I mean that was a slow mover earlier. Now just gathered that steam, and looking at the monsoon session, having the insurance bill, I think should be positive for most of the insurers. So among them, HDFC Life.
Okay. All right, Amrish, we'll wrap it up on that note. Thanks very much. We'll leave you to enjoy the rest of your weekend, and we'll connect again soon. Well, it's been a fabulous Friday for the market. That's the only way of looking at it because you've got a 300-point rally on the board. And we've outperformed most global markets thanks to the fact that no further negative news, at least none while we were trading. It got the bulls back out in full strength on the street. Big move on the Nifty. In fact, if you talk about it sectorally, the Bank Nifty has also done very well. It's outperformed, almost outperformed the Nifty. Gain of 1.2% there as well. And mid-caps have come back with a flourish. The mid-cap index is up almost 1.4%. It has cut its weekly loss to just about 0.5% now, because till yesterday the mid-cap index was sulking. It was down almost 2%, but looking very, very good as far as today's action is concerned. Let's quickly recap, of course, some of the key movers and shakers on the way up. On the Nifty, you've got big names like Reliance Industries. You've got a lot of the other heavyweights from the banking side like HDFC Bank, SBI, all doing quite well. PSUs like Power Grid and BEL, BEML, they've had a very good rally. In fact, BEML really soared towards the close of trade. Look at that, 9% higher on that stock. Other non-bank financials included Jio Finance and Shriram Finance that have seen good gains. Another good day for Mahindra and Mahindra. Stock up almost 3% as well. And Bharti had a good run. So that is your list of winners on the large cap screen. On the mid caps, it was such a good day. So just some more names here. Premier, Wari, Midhani, Mishra Dhatu. Gains between 5, 6, 7% depending on which stock you're looking at. And Premier and Wari, I mean, they were really lighting it up. Big moves coming in on many of these stocks today. And finally, the project financiers, which will benefit from the RBI final guidelines, which are not very, very tough. So PFC, REC, Hudco, Irida, all these stocks have gained between 3-4%. Well, good day for the bulls and the Nifty finally managing a close again above the 25,000 mark. In fact, 25,100. On that note, we take your leave on this edition of Closing Bell. Many thanks for watching, but the market discussion will continue, joining you right after this break on Editor's Roundtable. The ongoing tensions in West Asia did rattle markets through the week. However, Friday was a very different day. Friday, we had a great pullback, and finally, we managed to actually cut a lot of the losses of the last four sessions as well, even as most Asian markets failed to hold their ground, even as Europe was weak, and even as US futures were trading negative. It was India all the way. The Nifty and the Sensex actually managed to gain over 1% for the week gone by, and the Midcap index, it cut its loss. It was down 2% till Thursday. It cut that loss to just about 0.5% by the time we wound up the week. On this edition of Editor's Roundtable, we will get you Of course, so all the updates on the week that transpired, all the key events and the key factors that the market is going to look out for as we step into the new one. We also will decode the benefits of the latest project financing norms that have come in from the RBI, which are less onerous than what the market was fearing. So lots coming up. I'm Surabhi Upadhyay, and with me on Editors Roundtable this week, Nigel D'Souza and Manglam Malu, and a very special guest with us in the newsrooms, Nilesh Shah, Managing Director of Kotak Mahindra AMC. Nilesh, why you made the day? Ab to furti aa gayi. Ab to suddenly we're alive and kicking. Looking forward to this conversation.
He just came to the crease. He just came to the crease, and the crease was set before that itself. You know, the market did so well this week just by the news of you wanting to.
I think, yeah, they knew aap aa rahe hain, that's why.
If every time I visit, market will go up, I'll spend my whole life here.
What, you know, pehle kya hota tha, when there were batters from India who would go abroad, everyone would prepare a nice green top for them to get out. I think market was preparing for a nice green top for you to come, and then let's see how it's you know, playing out. But what resilience in the market, right? If you look at it, if you told someone that last Thursday, when the peak you know, tensions were there between Iran, Iraq, and then what US would do, etc.
Iran,
Israel. Not yet Iraq. You know, you would wonder, the Nifty at around 25,100, what happens then? Went all the way closer to 24,500. Yeah. And now back here, 1 week later, we're back to 25,100. So nothing really, you know, shook the belief of the bulls. And while Israel, Iran and US continue to dominate ticker and oil holds around that $77 per barrel, where all eyes are hoping for some sort of deal that may come by, de-escalation or any sort of negotiation that may happen. If you look at Nifty, Sensex, 1.5% each have moved higher. We're wondering whether there would be a tripartite agreement between Israel, Iran and US. There was definitely a tripartite agreement between the heavyweights of the index. Nifty Bank up 1.5%. Nifty IT up 1.5%. The third heavyweight, Reliance, up 2.5% this week. So that held the frontline indices. Yes, there was some give back in the broader markets. You know, 0.4% lower for the mid-cap index, 1% lower for the small-cap index. But amidst that as well, a lot of stocks and some blue chips did extremely well this week. You had, you know, M&M, Bharti Airtel, Trent gain anywhere between 4 to 6%. Tata Motors and Adani Ports, of course, geopolitical uncertainty, export-related issues, etc. That broke down, you know, some stocks lower. But look at these mid-caps. Aeroflex up 22% this week. Axis Cades up 21% this week. Looking at something like a Swiggy, which is up 9% this week. And decent traction for names like MCX and Avenue Supermarts as well. And among the losers, not many that lost in double digits. The one that lost in double digits had some reason behind that. So, you know, case like something like Dreamfolks, there was some uncertainty despite the management clarification coming in, down 15%. Intellect and Alembic, again, pharmaceutical and IT related names, some of them saw 7-8% sort of losses. But by and large, what resilience is what we saw. I mean, for the next week, all eyes will be on the monthly expiry. But at the same time, could there be a deal that may be announced during the weekend?
Well, that's right. Nilesh, I want to ask you, what's your view? We are only halfway through the calendar year. And imagine we have seen Trump's tariffs. We have had geopolitical uncertainty, India, Pakistan, you have Iran as well as, you know, Israel. And the last year, the earnings growth for India was very, very tepid. The hope is that things will pick up. But we're only 6 months into the year. And we've had so much of activity.
Because there's just so much news. Right?
How are you feeling? You know, are you feeling a little bit, are you drifting towards a cautious side? Or would you be more constructive on the markets?
So, Nigel, by Indian market is like a person whose one leg is in a cold water and other leg is in a hot boiling water. Oh. Average temperature normal lag raha hai. Domestically, we are in a fine shape. Inflation low, banking sector solid, RBI pumping liquidity, cutting rates, becoming pro-growth, current account deficit, balance of payment under control. So everything on domestic side, including last quarter growth, was fantastic.
Yeah.
Geopolitical, there's too much of uncertainty. Now what will happen? Will the boiling water cool off? If yes, then we are in a good shape. If it starts boiling more, then will we notice the heat? That will all determine where the markets will go. And in terms of earnings also, last year the base was 30%. On that to deliver 10% is quite good. It's not bad number.
Yeah.
And again, next year, we should be looking at a low double-digit earnings growth, which is decent. So on that base, this kind of sustenance is a very good thing.
You spoke about the average looking good and the cold water, hot water philosophy. market has actually done that only between 24,500 to 25,200. That range has somehow maintained. At some point, when the water gets a little too hot, we go to 25,400. When the water starts to look colder, we move to 25,200. When do we get out of this range? And what takes it out?
So, see, if I can convert this whole thing from a flow point of view.
Yes.
The retail investors have become so mature that whenever markets are rising and looking little expensive, it is SIP minus redemption, net flows automatically shrink. Whenever markets are correcting, it is SIP plus subscription, net flow increases. So at higher level of market, there is less money to invest. At lower level of market, there is more money to invest. Automatically, a range is getting set. Will this range change? I think it will change, but it will be a very slow process. Do we expect our markets to get re-rated from current level, where we are already at premium valuation? Ab isse upar kahan jayenge? So your earnings growth will deliver market return. Earnings growth are likely to be low double digit. Obviously, market return also will be moderate. Hence, these ranges will change, but people won't be able to notice it.
That liquidity question that he spoke about. So, you have a lot of data from the mutual fund.
Sylvie, and before you get to that, I'm sure you have crunched the data. I was up north a few months ago. I'd gone to Uttarakhand, Raniket, and I was at just outside this hotel, and we were talking, and there was a couple of people from Delhi region who they said, "Oh, Nigel, how are you? And good to speak to you and all." And as we were talking, that the guy who runs a grocery store out there, the other guy as well who's running another store, all of them were saying, let the market be. We are here for the long haul. Such kind of maturity in Raniket, out there where there is, it's still a developing place. It was so encouraging to hear. And at that point in time, the markets were in turmoil. And yet these guys were talking in this sort of a tone. I thought that was really heartening. Out here, sometimes we keep the money going and we say we are mature investors. But when at that point of time, when people start talking, when there was so much of uncertainty, I think that's heartening. But Surabhi, you have got a counter argument. Tell us.
No, it's not an argument. I'm just going to present data. But I think to your point, sometimes, and let me ask Nilesh about this. I think sometimes it's better, right? People sitting in Raniket are not looking at every news item, every ticker, every flow. They've invested, they've forgotten. They're looking at the big picture. People sitting here are looking at way too much information at some point.
I'll be very honest. I took a small little break last week. I didn't look at the market. I didn't see anything. Nifty was 25,100. Now when you look at it, it's 25,100. So,
therefore, sometimes that helps. But, okay, now here's, I have to ask you this question because of the numbers, to understand the numbers. On the mutual fund flows, let's talk about the good first. I picked up some data. So, of course, the last printed numbers tell us that the AUM of the industry is at an all-time high. It's crossed 70 lakh crores, in fact, 72.2 to be precise. Now, here's the interesting part. The MF AUM in India, over the last 10 years, the CAGR has been 20%. And last 5 years since COVID, it's been even better. It's 24%. And, of course, the DII-FI argument has been won by DIIs hands down. Last 12 months, total inflows are 6 lakh crores for domestic institutions. And at the same time, FPIs have battled total outflows, or they've given us net outflows of about 3.1 lakh crores. Now, that's the good part. However, I have to simply pull up the bar charts that we always look at when the monthly inflow numbers come in. And let me do that, and then I'll ask Nilesh about it. The fact is that when we talk about the net inflows coming into equity funds, from highs of 41,000, 42,000 crores that we were getting around Diwali last year, in fact, the December number was 41,000 crores, the last number that we got, the net number, it actually was just under 19,000. So that's a sort of a big fall that you cannot, ignore. So I went into the sectoral categories as well. Let's talk about large cap funds. Large cap funds were getting in January 3,063 crores. The last number is 1,250 crores. So that's halving in terms of just the monthly trends, how they're changing. Again, mid-cap funds also, mid-caps and small caps, usually the market's darlings. Mid-cap funds, 5,147 crores in January. Then 3,400, 3,400, 3,300. The last number was below 3,000, the May number. Small cap funds, again, we were peaking January 5,700 crores. The last number, it's still better than large caps and mid caps. But again, we're talking 3,200, roughly, give or take. The best number in all this is that SIP number because those SIP pillars are rock steady. 26,000 crores, 26,300, 400, 26,500. That's been the trend so far. Now, Nilesh, the question to you in this is that while we acknowledge what he's saying about the Raniket investor, SIPs are going steady, the firepower or just the sheer money power that was being thrown at the industry month after month, that has declined in the last 5-6 months. Is that, from a market perspective, could that at all be a risk?
Not at all. See, in mutual fund flows, there are 4 components. One is SIP, that's rising. Ekad mahina idhar udhar, but overall rising. The second one is NFO. When we launch NFO, we get a lot of money. When we don't launch NFO, there's no flow. The third one is a lump sum investment. As I mentioned earlier, people put lump sum when they believe market is cheap. They also don't put lump sum or avoid when they believe market is expensive. And finally, Surbhi, now we have 5 crore investors. They have 72 lakh crore here. They have made tons of money. Shouldn't they be spending something?
And boosting the earnings trajectory.
Yeah, May, June, they will be redeeming to take foreign vacation. When I can assure you that 90% of foreign vacation is sponsored by mutual funds. Because people have made money and they are going.
Planning for short-term goals, yeah.
Absolutely. So, I think retail investors have matured a lot. Whenever they believe valuations are cheap, there will be SIP plus subscription. Whenever they believe markets are expensive, it will be SIP minus redemption. But their participation in equity as an asset class will continue to grow.
But you're not worried about this slowly, 40,000, say 38 hua, then 35, then all of that, and now 18,000 plus.
Bring down market to 22,000 and see the
we hope that doesn't happen, because then that would mean that a lot of other stocks would see a lot bigger gashes. But be that as it may, you said that a lot of people are making a lot of money from the markets and thereafter they are taking vacation. So that holds on to the discretionary part of consumption. The other part of the economy is obviously credit growth. And there has been the rate cut that has come by. There has been the liquidity boost that has come by. Add to that, the RBI has actually gone ahead and eased project finance norm for banks as well. The NBFCs, Lata tells us that they will be benefiting from all of this. In fact, what we'll do is let's go across to Lata, who has broken this data down for us to tell us how the prospects are improving for the banks and NBFCs, specifically on project financing. Lata.
The draft rules on project finance were very strict. Compared to that, the actual rules which were announced yesterday, that is Thursday, are relatively easier on banks. Basically, it refers to how much you must set aside as provisioning when you give a project finance loan. Because in the past 10 years, during the infrastructure loans boom period, a lot of them went bust. Now, the RBI's move was in the draft rules that more money be set aside in good times so that even if they go bad, you can adjust. But to come to the rules say that banks have to keep a provision of only 1% for a project finance loan. The draft rules had set 5%. At the moment, banks keep only 0.4. So it's more than now what it is now, but it is much less than what the draft rules threatened. In case the projects were delayed, they are called DCCO deferment. What is DCCO? It is date of commencement of commercial operations. If it is delayed, then you have to keep an additional 0.37% of the total loan amount as provisioning for every quarter. The draft rules had said it should be 2.5%. Compared to that, again, it is lower. Then for commercial real estate, the new rules require 1.5% of the loan to be kept as provision. Again, the draft rules were 5%. Once the project becomes operational, under construction, you have to keep 1%. Once they become operational, the new rules say treat them as any loan and keep only 0.4% as provision. The draft rules had said even when they go into operation, you have to keep 2.5% as provision and then slowly bring it down over 5 years. So the point is the new rules which become applicable from October 1st are far simpler. What is more important, they apply only to prospective projects, not to projects which are already given. That was another thing which was pressuring bank stocks and the NBFC stocks. NBFC stocks which will also find relief because of this are PFC, REC, IREDA. But in the case of the NBFCs, just one point to note is they already provide more than banks because they have what you call ECL norms, expected credit loss norms. So for them, the change is really not much.
All right, thanks a lot for that. Lata brings a fair amount of clarity into, eased norms for project financing. Credit growth hasn't happened. And so two things which everyone watches as economic growth indicators. One is consumption growth, volume growth in consumer staples. The second is credit growth. These two factors are being tackled right now. We're still looking at signs of that improving. That hasn't happened. What is your thought?
Mangalam bhai, in FY20, listed India's total profit was 4,11,000 crore. This year it will be 18 lakh crore. Will they borrow or will they use this money to invest? So there is a huge growth in profitability and there aren't as many projects to invest into. Second, this lower credit growth is function of lesser demand rather than limited supply. Banks are flush with liquidity.
Exactly.
But there are not many people who are borrowing because one, they are making enough money and there are various factors at play. We have invested in a company where promoter said, Nilesh bhai, main kyun invest karu? One of my kid is going into restaurant business, other wants to run an art gallery. Now, clearly, the next generation is not stepping up. So, I think this credit growth is a complex phenomena. RBI and government has done their part in terms of providing liquidity, cutting rates, improving guidelines. But that ease of doing business still has to really improve further so that animal spirit in entrepreneurship comes alive.
But it is such a paradox, right? Just before we take that short break, I have to ask you this, because on the one hand, people are making money because of the markets. On the second, people aren't borrowing from banks because they are making money in the markets, and then they are spending somewhere. So some part of the market is earning, but a large part of the market is not lending because people aren't borrowing. And if people aren't borrowing to invest because their kids don't want to go into the business, there is no demand for businesses. And because there is no demand for businesses, capex is not happening. So it's such a complex mesh. Where does it...
So again, it's five blind men trying to identify elephant. One, there is improvement in efficiency. People are able to debottleneck their plant and improve the capacity. If you notice the utilization, it is still upwards of 70%. So it's not that we are facing... Plus, look at the inflation. Wholesale price inflation is in a low single digit. It just shows that there is no limitation of supply. People are becoming efficient. And despite having money, they are waiting to invest rather than rushing to invest.
Okay, we do have to take a quick break, but the discussion is going to continue. Lots more to discuss with Nilesh. We'll be back in just a bit.
Welcome back. You're tuned into Editors Roundtable, and we are joined by Nilesh Shah, who's spoken enough about markets. But Nilesh, let's before getting into the weekend, let's talk about a couple of interesting things. The cricket match is going to start. India versus England. Hopefully, our boys are geared up. A new look India team. In that sort of a backdrop, what do you make of these IPL valuations? There was a news report that suggested that one of the players are looking at a $2 billion valuation. Your thoughts?
So one, in the private unlisted market, CSK shares are available.
Yes.
Go and corner that. Maybe you will get it at a much discount. Second, I think all this kind of new age businesses should get listed in the market. They are likely to have better growth. And by coming into the market, they'll also create alternative mechanisms or structures like this. Like we have data centers, CDMOs, EMS. Why not sports franchisee? Today it is IPL, tomorrow who knows, it could be table tennis, chess, football. This is how we will create the sporting culture. Capital market can take the risk and provide the capital for development.
That's very interesting, you know, because among the listed players that there are already, you spoke about CSK, which is in the unlisted players, but you do have one of the...
Sunrisers.
You have Sunrisers, you have CESC Ventures, which has Lucknow Super Giants, and then you have obviously, Royal Challengers Bengaluru under United Spirits. These also aren't unlocking value immediately or at any point in the very near future. Do you think that deep value because of the IPL franchise in some of the players where the proportion of market cap versus what the IPL valuation is high, would that be an interesting bet?
So Mangalam, to some extent, there's no activism shareholders here. We do guard governance, but we don't force activism.
Value.
We don't go for value unlocking. I think it's a question of time. A day will come, like in Western world, Indian investors will also become active and force promoters, managers to do value unlocking. Till such time, we'll have to be at the mercy of promoters to create value.
Two important takeaways for this weekend that will be food for thought for everyone. One, animal spirits have to come by. And second, shareholder activism spirits have to come by. So basically some tonic everyone has to drink so that, everything is covered.
I'll tell you who is drinking the tonic. The guys who are doing all the blocks and the trades, all these investors.
you looked at us.
Surbi looked at me, I was like... But what plans for the weekend?
No, before that, let me ask about the investment bankers that are on steroids or some tonic or God, I don't know what, because the block trade party, promoters selling P, selling that on non-stop. So, Nilesh, what do you think of the deals that are happening in the market, the valuations, and just essentially what's going on between this hectic buying and selling daily basis?
So, Surbi, as a fund manager, we always see silver lining in the dark clouds. If promoters won't sell, if investment bankers won't work 24/7, how will we get the supply? I'll have to buy the existing shares at much higher prices. Let the market forces prevail. Very recently, one very large PE fund CEO came to meet me and said, Nilesh bhai, please don't do cartelization. I said, have you gone mad? In my own company, I'm not unable to do cartelization between one fund manager and second fund manager. And you are telling me I'm doing cartelization with my competitor. You have no idea how we operate. We are competitive. So will there be one or two issues where we may end up paying higher price than needed? Probably.
Yes.
But there will be 10 other issues where we will extract our pound of flesh.
But in general...
Let market forces prevail.
But in general, the deals that have happened, including BAT sold in ITC, there was a couple of weeks back, and so many other deals.
Vishal Megamart, 10,000 crore.
Vishal Megamart. In general, when you see, not only the deals that you would have participated in, but even otherwise, are valuations still in sync, or is it getting a little...
So beauty is in the eye of beholder. FPIs are underweight India, and मैं तो हमेशा कहता हूँ सुबह को बुला शाम को घर लौट आएगा.
Okay, so he's told us about the FIIs or the promoters selling and all that. He said that all those guys are in the mutual funds, they are spending on foreign vacations, etc. All those guys who are investment bankers, pocketing a hefty bonus by the end of this year.
And they become investors in mutual funds.
One, they become investors in mutual funds, and secondly, they're the ones who are buying these 10, 20, 30 crore flats. DLF,
absolutely.
11,000 crore worth sales in just about 10 days of launch.
So the top of the pyramid thriving, premium consumption.
Yeah. Let's talk about something that we all can afford and something that he's also a big fan of. Movies. Are you watching any this weekend?
Now with OTT, it's all serials. I recently watched Tehran on Apple TV. Fantastic serial.
What about Sitare Zameen Par? It's not on OTT. It's only in the cinemas, and it's going to be in the cinemas for a while before it goes on anywhere.
I mean, I had a chance to watch it yesterday as well as earlier this week as well. I enjoyed it. It sends home a message. It's a family entertainer. It has a little bit of love, and it drives home a message as well. So I really enjoyed it. But disclosure, I'm fully emotionally invested in this film. Sitare Zameen Pe, I think.
In a world filled with way too much strife and way too many negative events, and the very unfortunate one that we had last week, I think the world can do with some positivity and love. And on that note, I think it's curtains on this edition of Editors Roundtable. Nilesh, thank you so much. You brightened up our Friday. Thanks for coming in. And with that, we'll take your leave. Thanks for watching. But stay tuned. News and updates continue on CNBC-TV18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. The Israel-Iran war enters the second week. Trump buys 2 weeks' time to decide whether or not to plunge the United States into the heart of the conflict. Ministers from the European Union and Iran set to hold talks in Geneva. Stocks rebound across the world as Trump delays Iran decision. Sensex and Nifty gain 1% this week thanks to Friday rally. Crude oil prices cool after rising 10% this week. India and European Union are working towards a full substantial free trade agreement by the end of 2025 and not an interim deal. EU ambassador calls India to ease tariffs on automobiles, pharma and alcohol, says EU will not drop the carbon tax, calling it an integral part of climate action. That's an exclusive. DMK MP Dharavi Maran sends a legal notice to brother and media baron Kalanidhi Maran alleging fraud and money laundering, demands restoration of a 22-year-old ownership structure. Sun TV calls it a personal matter between promoters and all legal obligations were met before listing. After TCS, Andhra government sold over 21 acres land in Visakhapatnam to Cognizant for a token lease price of 99 paise. Cognizant commits to invest close to 1,600 crores to build an IT campus in the city, which is expected to generate around 8,000 jobs over 8 years. 220 victims identified so far, 8 days after the Ahmedabad Air India plane crash that killed 241 out of 242 people on board. Air India cancels 8 flights, citing enhanced maintenance and operational reasons. 4 of them were overseas flights. Growing fears over the Dharavi redevelopment project as nearly 1 million residents could be pushed out along with their livelihoods. The Adani Group is leading the 95,000 crore rupee project to revamp one of the world's largest slums in Mumbai. The Bombay High Court terms deaths of commuters on Mumbai locals alarming. This after Railways filed an affidavit showing 3,588 fatalities in 2024 alone. This amounts to 10 deaths on average every day. 16 billion passwords and login credentials have been leaked online, according to a Forbes report. This includes user accounts on Google, Facebook, Apple, among others, in what is possibly the biggest data breach in history. All right, our top focus, the conflict between Israel and Iran has entered the second week with both sides continuing to exchange heavy fire. The Israeli military has said it attacked dozens of military sites in Iran overnight, added that over 60 fighter jets struck dozens of military targets using approximately 120 munitions. The military added that several industrial sites used to manufacture missiles were struck in Tehran as well. They claim that these sites served as a key industrial center for the Iran's defense ministry. Tel Aviv also claimed that Iran fired cluster bombs at Israel with an aim to increase civilian casualties. Israel, meanwhile, bombed a northern Iranian city. The attack caused a massive explosion in the area, prompting people to evacuate the region immediately. Israel's strike also reportedly hit the Sefit Road industrial park located in North Iran. Reports suggest that Iranian missiles targeted Israel's tech park in Beersheba that also housed Microsoft's office. Plumes of fire was reported outside the tech giant's office, while residential buildings also suffered significant damage. As per the Israeli emergency services, 5 people were reportedly injured and were taken to a nearby hospital. Meanwhile, Israeli Defense Minister issued a stern warning to Hezbollah for extending its support to Iran. This comes after the head of the militant group vowed all forms of support to Iran in its war with Israel. Foreign ministers from the UK, France and Germany are set to meet their Iranian counterpart in Geneva today to try and find a way to de-escalate the situation. The meeting comes after US President Donald Trump set a 2-week deadline to decide whether the US will join Israel's war against Iran.
Now, regarding the ongoing situation in Iran, I know there has been a lot of speculation amongst all of you in the media regarding the president's decision-making and whether or not the United States will be directly involved. In light of that news, I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks. That's a quote directly from the president for all of you today. So the president is always interested in a diplomatic solution to the problems and the global conflicts in this world. Again, he is a peacemaker in chief. He is the peace through strength president. And so if there's a chance for diplomacy, the president's always going to grab it. But he's not afraid to use strength as well, I will add.
One should not forget that the EU has been in negotiation with Iran on its nuclear program for years. That was called the JCPOA. Unfortunately, this preferred way of actually reaching a deal never materialized. The EU has made its position very clear that Israel has a right to defend itself, that we've continually said that Iran was not compliant with its own obligations under the Non-Proliferation Treaty, and that there is still a window for diplomacy, and that Iran would be well advised to seize that window for diplomacy.
We as a country, we as a free nation, we expect the other free nations and other countries to condemn these vicious actions, these unlawful military attacks against civilians, against the children, women, in order to make them stop this aggression.
Sensex and Nifty witnessed healthy gains in today's trading session, with frontline indices rising more than a percentage. Nifty closed above the 25,100 mark after 6 trading sessions for the week. Today's gains helped market regain losses of last week. Sensex and Nifty rose more than a percent each, while Midcap slipped 1%. From currencies to commodities, crude prices softened, with Brent falling nearly 2%. The gains were trimmed after the White House delayed a decision on USA's involvement in the Israel-Iran conflict. Remember, oil prices surged amid fears of increased US involvement in Israel's conflict with Iran. However, prices are still on track for a third straight week of gains. On to a money control exclusive. DMK MP Dharavi Maran has sent legal notice to his brother and Sun TV chairman Kalanidhi Maran. The MP has alleged that his elder brother executed a fraudulent scheme to take control of Sun TV after their father's death in 2003. Sun TV has called the issue the promoter's personal matter. The network shares declined 4% in trade. Money Control's Chandra Shrikant is here with more.
Sun TV shares are in focus after Money Control's report of a feud between the Maran brothers, Kalanidhi Maran, the chairman of Sun TV, and his younger brother, Dayanidhi Maran, former union minister and currently a DMK leader. Now, Sun TV has clarified to exchanges that this is a family matter and will not impact the day-to-day functioning of the company. They've also said that some of these allegations in these media reports are inaccurate and misleading. Now, why is Sun TV in focus? Well, Dayanidhi Maran has sent Kalanidhi Maran a legal notice accusing him of indulging in fraudulent practices over the last couple of decades to wrest majority control of Sun TV. Remember, Kalanidhi Maran is a 75% owner of Sun TV network, one of India's most profitable listed media firms, and he's one of India's also richest entrepreneurs with a net worth of over $2 billion. Now, in his legal notice, Dayanidhi Maran has threatened to invoke action by various regulators, including the SFIO, to DGCA, to other agencies, if Kalanidhi Maran does not restore the original shareholding that was there in 2003, when the Maran and the Kalanidhi families had 50-50% in the present Sun TV. So we'll have to wait and see how this proceeds. But for now, Sun TV clarifying to exchanges after their shares were trading lower in the day that this is purely a personal matter, a family matter, and will not impact the operations of the firm.
Right, thank you, Chandra, for that. The Andhra Pradesh government has sold over 21 acres of land in Visakhapatnam to Cognizant for 99 paise. Now, this move comes a couple of months after the state government inked a similar deal with TCS. Shilpa Ranipeta joins us now for more. Shilpa, please take us through the contours of this deal.
Well, you know, after Tata Consultancy Services, it's now Cognizant that's getting land from the Andhra Pradesh government for just 99 paise. The government has sold over 21 acres of land in Visakhapatnam to Cognizant to set up a large development center. Now, as per lease terms, Cognizant will invest 1,582 crore rupees over the next 8 years. Now, the company is expected to generate over 8,000 jobs through this project, and the campus is likely to be operational by March 2029. Now, first TCS and now in April and now Cognizant in the same area. This move is part of the Andhra Pradesh government's broader push to turn Visakhapatnam into a major IT destination. TCS, if you remember, had committed 1,350 crore rupees and promised to create 12,000 jobs in the same area in Visakhapatnam. Now, while experts have questioned the revenue implication of leasing prime land at token rates, especially when the state is reeling under high debt, the state is actually betting on long-term economic gains, job creation, infrastructure development, and positioning Vizag as a credible alternative to traditional IT hubs like Bengaluru, Hyderabad, and Chennai. Back to you.
All right, thank you, Shilpa, for that. Shifting focus now, India and European Union are working towards a full, substantial free trade agreement by the end of 2025. And not an interim deal. That's the word coming in from the EU ambassador to India. In an exclusive conversation with CNBC-TV18, Ambassador Irv Delphin called upon India to ease tariffs on automobiles, pharma and alcohol. He also said that EU will not drop the carbon tax, calling it an integral part of climate action. Take a look.
We have been getting reports that while we want to complete a full trade deal with the European Union by the end of the year, both sides may also have an early trade deal, an interim trade deal by July. Is there an ambition to do that? Are we close to that?
I think the July deadline seems to apply to another geography rather than to the EU. I think the message of our leaders, as I mentioned, was very clear: by the end of the year. So what matters most for us is not the fast and furious, and is a steady and progressive negotiation that really brings tangible results. I think most important is the substance of this trade deal. So we are not somehow bound by any artificial deadline by July or other. That doesn't really concerns both the EU and India in their relations. So I think we are comfortable with the pace, with the intensity, the focus of the negotiation as we have them, and I think both sides are really determined to have really something substantive.
CBAMs and deforestation regulations, India has been seeking a carve-out from that. In fact, according to certain reports, Indian government is even mulling retaliating in case that CBAM tax, carbon tax, is imposed on Indian companies. This will only go into effect in January next year. Is there any possibility, any discussion for a carve-out from India, for India?
Based on the feedback that we receive from different constituencies and private sector, we have moved and gone through what we call a simplification package of the CBAM, which just this week there's been an agreement between the Council and the Parliament on this CBAM simplification package. So what we want to do is to come back to the Indian partners and stakeholders to explain what it is. And indeed, the Federation of Industry in India, FICCI, has been a partner in that, in trying to bring the conversation, and we will have this interaction with the Indian private sector early July. And I think that will help also to pave a way forward. And last, I would like to point out that CBAM, or the equivalent of CBAM, has been taken out of the FTA with the UK. And we have always made the point that CBAM is not a trade instrument. It is an instrument which is part of our climate agenda action. So I think all these elements should point towards a position of the EU where we are confident that we can address the issues that India has with CBAM, but outside the FTA.
The price band for HDB Financial's public issue has been set at 700 to 740 rupees a share. The company plans to raise 12,500 crore rupees and will open on the 25th of June and close on the 27th of June. The company's public offering will be the largest since Hyundai Motor India's 27,000 crore rupee IPO. 8 days after the Ahmedabad Air India plane crash that killed 241 out of 242 on board, 220 victims have been identified so far. 202 bodies have been handed over to their families. Air India has cancelled 8 flights citing enhanced maintenance and operational reasons. 4 of them are overseas flights. Madiha Mujawar is here with more on this. Madiha.
Well, there are planned cancellations till mid-July, and then there are also daily cancellations due to the enhanced maintenance and operational reasons. So first, about planned reductions, Air India has announced a significant scale down of its international operations. The airline will be cutting 48 flights per week until mid-July, and this includes a complete suspension of routes like Delhi, Nairobi, Amritsar, London, Gatwick, and Goa, London, Gatwick until the 15th of July. 38 flights have been cancelled to routes including North America, Europe, Australia, Japan and South Korea, and these flights are operated by the Boeing 787 and Boeing 777 aircraft, the ones that are currently undergoing safety inspections following the tragic AI-171 crash that was also operated by the 787 Dreamliner. So besides the enhanced pre-flight safety checks, Air India says that reductions in flights is also to accommodate airspace closures in the Middle East and the Pakistan airspace closure, which is requiring Indian airlines to take longer routes to Europe and the North American destinations. Now on daily flight cancellations, which are separate than the planned ones, Air India cancelled Dubai to Chennai, Delhi to Melbourne, Melbourne to Delhi, Dubai to Hyderabad flights on international routes. In domestic flights like Pune to Delhi, Ahmedabad to Delhi and Hyderabad to Mumbai and Chennai to Mumbai have also been cancelled, and there could be more additions to these daily cancellations as we speak.
All right, thank you Madiha for that update. On that note, we'll slip into a short break. Coming up next, growing fears over the Dharavi redevelopment project as nearly 1 million residents could be pushed out along with their livelihoods. More on that when we return. Welcome back. Finance Minister Nirmala Sitharaman has flagged the growing gap between the detection of tax leakages and recoveries. Sources tell CNBC-TV18 that tax authorities have been urged to take steps to increase the amount recovered after evasion has been detected. Timsy Jaipuria has more. Timsy.
Well, that's right. Sources have told CNBC-TV18 that CBIC's two-day brainstorming conclave has ended, and Finance Minister, in her address to the field formations, has pushed officers to improve leakage recovery ratio. Finance Minister flagged the growing gap between detection of tax leakages against recoveries. Just to give a sense, what is this particular area? Well, the GST audit data pegs that pan-India recovery is at just 4,000 crore rupees versus a detection of leakage of about 34,000 crore rupees. Also, the GST audit data of the taxpayers which are under CGST regime is showing that the highest tax evasion was detected in Chennai, followed by Mumbai, Bengaluru and Hyderabad. Also, the data suggests that in FY24, enforcement arms under GST detected tax evasion, which was worth just a little over 10% of total tax collections. Further, in her address, Finance Minister pushed for faster cargo clearances by Customs Department across land, sea and airports. Also, she asked CBIC officers to identify pockets of high cash transactions and to convert them into formal economy. She also emphasized that the CBIC officers should ensure integrity of tax department is impeccable and unquestionable. She said that CBIC should speed up vigilance cases pending against officers for swifter justice. Also, Finance Minister asked CBIC officers to work towards addressing taxpayers' concerns, bringing in ease of doing business and grievance redressal as the key action points for the next coming quarters of this fiscal. Back to you.
Right. Thank you, Timsy, for that. Moving on, the master plan is now in place and the world's largest urban renewal project is ready to begin. But the 95,000 crore rupee plan to revamp Dharavi, one of the world's largest slums, is not being welcomed by everyone. CNBC-TV18 Shilpa Ranipeta reports that on the ground, there's growing fear that many of its nearly 1 million residents may be pushed out and their livelihoods with them. Take a look.
I'm standing in the heart of Mumbai in Dharavi, Asia's largest slum. It is a maze of lanes, by-lanes, alleyways. It has homes, it has workshops, it has shops. It is full of life. It is also one of the most valuable, fiercely contested and densely populated pieces of urban land in the world. And it is all set to change forever. Approved in 2022, the Dharavi redevelopment project promises to transform this city within a city. The entire project spans a gross area of 251 hectares. Of this, around 109 hectares have been marked as developable land. The remaining space is to be set aside for roads, public amenities and civic infrastructure like drains and high-tension power lines. The project is being executed by Navbharat Mega Developers, a joint venture between the Slum Rehabilitation Authority and the Adani Group. So far, over 4,500 crore rupees have been invested in both land acquisition and in the construction of around 1,000 homes and amenities on land handed over from the Indian Railways. At its core, the redevelopment plan is about the rehabilitation of Dharavi's nearly 1 million residents. But residents complain that the current master plan involves the construction of only 72,000 units. Around 58,500 of these will be residential units. This assumes that the population in redeveloped Dharavi will be around 4.85 lakh people, including the people who buy land or units that are eligible for sale.
यहाँ पे टोटल 1,15,000 से ज़्यादा रेसिडेंशियल और कमर्शियल है। यहाँ पे जो उन्होंने किया है वो अदानी के फ़ायदे के लिए जो 72,000 बोला उसमें रेसिडेंशियल भी है कमर्शियल में, वो उनका जो नंबर है वो बहुत गलत है।
खाली सुन में आ रहा कभी भी तोड़ना चालू कर देंगे, स्टैम्प मार के चले गए हैं तो हम लोग कहाँ जाएंगे? बच्चों का स्कूल कॉलेज यहीं पे है, कहाँ जाए कैसे सेटल करेंगे? सब बहुत प्रॉब्लम आ जाएगी, इसलिए हम लोगों का मतलब रिक्वेस्ट है कि यहीं पे दिया जाए।
The eligibility criteria of being assigned a home in redeveloped Dharavi is another bone of contention. Only people living in the ground floor residences with documents proving that their occupancy predates the year 2000 are eligible for free in-situ rehabilitation. Those on upper floors or those who do not have papers to prove occupancy will not get homes.
हमको नहीं चाहिए, हमको एक ही घर धराई में ही चाहिए, बाहर हमको नहीं चाहिए। वहाँ
देवनाथ डंपिंग में जाना तो वो हम लोग को गंवारा नहीं है, वैसे भी मरना है। डेवलपमेंट के बिल्कुल खिलाफ नहीं, लेकिन हमको हमारा घर धराई में मिले।
हम लोग डेवलपमेंट के कोई खिलाफ नहीं, कि किसी लड़ाई हो रही है। मैं तो बोलो यहाँ पे इतना सारा फैक्ट्री चल रही है, काम है, यहाँ पे लोग इतना कमा रहे हैं, यहाँ पे सबको उजाड़ दोगे, दगा भी नहीं दे रहे हो किसी को, सब उजाड़ के फेंक दोगे तो लोग जाएंगे कहाँ?
But SVR Srinivas, the CEO of the project, says residents not eligible for new homes have an option.
So for those ineligible, the government has decided they'll be given houses in hire purchase format, initially in the form of rental housing, but in the due course they can purchase the house also.
Dharavi is also a commercial hub for Mumbai. From leather to garments to food processing and recycling, thousands of small businesses operate here, forming an informal economy that's estimated at over 7,000 crore rupees. Residents fear that the redevelopment will destroy livelihoods that have thrived for generations.
अभी जो मास्टर प्लान बना कुछ दिया ही नहीं कि कहाँ देंगे जगह कमर्शियल की। अभी एक एक यूनिट में आप देखोगे ना तो कम से कम 30-30, 40-40 जन है। अब 40 अगर एक फैक्ट्री में 40 आदमी है तो उसके पीछे एक फैमिली में 5 जन पकड़ो तो कितने लोग इस पे चल रहे हैं, लाखों लोग मतलब पल रहे धरावी से। और ये धंधा कहीं और सेटअप जाएगा तो ये बर्बाद हो जाएंगे सब बिजनेसमैन लोग यहाँ से। नवी जगह जाके धंधा सेट नहीं होएगा।
The administration, however, says these fears are misplaced.
Those who are inside the commercial units inside Dharavi, they are ineligible. They'll be given tenements from out of a 10% quota commercial space we have kept in each building.
But as the ambitious project takes off, it's the lack of trust that's defining the mood on the ground. In Mumbai, Shilpa Rani Peta.
And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
An iconic building in San Francisco, a building that was constructed in 1907 after the devastating earthquakes. It's only appropriate that this is home to Notion. Notion, of course, is the productivity powerhouse started in 2013 by Ivan Zhao, Simon Last, and then Akshay Kothari joined them a couple of years in. It's got all the makings of the Silicon Valley dream. It started strong, went almost belly up, came back in 2016 in a new avatar, and today has over 100 million active users, $330 million in funding, and a $10 billion valuation. It's hoping to become the everything app as it takes on Google and Microsoft. To talk to us about the past, the present, and the future is co-founder Akshay Kothari, joining us now on Voices from the Valley. Stay tuned for the Notion story. Akshay, it's great to see you again, and thanks so much for having us here at the Notion headquarters, a pretty iconic building constructed in 1907, and this is now home for you.
It is our new home. We just moved in here about a month ago, and it feels like graduation from maybe kindergarten. We're on Market Street now, and it's a sign of our business also moving up market. Starting to, actually really see more and more enterprise customers use Notion. And so it's fitting for us to come to Market Street.
Yeah, and it's also fitting because this is a timeless building, and that's the ambition, right? To build timeless products. So it kind of converged.
It very much is. Our ambition is to build a timeless tool. In fact, all these conference rooms are named after timeless tools that we look up to. And we hope Notion is something that will be around for generations to come.
Let's talk about Notion and the many pivots that you've had to make along the way, from the start in 2013 to, of course, the big breakout moment in 2016 to where we find ourselves in 2025. I have to say, I was pleasantly surprised because as I was driving down the highway, I see a billboard and it says software is beautiful. Now, I've heard software being described as many things. Beautiful is not one of them. But take me through why you're placing all your bets on software being beautiful.
Well, it really goes to our ethos of the company. I think we are rooted in a lot of the work that computing pioneers of the 70s did. One of them, Douglas Engelbart, really talked about augmenting human intellect. And so when you drive by, you see all these billboards about AI replacing humans. That's not our ethos. Our ethos is very much about augmenting people in a way that can make them do more. And it goes back also all the way back to our first office 12 years ago was in a design studio. And that intersection of liberal arts and technology is where we love to thrive.
And that's where Ivan thrives.
That's where Ivan
in that intersection. I mean, this looks a little bit like a chair museum as well, because I believe he handpicks every chair that we find here. And they're stunning pieces, by the way.
Handpicks every chairs, but not just chairs. I think every piece of furniture, down to the pen we're using, is something Ivan picks. We are trying to build a timeless tool, and he wants to make sure we are surrounded by timeless tools that we're inspired by. So the natural light, the things we're using around us really pushes us.
Jazz in the background.
The jazz music in the background. It really pushes us to do our best work.
So let's talk about AI and what that's going to mean now as far as Notion's future is concerned. How do you see yourself making an AI pivot?
Well, AI is like new electricity for us. We've spent about a decade building an incredible editor, an incredible database where people are doing lots of work. There's tens of millions of people using the product. And now what AI does is it infuses all this power. One of the things that we always hear from people is that people really love the product, but they find it hard to really customize it or build it to a place that they would like. And AI enables that. AI knows how all the different parts of Notion work. And so now you can essentially speak English or your language, and it converts it into a setup that is customized for you.
So the think it, make it philosophy is being taken forward courtesy AI today.
Correct. And in some ways, people had to do this work, or people had to rely on the community to build the things that they can use, and now they can build it themselves. This idea that every person in this world, there's 1 billion knowledge workers, and every one of them can create a customized software by just asking it what they want.
You know, so here's what I want you to address now, Akshay, because I know that the ambition of Notion when it started was to be the building block, was to be the Lego equivalent of the software world. From that to now the ambition of being the everything app and kind of taking on the big boys. You know, this arc, this journey that you're transitioning to, what does that mean in terms of what you change inside and what you change on the outside as well?
Well, in some ways, there's a connectivity to that. We always thought that people are drowning in too many tools. And we always thought that maybe fewer tools that can actually help you do your work was actually better. And so instead of every person inside a company using 100 tools to do their work, we thought Notion can enable you to do all of that in one place. Now, what AI has done is that really enable that for the long tail. You know, and people come to Notion for all sorts of very interesting use cases.
Okay.
Some people are,
What's the most interesting use case?
I think people use it to, in the personal side, track their workouts, to manage their plans, to figure out their fridge inventory for what they're cooking in recipes in Notion, all the way to the work where people are managing their projects and their OKRs and they're, you know, running their company on it. And with an interesting product which works for 5 people, but then also the same product works for 50,000 people. And that's quite unique, right? Basically having 4 orders of magnitude difference, and it's the same product. And so it has to be simple enough so that the next college student can use it, but also it needs to scale so that when they go on to start a company and it becomes 10,000 people, the product continues to scale.
So, you know, as you make this journey now, what do you see as being the next steps necessary? I mean, you know, some of the fundamentals of the company, which was basically to ensure that it is profitable from the get-go, of course, after having almost gone belly up to then restarting in 2016, the idea has always been to sort of stay profitable. As you look at the future, profitability, as you look at enterprise, I mean, you know, what could we be talking about in terms of potential revenue expansion?
The company continues to grow, and at the moment, we're really sort of moving towards a path where we'll get to $1 billion in ARR. As you said, in the coming years, I think not too distant future. And as you said, we've been cash flow positive for many years, and something that I grew up in Ahmedabad and my roots are Rajasthan, so it's something that my dad approves of.
Cash flow is king.
Cash flow is king. And it's quite rare actually in the Valley to have that, right? I think to have a business that continues to, like almost the business continues to fund our expansion. And I think part of it also comes from our ethos of keeping the team small. We care a lot about talent density. We care about having the fewest number of people here that can have incredible leverage in terms of what we build and what we can do, and to give that leverage to our customers as well.
You know, you're talking about people, and we're also talking about AI, and I think we're almost in this race at this point in time with companies claiming that, look, 20% of our code is now being done by machines, 30% is being done. It's almost become this sort of, you know, slogan. How are you seeing that? I mean, you know, how do you find this balance between what machines can and should do and the contribution that humans should and will continue to make?
I think Notion has a slightly different ethos. I think a lot of people talk about artificial and general intelligence, AGI, and I think a lot of the focus is on replacing humans and being as good as humans or better than humans. We really think about it as augmenting human intelligence, and this idea that what can a human, with the help of AI, with the help of robots, can do? Like, what can we do together? And I'm actually extremely optimistic and bullish for the world, because I actually think that, you know, so much of your day-to-day life is currently focused on all these monotonous things that you wish you didn't have to do. And so I think you can kind of take two different views, which is like, will those jobs go away, or will people's 30% of their time will be recovered by people, and people will be more creative, and people suddenly have the time to build things in the world that they didn't have before. I feel that way right now. Like, I feel like, oh, there's all these things that AI is helping me with, which means that I can build so much more.
So what are you building today?
We're building so many things from, so if you just think about Notion, like even 2 years ago, we were focused on a singular product, which was Notion. In the last 2 years, we launched Notion Calendar last year. We launched Notion Mail this year. And we're slowly becoming the suite or the connected workspace that the future generations are using. We want to get to a point where people don't have to use any other tools. They can live in this deeply connected world where your meetings have the perfect meeting notes in Notion, and your emails can schedule meetings perfectly in the calendar, right? And all these connections that should have existed actually in the last 2 decades, but haven't. And so that's an area that we have really expanded, and things that we're able to do now because we're all accelerated by AI.
But this is a space dominated by the big boys, right? Between Google and Microsoft, it's the lion's share of the market. Now, how do you take on these large legacy incumbents? What is the strategy to go after a share of that pie? And what do you see as the addressable market for yourself?
It is a multi-decade path, and it has been done before, so I'm excited about that. I was in school, maybe in college 20 years ago. 20 years ago, Google Docs and Gmail came into life, and when I was in school, it felt like the best thing since sliced bread. Like, we all grew up using these products, and when I went to work, I demanded that we should use Google products because that's what I grew up with.
That was the gold standard.
That was the gold standard. And if you talk to students today, high school students, college students, startup founders, they're all growing up on Notion. They're all so used to having this flexibility in the workspace. The way Notion knows them is very much the only way they know how to work. They are going to go on to build the next generation of enterprises that will all run on Notion. And so I think part of our biggest bet is to make sure that we inspire the future generation to be using Notion.
So that's the bet that you're making, but let's talk about the expansion as well. I mean, outside of here in San Francisco, in the US, you've got offices in Ireland, you've now got your first engineering center outside of the US in Hyderabad, in India. How critical is India going to be as part of your strategy?
Oh, India's going to play a big role. So outside of the US, as you said, the only engineering office we have is Hyderabad, and we're continuing to invest quite a lot of investment there. We're growing the team quite a bit. It actually started a couple of years ago when we acquired a company in India. And if you have to think about, Automate is the company we acquired. And when you think about like all the future developers who are going to really build the tools of tomorrow, I think India is already the #1 or #2 market in terms of developers and knowledge workers. And so I think we're very excited about the market in India, both from a standpoint of us growing our team there, but also the market.
As a user market. What numbers do you have in India today?
I think if you look at the number of unicorns around the world, like what percentage of them exist in India, it's starting to grow quite a bit in the last few years. And a lot of them are customers of ours. And this happened without us being there in the early days, right? So again, it was probably a designer who decided, actually, my portfolio looks better on Notion, my work looks better on Notion. They bring it into their company, and in a couple of months, the entire company is using it.
So, staying with India, the expansion has been by way of M&A through an acquisition. Is that potentially something more that you could consider in India at this point in time?
I think we definitely look at that as a way to expand, but we're also, I think the acquisition became a core hub for us in Hyderabad. And so now that we have such great engineering leadership there, it gives us the ability to really sort of invest in it more. And I think one thing that I'm really excited about, especially because I've spent some time in India myself, is that Our office in Hyderabad is like a front office. It's an office that is building core products that is used by everyone around the world. It's not a
not the back
support
office.
center. It's not a build these things so that people here can build. No, they're building things that literally our global customers are using, and they're a core part of our strategy. This was important for me because, of course, I grew up there, but I also worked there for 3 years when I was at LinkedIn. And I saw the talent we have there.
I want to go back to your equation with Ivan. And again, I don't know how many people remember this or perhaps even know it, but you were one of the first few investors in Notion when Ivan started the company in 2013. And it was only until much later that you actually decided to come on board. Take me through to what made you want to leave LinkedIn and say, okay, Notion is where I believe I'm going to find my truth.
I think also very serendipitous, right? So I think I invested in 2013 right out of the Pulse acquisition. I had made a little bit of cash, and then
a little bit.
And then I think as people do in the Valley, I think people choose to pay it forward. And so I think Notion was my first investment, and I invested because Ivan is someone I tried to hire at Pulse. He was a designer, and I lost that battle. And so when he's starting a company, I said, here's my check. I'd love to support you. And of course, I was extremely inspired by his vision of democratizing software. And but it's been I think first 3-4 years I thought I'd made a mistake because the company didn't really launch a product, ran out of money, and only in 2017 it started to sort of emerge out of the shadows. And in 2018, I think I was here for one of those summer planning exercises as part of LinkedIn, Microsoft. And I had breakfast with him, and you could see the numbers moving every week. And he asked me if I could join him as the COO. It was only 8 people back then, so it's pretty small. And I don't know what, but I never thought of a different opportunity. I never considered doing anything else. But as soon as Ivan said it, it clicked that this felt like the right opportunity. And it was a big decision, which to me professionally, I sort of knew that was the right call.
you find the most exciting aspect about what we're seeing because of generative AI and how it's shaping behavior, how it's shaping consumption today, and what it could potentially mean in terms of innovation for companies like yours?
It really feels there is something different in that how useful it has already been just in 2 years, how quickly the behaviors are shifting, and also the fact that it's permeating through every industry, every function. There isn't any function you can talk about where people are not using it or leveraging it in meaningful ways. And so maybe the thing that feels different is the pace. Somebody said this recently, which really resonated with me, is like, you know, we all grew up and like evolution just happened, like you didn't feel it. I think last 2 years feels like we're experiencing evolution. Like it's so fast that what happened last week is already old news today.
Yeah.
And so the pace is quite fascinating.
How do you engineer in an environment like that, where, you know, as you pointed out, what was exciting and cool a week ago is obsolete today? I mean, how much of what you're building and even the culture do you need to sort of break on a daily basis just to be able to keep pace with the kind of change that we're seeing?
There's no other way. I think you just have to stay connected to everything that's going on. It is something that is almost necessary for every company to stay relevant. And part of it is like, you know, I think sometimes I get grief from my team saying like, hey, we did this planning, just finished planning and now you're already changing plans. But it's like, but that's just the world we live in now. Like, I think what was true in December is just not true in March anymore, right? And so part of it is you have to sort of throw away the dogmatic things you have inside your company, and you have to rethink it from a standpoint of like, well, if I was trying to build a new company today to take on Notion, what would I do? And then I have to do that, right? I think that's the only way to stay relevant. And
so what are you most paranoid about today, you know, in terms of staying relevant, in terms of why you believe you continue to have the winner's mindset? I mean, what are you most paranoid about today?
Well, as we discussed, I think we're up against some of the giants who've had decades of distribution advantage over us, right? So the thing that keeps me up at night is primarily like distribution. I want to get to a point where hundreds of millions of knowledge workers are using Notion every day. And that is my ticket to staying relevant as a way to make sure that we are going to be considered as a tool, as a company that is amongst the top 3 things you buy when you start a company. Like, we have to be in that top 3 list because if we're not, then we're not mission critical. And we want to build something that is mission critical, not for a small niche, but for hundreds of millions of knowledge workers.
You know, you talked about the big boys. I'm sure the big boys have come calling, have come knocking. Is that an eventuality that you consider? Have you looked at it, or would you look at it in the future, should that to happen?
Well, as you know, Pulse was acquired by LinkedIn, and then LinkedIn was acquired by Microsoft. So I've gotten to see that twice before. I hope Notion goes all the way and becomes a public company. I actually think this is also something that Ivan told me as a way to recruit me into the job. He said, do you want to continue working at Microsoft, or do you want to build the next Microsoft? And I think that was an inspiring vision for me to join Notion.
As you look at building the next Microsoft, and you talked about potentially going public at some point in time, I mean, how much of an aspiration is that? Are you actively considering that possibility?
We're investing a lot. I mean, in many ways, our business is already public scale. The fact that we're cash flow positive doesn't force us to hit the public markets right away. We don't have any needs for capital. But what we are doing internally is really trying to operate as a public company. And what that means is that we have our own forecasts for what we're trying to do every quarter, and we try to hit those. We are improving the internal controls. For example, you know, making sure we're audited every year, and we're closing the books on time. we have all the right processes and controls, that we're compliant with all the things that larger enterprise needs. And so in some ways, we're actually doing everything we need to do to be a public company, and then that will give us an option to go public. And whether we take that option or not probably depends on a bunch of other factors, including...
What's the next big wave that you're hoping to catch?
Well, the biggest wave is AI. I think it's probably the biggest wave I've experienced in my short 15-year career. And when you get a wave that big, I think you can kind of focus on that.
Where do you believe Notion is likely to be in the next 5 years? What's the internal targets that you've set? You talked about $1 billion in ARR, and that's potentially the target in the foreseeable future. But outside of that, what are some of the key metrics that you've put on the drawing board as the aspirational targets over the next few years?
So our goal is, primary goal is to make the product ubiquitous. And so I really think about how do we make sure that hundreds of millions of knowledge workers are using the product. And my own personal goal is, in about 10 years, my daughter will go to college. And my hope is by the time she goes to college, every person in her classroom is on Notion.
What kind of investments are you making in what kind of companies as an investor today?
Investments, I feel like, so I started to do this as a side hustle, as a way to creatively sort of involve myself with ideas that I'm not doing at work. And of late, I've been thinking about experiences as as a thing that feels like AI safe. And so actually the two investments that I'm super excited about reading updates every month is a company called Such Paneer here, which makes the best paneer in America.
Such Paneer, okay.
And the other one is Dandelion Chocolate, which is in San Francisco. And as a software entrepreneur, I feel like I live and breathe software all the time.
Yeah.
But actually seeing a chocolate maker and a paneer maker
be the two big bets that you're making at this point in time.
I feel like inspired by, I don't know, I feel like investing to me is less about maximizing financial outcome. To me, it's about learning. And I feel like the things I learned from reading those updates are so interesting, because I don't run a retail shop and I don't run a big manufacturing. And so somebody said it well, where they said, investing is like, you'd appreciate this, which is it's like tuition fees with a call option. It might work, but you're paying tuition to learn about a new business.
About a new business. Well, we hope that you continue to learn many things about new businesses that you potentially invest in, but also, every day is different at Notion, as you've just explained to us, and we wish you the very best of luck over the next few years with what you're attempting to do. But thanks very much, Akshay, for joining us here on Voices from the Valley. Akshay Kothari here, talking to us on Voices from the Valley on what is next as far as Notion's future is concerned. From all of us here on the team for now, thanks very much for watching. If you enjoyed the program, then write into us, log on to our website, and of course, visit us on social media. Everything is there for you. Goodbye, and thanks very much for watching.
Hello and welcome to Global Eye. I'm Parikshit Luthra. The United States buys 2 weeks to decide whether or not to join Israel's war against Iran, even as the conflict enters the second week. Both Tel Aviv and Tehran refuse to blink and accuse each other of bombing civilian sites. The European Union tries to reason with Iran, even as its supreme leader takes a hard stance. The Israeli military claimed to have attacked dozens of Iranian military sites overnight. Tel Aviv also claims that Iran fired cluster bombs at Israel with the aim to increase civilian casualties. Meanwhile, reports suggest that Iranian missiles targeted Israel's tech park in Beersheba that also housed Microsoft's office. EU ambassador to India added that there's still a window for diplomacy and Iran should seize it. Listen in.
One should not forget that the EU has been in negotiation with Iran on its nuclear program for years. That was called the JCPOA. Unfortunately, this preferred way of actually reaching a deal never materialized. The EU has made its position very clear that Israel has a right to defend itself, that we've continually said that Iran was not compliant with its own obligations under the Non-Proliferation Treaty, and that there is still a window for diplomacy, and that Iran would be well advised to seize that window for diplomacy.
We believe these aggressions should be stopped as soon as possible. It could be done via international joint effort. Those countries like India, who are the voice of the South, the big countries who actually are in favor of peace, they should coordinate and put pressure on Israel. But I think at the first step, they should condemn this action not to be happen in the future.
To take this discussion forward, we are now joined by Major Dan Pfefferman, and a retired IDF officer and expert on Middle East. Major Dan, thank you so much for joining us on Global Eye. Let me begin by asking you, the European Union, Germany, France, these countries are going to sit down and talk to Iran today to see if there is a diplomatic way out. If they propose to Israel and Iran a solution out of this crisis to end the war, is Israel in a mood for accepting a diplomatic solution?
Hi, thank you for having me on the show. Israel would have been in the mood for any kind of diplomatic solution many years ago that puts an end to Iran's nuclear program, which is almost entirely focused on threatening Israel's very existence, on the ballistic missile programs, which, as we see unfolding this week and as we have seen over the last 2 years and well before, provide Iran itself and its army of proxies around the region a tool with which to terrorize Israeli civilians. And a path to get Iran out of its state of constant belligerency against Israel, whether directly or indirectly or diplomatically or economically. So the only reason that Israel attacked was because diplomacy was not putting an end to all of these threats. It is clear that Iran was getting dangerously close to the capacity to have both enough enriched material, plus it already has the capability with which to deliver it. And the negotiations from Iran's point of view were just a way to buy time while continuing to bypass or to skirt or to get around the NPT or the IAEA's restrictions, even per Iran's own commitments to the JCPOA. It's clear that it was just trying to buy time and find ways to continue sneaking closer and closer to a nuclear weapons program. So as far as we're concerned here in Israel, diplomacy would have always been the preferable option, but it was clear to us that Iran was never actually committed to diplomacy, and so Israeli leaders took the decision before it was too late.
So are you saying that whatever happens now in Europe in terms of negotiations between EU leaders and Iran, that is not going to be acceptable to Israel at all? Or will there be certain benchmarks, if achieved, then you will accept it?
I believe it's the latter. I believe that if certain benchmarks are achieved, as far as completely taking away Iran's ability to enrich uranium and the weaponization programs, which it was supposed to not be doing anyway, and the commitments to stop producing ballistic missiles that literally threaten our country. I mean, 2 missiles this past week landed within a kilometer of my house. These are meant for only terrorist purposes to terrorize. One landed on a hospital yesterday, right? So if Iran were in good faith and feeling the pressure that it's feeling now to come to the negotiating table, whether with the Europeans, whether with the Americans, or even under Indian auspices for, and commit to actually taking away these capabilities and abiding by agreements that it makes, Israel would be very happy, because war is always a last resort. And we, the citizens, we, the country, we pay the direct price for it.
Right. In terms of the current escalations, the war continues. What's going to be next in terms of Israel's action to put pressure on Iran to eliminate its nuclear capabilities? What next can we expect from Israel in terms of stepping up the military action and also the intensity of weapons that are used?
So what we're looking at right now is a sort of an escalation ladder, an escalation plan. If I'm seeing what the Israel Defense Forces, the Israel Air Force is doing, is that they mapped out a whole series, a plan of what it essentially means to neutralize, to cripple, or to set back, at the very least, Iran's, first and foremost, nuclear program, secondly, its ballistic missile program, and thirdly, its general defense and intelligence infrastructure. The first part of it would have been to neutralize Iran's air defense capabilities, but Israel actually did that when Iran launched 2 separate barrages of 200 and then 100 ballistic missiles at Israel earlier in this year. And so in the reprisal to those Iranian attacks on Israel, Israel actually already took out Iran's air defense capabilities. And so the plan, the escalation ladder, had actually been moved up by about a week. What we can see now is that a continued degradation of Iran's missile capability, defense manufacturing capabilities. Iran produces much of its own defense hardware, whether it's missiles or UAVs. Continued attacks as much as possible on the weapons program, the nuclear program, recognizing that Israel alone doesn't have the capability to fully neutralize it, and if need be, to continue stepping up the pressure on the regime itself. Perhaps another escalation step that we could see is on energy or transport infrastructure, for example, on the Bandar Abbas port, which is a strategic port for Iran, or on major oil or gas installations. And so all of this is potentially still in play. Obviously, I don't have the plans in front of me, but you could continue seeing a ramping up both of pressure, but at the same time, a ramping up of neutralizing Iran's capabilities to wage war, and with the end goal that Iran does come back to the negotiating table with the, whether it's the Europeans or the Americans, and commit in a verifiable way to cease its nuclear enrichment, nuclear weapons program, and its ballistic missile programs.
All right, Dan Pfefferman, thank you so much for joining us on the program, giving us your view on the escalations and what Israel could do next. Let's see what happens in the talks between European Union and Iran later this evening. We're going to take a short break, but up next, President Trump continues to claim he stopped India-Pakistan war after hosting Field Marshal Asim Munir in the White House. I caught up with D.P. Srivastav, ex-Indian envoy to Iran and author of the book Pakistan, Ideologies, Strategies and Interests, on what this means for India. You're watching Global Eye. US President Donald Trump hosted Pakistani Field Marshal General Asim Munir at the White House earlier this week. The meeting came less than a day after Prime Minister Modi had a phone call with Trump to clarify that no discussions were held with US on mediation or trade during Operation Sindoor. That's not all. Trump, while addressing the media, had claimed yet again that he had helped end the war between the two nuclear nations. I spoke with ex-Indian envoy to Iran, DP Srivastav, to get a sense of the American playbook when it came to India and also Pakistan's larger game plan and military doctrine. Srivastav was posted in Karachi in the 90s. He has recently authored a book called Pakistan Ideologies, Strategies and Interests. His book traces the interpretation of ideology and elite interest in the making of Pakistan's domestic and foreign policy. I started by asking him to weigh in on the meeting between US President Donald Trump and Pakistan Army Chief Asim Munir at the White House.
The meeting, the luncheon meeting with the US president is being projected by both sides in the context of recent hostilities between India and Pakistan. But to understand it, you have to bear in mind the West Asian context. And let's go back a month. General Kurilla, the head of the US Central Command, in a testimony to US Senate, described Pakistan about a month ago as a useful ally in the fight against terrorism. Now, this is a very curious statement. America exited Afghanistan 4 years ago. There has been no recent catch of big terrorist figures, and they abound in Pakistan in recent years. So what explains this, this heartwarming commendation to Pakistan? I think you have to look at the developing situation in West Asia. Pakistan is an immediate neighbor of Iran. In case of hostilities or military action against that country, it can be very useful. And indeed, perhaps this has been in the works for some time, because you would recall then that in the midst of Operation Sindoor, IMF announced a fresh commitment of $1.5 billion to Pakistan under Climate Resilience Fund. This was in addition to release of a tranche of $1 billion under the existing commitment of $7 billion IMF undertook last year. This was not exactly a good signal to a country indulging in terrorism, but the current situation in Iran, if you work backwards, explains this generosity. Pakistan was being brought on board for any contingency that might arise, and of course Pakistan has always fished in troubled waters, and it is in deep economic trouble. It needs money, and it has already delivered. It's not a coincidence that on 15th June, one day after Israeli-Iranian war began, Pakistan closed its borders with Iran, except for return of Pakistani nationals. Now, you keep in mind the historical context. In 1965, during India-Pakistan war, Iran under Shah had provided Pakistan Air Force sanctuaries. And today, Pakistan has closed the doors, shut in Iran's face. So obviously, it has to be paid for services rendered.
Absolutely.
And that explains the context of this rare honor of being invited to the White House for an army chief.
Ambassador Srivastav, we'd also like to ask you about General Munir's position right now in Pakistan and why Pakistan went in for that terror attack against India. You've said in your book, and you've quoted General Zia-ul Haq to say, the professional soldier in a Muslim army pursuing the goal of a Muslim state cannot become a professional if he does not take on the color of Allah in all his activities. Could you give us a sense of what General Munir is now trying to achieve?
Let me first give you the historical context. You quoted from a book by Brigadier Malik, which is prescribed reading in Staff College Beta. And General Zia wrote the introduction. Brigadier Malik in this book said that terror is not a means to achieve an end. Terror is an end in itself. And this was the book which was being commended by General Zia. And mark General Zia's words, he was not talking about a Pakistani soldier. He was talking about a Muslim soldier in the service of an Islamic state. And that is the philosophy which also inspires General Munir. He said about a couple of months back in his speech that he does not recognize anyone as Pakistani who does not accept Islam and Constitution. So religion obviously in his mind plays a larger role than the country's constitution. And he, in this 16th April speech, which was just a week before the Pahalgam terror attack, referred to ideology of Pakistan. He referred to two-nation theory. He said that Kashmir is the jugular vein of Pakistan. Now, the last two statements, there's nothing new. This was originally, these words were spoken by Jinnah, and it has been part of Pakistan's official creed since then. But, when you say that Kashmir is the jugular vein of Pakistan, it reflects Pakistan's obsessions with its own interests, not with the Kashmiri people. In the same speech, General Munir went on about the Baloch struggle.
Right.
And he said that, Pakistan would not allow it to succeed. So the ideology of Pakistan tries to impose a homogeneous religious identity on a diverse people and does not recognize the distinct national or linguistic identities of its people. And that is the genesis of the ongoing trouble in Balochistan. It tells you something about General Munir's mindset. And most interestingly, in the same speech he quoted Iqbal, he also made a reference to Palestine situation and described Israel as a Zionist state. Right. And today, he's being feted around in White House. And obviously the current context which is being played out in West Asia is a pointer of things to come.
Okay. Ambassador Srivastav, you've also spoken about how Pakistan's economy has been in shambles. There is an entire chapter in your book dedicated to the Pakistan economy. And you've also quoted Ishrat Hussain, former governor of State Bank of Pakistan, to say Pakistan has been a laggard in South Asia, facing episodes of boom and busts. The country has approached IMF for meeting balance of payment crisis 22 times in 30 years. Considering that the economy of Pakistan is in such a precarious situation, why do they continue going after Kashmir as a goal? How does this serve their national interest? You've also noted in your book that India is not a threat to Pakistan. We are not wanting to attack Pakistan, but Pakistan is constantly targeting India with terror, is constantly eyeing Kashmir at the cost of their own economy. Why is that?
It's a very pertinent question. Kashmir is an ideological issue for Pakistan, and this is reflected in the slogan that Kashmir is the unfinished agenda of partition. This has nothing to do with, the aspirations of Kashmiri people. It goes back to the two-nation theory. Now, this obsession with Kashmir has impoverished Pakistan, diverted most of its budget to military purposes. In his first budget presented by Jinnah in 1947, he devoted 70% of the budget to defense. And that situation continues in the recent budget, which was presented on 10th June. The Army's budget, the defense budget has been increased by 17%, while the overall budget size has been slashed by 7%. And the contrast becomes even more stark when you consider that the development budget has been slashed to half. Now, the sum total of Pakistan's military budget and the debt service obligations exceeds Pakistani federal government's share of revenues, which means, in other words, that for rest of the government, that is other than debt service payment and defense, the government has to be run on fresh loans. How precarious is Pakistan's economic situation can be understood from the fact that it has reserves of foreign exchange reserves of $11 billion. This has been made possible because gesture by friendly countries to roll over Pakistani debts amounting to $16 billion, which had fallen due this year. So if those debts are called, Pakistan would immediately go into default. But despite this precarious situation, almost like it's an addiction, and it serves Pakistani military's corporate interests. It serves, their sense that they are the ultimate, the custodian of the ideology of Pakistan, not just its frontiers.
Right. My final question to you, sir, is about the nuclear angle. Pakistan, as you said in your book, is developing tactical nuclear weapons and has now embarked on a full-spectrum deterrence. Considering that the threat of a nuclear war in the region is very real with what's happening between Israel and Iran, what do you think Pakistan's designs are likely to be, and how should India now prepare for the future? That would be my final question to you.
Let me point out two very odd things about Pakistan's nuclear policy. It has a first-use policy. In theory, that is also the case with much of the West, with NATO, with a difference that Pakistan combines first-use policy with what it calls a territorial dispute. In Europe, NATO and other EU countries, as well as, Soviet Union on the other side of political divide, agreed under Helsinki Accord that it will not use force to change borders. So Pakistan, by combining first use with territorial dispute, has lowered the threshold of use of nuclear weapons and made it more likely. Now, the second part is that nuclear weapons are supposed to be weapons of last resort. In every crisis, Pakistan flashes it right in the beginning to draw international attention. So this again lowers the threshold. Now, let me just touch on one point about recent Operation Sindoor. There was a statement by Pakistani ambassador to Germany before Operation Sindoor about use of nuclear weapons and so on. But once the operation got going, there was no such threat. Now, this really means something. It means that Pakistan's nuclear bluff has been called. Pakistan has traditionally used to hold out the threat of nuclear escalation to deter India's conventional strike against its sub-conventional attack. This is not going to happen in future. Coming back to, the Iran-Israel thing, there was Pakistani defense minister has made it clear that Pakistani nukes are for Pakistan's interests. So that is not going to happen. But the fact remains that in the past, it is proliferation of nuclear technology by Pakistan to Iran in early 90s, to Libya again in the 90s, and to North Korea, which has created this headache for the international community and the West, which is now mollycoddling Pakistan.
And with that, it's a wrap on this edition of Global Eye. Thank you for watching. Stay tuned to CNBC-TV18. News continues on the other side.
Well, the minutes of the monetary policy meeting are with us, and there is consensus among members to support growth. What comes out from the governor and the deputy governor's stance appears to be that the neutral rate means that you can either cut or hike. There are signs that perhaps they're giving themselves elbow room for a further cut also. That's one way to look at the key points from the minutes. But a very interesting discussion comes from one of the external members, Dr. Ram Singh, an external member of the MPC, who argues the theoretical reason why you have a neutral real rate and how it is calculated. The difference between the inflation rate and the repo rate should be the neutral real rate, and how that changes from time to time. To get more on that, we are joined by Dr. Ram Singh himself. Dr. Singh, thank you very much indeed for joining us. Well, the first point I want to ask you is whether you think there is more elbow room, because that is the impression one gets from the way Rajiv Ranjan, from the way Sanjay Malhotra have argued. But you have left your stance to only one line, that you want it to be neutral because of the global uncertainties. What is the sense you are getting about the future elbow room available for the monetary policy?
Thank you, Lata, for having me on your show. So let me give perspective to the way I look at neutral rate and the scope we have for rate cut in this cycle, in this policy cycle. So this year's inflation, this fiscal year's inflation forecast is at 3.7%. Whereas when we met, when MPC met in June, that time repo rate was at 6%.
Yes.
This gives the difference of 2.3% real repo rate.
Yes.
In its own right, it appears too high.
Yes.
Not growth supportive.
Yes.
Historically speaking. But then we have benchmarks also you alluded to, which is a neutral rate.
Mm-hmm.
A neutral rate is a short-term phenomena, but we know that it also follows some pattern. During last 2.5 decades, real neutral interest rates have been declining world over.
Yes.
That has been the case for India also. Most two recent estimates of neutral interest rates for India.
Mm-hmm.
One is for pre-COVID, and then there are one after COVID.
Yes.
So there was a change. There was an uptick in neutral rate from about 1.2% to about 1.65%.
Yes.
This was on account of COVID-specific factors.
Mm-hmm.
COVID-specific factors were escalations in public debt, yes, and output gaps that had arisen.
Yes.
Also, there were issues with pent-up demand.
Yep.
Now those factors are behind us. Therefore, I feel, this is a feeling, I would like to describe it as an educated guess, that our neutral interest rates are heading to pre-COVID level, that is towards 1.2%.
Okay.
But given the research uncertainty, let's go by post-COVID estimate, which is 1.65%. By this logic, we have room for 60 basis point cut.
Yes.
That is the perspective I have.
Okay.
And if you would like, so we also have in the same perspective, we have a demand situation where the demand seems to be tepid for urban demand for housing. And we also see very little uptake in private investment, whichever way look at private capex, either as a ratio of net surplus or we look at a debt to equity ratio, there seems to be the case for supporting demand. So we have scope, ample scope, and there's a need. And therefore, this is the rationale for...
Okay, fair point, sir. Fair point, sir. Going forward, what do you think should govern the MPC's decision making? If inflation were to undershoot, would you have greater confidence in cutting or desire to cut? Or will you be more wanting to cut if growth undershoots?
We will watch out for both. Inflation is the first number we look at.
Yes.
And our stance, change stance to neutral territory, it does not take out the options that are there in accommodative stance. It just adds one bit, one more dimension, one more degree of freedom to our decision making. But if inflation turns out to be below what we are expecting it to be, that will strengthen the case that will open the room for rate cut. If there are signs on growth front, that will also be a consideration in my view. Lata, I should have added this in the beginning, but allow me to add now that the views I'm expressing, these are my individual views. They do not reflect views of the MPC or the Delhi School of Economics.
Of course, sir. Point taken. The other point that keeps coming, the repo rate is meant to be the monetary policy framework requires the overnight rate to be the operative rate as the repo rate. But we have seen that the overnight rate is way below the repo rate. Is that a bother for you? Do you feel that it should converge with the repo rate? And therefore, did you all prevail upon the RBI at all that the overnight rate should be at the repo rate?
First of all, Lata, this is not our mandate, MPC's mandate, to give direction to RBI on this matter. But like any other citizen and expert, we can give, we are free to make our submissions, our suggestions to the RBI. Having said this, this particular divergence between call money rates and repo rates, and the former being closer to the floor of the liquidity adjustment facility, is it's something that is noticed. But RBI governor has provided explanation for this in his statement and also subsequently also. That during the easing phase, it is not unusual for the call money rates to be below repo rates. In the long run, medium term, one would expect the two to converge.
Okay, fair enough. So you've left your position on the stance with just one sentence, that I support the stance change from accommodative to neutral in view of the global uncertainties. What is your sense? Making it neutral makes the chances of a cut much less?
No, it's I don't look at this way, look at the situation this way. I do not have concerns on inflation front.
Okay.
I hope we get pleasant surprise on inflation. Prints turn out to be less than what we expect. I also do not have concerns on growth vis-a-vis 6.5%.
Okay.
But there are concerns only on two counts. 1.5 count. One is the global uncertainty, and half count would be something unusual, unexpected happening on the food inflation front.
Okay.
These are the two considerations in my mind when I support neutral
vote for. Point taken, sir. And those are genuinely something we cannot predict. So far, the monsoon has been kind to us. So we will have to see how things pan out. Dr. Singh, pleasure speaking with you, sir. Thank you very much indeed for joining us.
It was my pleasure too. Thank you, Lata. Thanks again. Bye.
Okay. Well, we need to take a break on that note. More discussions continue.
of it is, if you have the concentration that we're talking about of one company or a group of companies owning so many treasuries to try to back the stablecoins, how should we think about that?
Yeah. Well, when I'm talking about stablecoins, Andrew, also let me be really clear. I'm really talking about fiat-backed, one-to-one, dollar-backed, or fiat currency-backed stablecoins. I'm not talking about algorithmic-backed stablecoins, although a really interesting idea.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, India's retail investors are all set to get a brand new asset class to invest in. This new product will be a bit more sophisticated perhaps than regular mutual funds, but hopefully not as complicated as PMS or AIF products. I'm talking about an asset class that will be known as the specialized investment funds, an asset class that will look to bridge the gap between mutual funds and products like PMS, which is Portfolio Management Services, or AIFs, which are alternate investment funds. Now, we have to discuss what the risks are, what are the tax implications, what are these new, more sophisticated strategies involved, and should we investors really care? Well, to do this, I have two very special guests with me in the studio, Radhika Gupta, MD and CEO of Edelweiss AMC, and Swaroop Mohanty, Vice Chairman and CEO of Mirai Asset Managers. Thank you so much, Radhika and Swaroop, for joining in. It's a pleasure to have both of you in person with me in the studios. And with your presence together, I know this is an exciting moment for investors. What are we looking at? Lady, let's start with you.
Thank you. It's lovely to be here. I think, I usually have more mixed opinions about new things that are launched. But with the SIF launch, I am reasonably bullish. You said it's a middle path between MF and PMS and AIF. I actually think that for the consumer, it brings the best of both worlds. And I came from an alts background, so perhaps this is closer to heart, but I think what PMS and AIF offered is flexibility in investments, flexibility in subscription redemption, how you use credit, how you use derivative. But what mutual fund offered was comfort. People are comfortable with the structure. You can do SIPs, huge sense of tax advantage. The consumer doesn't pay any tax. I think SIF gives you the flexibility that AIF and PMS had, with all the comfort that mutual funds have. And the 10 lakh ticket size, I really think opens this up to consumers, a much wider range of consumers, because when you were talking AIF, you were talking 1 crore investor, which means someone with 10 crore net worth to hoga, because you won't put more than 10%. So that versus someone with a 1 crore net worth, I think the ambit of people that we can speak to is very good. So I think in India's asset management evolution, you saw the evolution of passives, multiple investment styles, smart beta. I think this is a welcome step in the evolution, and I'm glad the mutual fund platform has been chosen, because it's a platform people have gotten comfortable with.
Okay. Well, the objective is to make it as simple as possible for people to understand, because there are nuts and bolts and nuances of this new product. Swaroop, what are your opening thoughts? Do you see this as a big stepping stone, or well, it'll be one more product that AMCs offer?
No, it's a step forward, both for the investor as well as the asset manager. I mean, look at it, we are graduating forward into a slightly more evolved space. I won't say complicated or easy space, but for an asset manager, it's great to start expressing ourselves into new areas of investments. The regulations have made it far more broader than what we used to do. The risks are very different, so how we manage it, how we look at the whole space will be different to each fund managers. And I think it's the emergence of style-based investing coming out from each fund houses. So it's a great platform to express our backend to the investors. At the same time, from the investors' perspective, and I say this with all humility, when I look at the last 2-3 years in particular, when return chasing has become so blatant, risk understanding needs to go up. Finally, you start your investment journey thinking it's a process of return generation, but it's a process of risk mitigation. I think this will set the tone for people to understand risks more, and the safer or the better approach to risk will be a better approach to investing. So it's a great step forward, and I echo what Radhika says, and it's fantastic that mutual funds were considered to be this vehicle for the future.
To offer this new product. So I think the first checkpoint, I think we've all taken note of, that you need to have a minimum investment threshold of 10 lakh rupees, which is not too much if you're looking at the mass affluent, households of India. Most of us are investing, that amount or maybe higher across mutual fund schemes. But let's understand the nuts and bolts of this product. So what the original understanding was that this product, the SIF, will have more flexibility in terms of taking long short strategies, more derivative positions, something known as naked shorting in the market. Radhika, if you could just expand on this, what are some of the basic differences, say, or in architecture perhaps, between regular MFs and this new product?
So I think there are three differences that consumers should know about. One is derivatives. Now, mutual funds were allowed to use derivatives. It's a myth that they were not. Arbitrage funds use derivatives, balanced advantage funds use derivatives, but they use derivatives for the purpose of hedging. They don't use the derivatives for the purpose of expressing a view. So if I was long stock A by 50 rupees, I had to be short stock A by 50 rupees in absolute amount. Now I can be short stock B by 10 rupees, up to the tune of 25%. So in that sense, I'm allowed to express a negative view or use derivatives beyond the purpose of hedging. So that, I think, is the number one flexibility. So suddenly, if you look at the SIF categories, you take a category which was a normal flexi cap category, but you are allowed to apply derivatives. You take a category, they've got one called X Top 100 Long Short. It's like a mid and small category of the old mutual fund, but suddenly I can express a view that is negative.
And this is capped at 25%,
25%.
Right? The total short position, so to speak.
Is capped at 25%.
Okay.
So that's one. The second flexibility is around exposure to credit. Now, most of the conversation around SIF has centered around equity, long, short, etc., which is okay. But there are substantially larger relaxations for credit, which is a good thing. And maybe you will see the revival of credit funds post 2018 in some format. We saw the private credit industry grow in a big way. The third, which is related to both of these, is that mutual funds are daily subscription and redemption instruments. Here, depending on the category, you don't have to provide daily redemption. The asset manager can choose to provide bi-weekly redemption, or in the case of a fixed income fund, weekly redemption. So many of the issues of the old of having illiquid credit but having daily liquidity perhaps can be mitigated more sensibly.
To simplify this, what it means for me, the investor, is that there could be products which don't allow me to redeem on a daily basis. It could be perhaps once a week or once a fortnight.
And which is why it's very important in SIF, and we can talk about this more, to read the risks and understand the fine print, because it will not be the same.
No, absolutely. In fact, we should try and flash that. I have that disclaimer that the regulator has also put out. I'll read this out since we're just starting the conversation. Here's what SEBI is saying, and there's a mandatory disclosure that will go with all of these new funds. Investments in specialized investment funds involve relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all the investment strategy related documents carefully before making the investment decisions. I've taken more than 30 seconds to say it for sure. So, Swaroop, come in on this. I mean, and expand on some of these points, that there are more sophisticated strategies, some of the derivative strategies that Radhika alluded to. From an investor's perspective, I'll say, "Kyun karna hai? If I'm getting more return, to theek hai. Otherwise, why do it?"
See, at this moment, forget SIFs. If somebody is not investing, it's that person's problem. It's probably the best phase of the country, and the best way to get that growth of the country into a person's portfolio is probably the capital markets, right? And this offers a far evolved position, like I've been using the word evolved, for the investor. Now, a lot of investors have different risk profiles, right? And this is a product which is catering to a slightly evolved, somebody who's been investing for 20, 25 years in mutual funds for that, can look at these in a far graded manner than they used to. Now, here's the thing. Now, suppose the flexibility is for 25%. We need not go 25%. Now, suppose the option is to go 12% in lower credit rating papers. We need not go 12%. Each fund will have its own way of expressing that same risk profile to the investor. And hence, the need for the investor to read a little bit more about this is very important at the beginning of this journey. And once that, and it's not rocket science to understand all this, okay? Guys like me will come and pose that it's a rocket science vehicle to make ourselves more important, but just a little bit of reading can ease out a lot of things. What can happen through these products will be far more evolved than what we've put on place in mutual funds is a submission.
So derivatives is one important aspect that Radhika touched upon. I believe that there is a greater exposure that these funds can take in REITs as well. For instance, REITs in REITs. Anything you want to add?
All those exposures have doubled. I mean, 20% we can go up to.
Yeah. Okay.
And that's why the flexibility on redemptions.
Yes.
Some of the underlying assets need not be as liquid as we have to take on the mutual fund side, because we have to give redemptions on a daily basis. And that gives the difference of flexibility to the fund management. Okay. One can dig deeper into these papers and hence aspire to give a higher yield, right? And that's where the maturity of the product comes in, and it's up to the investor to understand why the need for periodical redemptions. It's for the betterment of the investor. See, in any portfolio, there are three types of investors. The investor who's coming in, the investor who's there, and the investor who's leaving. The fund manager has to be fair to all three at all point of time. Now, if the product is at the underlying is a little bit illiquid, then the person should be able to sell it, realize that value for the person who's going out, and also for the essence of investors who stay back. So all these have been thought through, and what has come out is a far suitable product for the underlying product, for the portfolio from an investor's perspective.
Okay, I want to quickly go over the categories, the strategies that the regulator is allowing. Like that, for mutual funds, there could be one large cap fund, one mid cap, one small cap. So regulators very clearly defined what kind of funds can be launched by AMCs on the mutual fund side. Similarly, now they're talking about very specific strategies that can be launched within an SIF. So let's start. So equity oriented strategies, debt oriented strategies, and hybrid strategies, similar to mutual funds. So Radhika, let's start with the equity oriented strategies. What are we talking about here?
So I would just break this if you just look at mutual fund parlance to simplify. They have equity. Now they have three categories. They have an equivalent, or they have something called equity long short. What is that to me? That is a flexi cap fund in the mutual fund world with additional flexibility around derivatives.
Okay.
You can go everywhere, but you can also use derivatives.
Okay.
Then they have a category called X top 100.
X top 100 long short.
Long short. Now again, that is your mid and small cap. You used to have, we have mid cap and small cap. We used to have a mid and small cap category in mutual fund. We used to run one fund. That's mid and small cap. So you buy beyond the top 100, but you have the flexibility to short. I want to add one point to what
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. The Israel-Iran war enters the second week. Trump buys 2 weeks' time to decide whether or not to plunge the United States into the heart of the conflict. Ministers from the European Union and Iran set to hold talks in Geneva. Stocks rebound across the world as Trump delays Iran decision. Sensex and Nifty gain 1% this week thanks to Friday rally. Crude oil prices cool after rising 10% this week. India and European Union are working towards a full substantial free trade agreement by the end of 2025 and not an interim deal. EU ambassador calls India to ease tariffs on automobiles, pharma and alcohol, says EU will not drop the carbon tax, calling it an integral part of climate action. That's an exclusive. DMK MP Dayanidhi Maran sends a legal notice to brother and media baron Kalanidhi Maran alleging fraud and money laundering, demands restoration of a 22-year-old ownership structure. Sun TV calls it a personal matter between promoters and all legal obligations were met before listing. After TCS, Andhra government sold over 21 acres land in Visakhapatnam to Cognizant for a token lease price of 99 paise. Cognizant commits to invest close to 1,600 crores to build an IT campus in the city, which is expected to generate around 8,000 jobs over 8 years. 220 victims identified so far, 8 days after the Ahmedabad Air India plane crash that killed 241 out of 242 people on board. Air India cancels 8 flights, citing enhanced maintenance and operational reasons. 4 of them were overseas flights. Growing fears over the Dharavi redevelopment project as nearly 1 million residents could be pushed out along with their livelihoods. The Adani Group is leading the 95,000 crore rupee project to revamp one of the world's largest slums in Mumbai. The Bombay High Court terms deaths of commuters on Mumbai locals alarming. This after Railways filed an affidavit showing 3,588 fatalities in 2024 alone. This amounts to 10 deaths on average every day. 16 billion passwords and login credentials have been leaked online, according to a Forbes report. This includes user accounts on Google, Facebook, Apple, among others, in what is possibly the biggest data breach in history. All right, our top focus, the conflict between Israel and Iran has entered the second week, with both sides continuing to exchange heavy fire. The Israeli military has said it attacked dozens of military sites in Iran overnight, added that over 60 fighter jets struck dozens of military targets using approximately 120 munitions. The military added that several industrial sites used to manufacture missiles were struck in Tehran as well. They claim that these sites served as a key industrial center for the Iran's defense ministry. Tel Aviv also claimed that Iran fired cluster bombs at Israel with an aim to increase civilian casualties. Israel, meanwhile, bombed a northern Iranian city. The attack caused a massive explosion in the area, prompting people to evacuate the region immediately. Israel's strike also reportedly hit the Safed Road industrial park located in North Iran. Reports suggest that Iranian missiles targeted Israel's tech park in Beersheba that also housed Microsoft's office. Plumes of fire was reported outside the tech giant's office, while residential buildings also suffered significant damage. As per the Israeli emergency services, 5 people were reportedly injured and were taken to a nearby hospital. Meanwhile, Israeli Defense Minister issued a stern warning to Hezbollah for extending its support to Iran. This comes after the head of the militant group vowed all forms of support to Iran in its war with Israel. Foreign ministers from the UK, France and Germany are set to meet their Iranian counterpart in Geneva today to try and find a way to de-escalate the situation. The meeting comes after US President Donald Trump set a 2-week deadline to decide whether the US will join Israel's war against Iran.
Now, regarding the ongoing situation in Iran, I know there has been a lot of speculation amongst all of you in the media regarding the president's decision-making and whether or not the United States will be directly involved. In light of that news, I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks." That's a quote directly from the president for all of you today. So the president is always interested in a diplomatic solution to the problems and the global conflicts in this world. Again, he is a peacemaker in chief. He is the peace through strength president. And so if there's a chance for diplomacy, the president's always going to grab it. But he's not afraid to use strength as well, I will add.
One should not forget that the EU has been in negotiation with Iran on its nuclear program for years. That was called the JCPOA. Unfortunately, this preferred way of actually reaching a deal never materialized. The EU has made its position very clear that Israel has a right to defend itself, that we've continually said that Iran was not compliant with its own obligations under the Non-Proliferation Treaty, and that there is still a window for diplomacy, and that Iran would be well advised to seize that window for diplomacy.
We as a country, we as a free nation, we expect the other free nations and other countries to condemn these vicious actions, these unlawful military attacks against civilians, against the children, women, in order to make them stop this aggression.
Sensex and Nifty witnessed healthy gains in today's trading session, with frontline indices rising more than 1% each. Nifty closed above the 25,100 mark after 6 trading sessions for the week. Today's gains helped market regain losses of last week. Sensex and Nifty rose more than 1% each, while Midcap slipped 1%. From currencies to commodities, crude prices softened, with Brent falling nearly 2%. The gains were trimmed after the White House delayed a decision on USA's involvement in the Israel-Iran conflict. Remember, oil prices surged amid fears of increased US involvement in Israel's conflict with Iran. However, prices are still on track for a third straight week of gains. Onto a money control exclusive, DMK MP Dharavi Maran has sent legal notice to his brother and Sun TV chairman Kalanidhi Maran. The MP has alleged that his elder brother executed a fraudulent scheme to take control of Sun TV after their father's death in 2003. Sun TV has called the issue the promoter's personal matter. The network shares declined 4% in trade. Money Control's Chandra Shrikant is here with more.
Sun TV shares are in focus after Money Control's report of a feud between the Maran brothers, Kalanidhi Maran, the chairman of Sun TV, and his younger brother, Dayanidhi Maran, former union minister and currently a DMK leader. Now, Sun TV has clarified to exchanges that this is a family matter and will not impact the day-to-day functioning of the company. They've also said that some of these allegations in these media reports are inaccurate and misleading. Now, why is Sun TV in focus? Well, Dayanidhi Maran has sent Kalanidhi Maran a legal notice accusing him of indulging in fraudulent practices over the last couple of decades to wrest majority control of Sun TV. Remember, Kalanidhi Maran is a 75% owner of Sun TV network, one of India's most profitable listed media firms, and he's one of India's also richest entrepreneurs with a net worth of over $2 billion. Now, in his legal notice, Dayanidhi Maran has threatened to invoke action by various regulators, including the SFIO, to DGCA, to other agencies, if Kalanidhi Maran does not restore the original shareholding that was there in 2003, when the Maran and the Kalanidhi families had 50-50% in the present Sun TV. So we'll have to wait and see how this proceeds. But for now, Sun TV clarifying to exchanges after their shares were trading lower in the day that this is purely a personal matter, a family matter, and will not impact the operations of the firm.
Right, thank you, Chandra, for that. The Andhra Pradesh government has sold over 21 acres of land in Visakhapatnam to Cognizant for 99 paise. Now, this move comes a couple of months after the state government inked a similar deal with TCS. Shilpa Ranipeta joins us now for more. Shilpa, please take us through the contours of this deal.
Well, you know, after Tata Consultancy Services, it's now Cognizant that's getting land from the Andhra Pradesh government for just 99 paise. The government has sold over 21 acres of land in Visakhapatnam to Cognizant to set up a large development center. Now, as per lease terms, Cognizant will invest 1,582 crore rupees over the next 8 years. Now, the company is expected to generate over 8,000 jobs through this project, and the campus is likely to be operational by March 2029. Now, first TCS and now in April and now Cognizant in the same area. This move is part of the Andhra Pradesh government's broader push to turn Visakhapatnam into a major IT destination. TCS, if you remember, had committed 1,350 crore rupees and promised to create 12,000 jobs in the same area in Visakhapatnam. Now, while experts have questioned the revenue implication of leasing prime land at token rates, especially when the state is reeling under high debt, the state is actually betting on long-term economic gains, job creation, infrastructure development, and positioning Vizag as a credible alternative to traditional IT hubs like Bengaluru, Hyderabad, and Chennai. Back to you.
All right, thank you, Shilpa, for that. Shifting focus now, India and European Union are working towards a full, substantial free trade agreement by the end of 2025. And not an interim deal. That's the word coming in from the EU ambassador to India. In an exclusive conversation with CNBC-TV18, Ambassador Irv Delphin called upon India to ease tariffs on automobiles, pharma and alcohol. He also said that EU will not drop the carbon tax, calling it an integral part of climate action. Take a look.
We have been getting reports that while we want to complete a full trade deal with the European Union by the end of the year, both sides may also have an early trade deal, an interim trade deal by July. Is there an ambition to do that? Are we close to that?
I think the July deadline seems to apply to another geography rather than to the EU. I think the message of our leaders, as I mentioned, was very clear by the end of the year. So what matters most for us is not the fast and furious, and is a steady and progressive negotiation that really brings tangible results. I think most important is the substance of this trade deal. So we are not somehow bound by any artificial deadline by July or other. That doesn't really concerns both the EU and India in their relations. So I think we are comfortable with the pace, with the intensity, the focus of the negotiation as we have them, and I think both sides are really determined to have really something substantive.
CBAMs and deforestation regulations, India has been seeking a carve-out from that. In fact, according to certain reports, Indian government is even mulling retaliating in case that CBAM tax, carbon tax, is imposed on Indian companies. This will only go into effect in January next year. Is there any possibility, any discussion for a carve-out from India, for India?
Based on the feedback that we receive from different constituencies and private sector, we have moved and gone through what we call a simplification package of the CBAM, which just this week there's been an agreement between the Council and the Parliament on this CBAM simplification package. So what we want to do is to come back to the Indian partners and stakeholders to explain what it is. And indeed, the Federation of Industry in India, FICCI, has been a partner in that, in trying to bring the conversation, and we will have this interaction with the Indian private sector early July. And I think that will help also to pave a way forward. And last, I would like to point out that CBAM, or the equivalent of CBAM, has been taken out of the FTA with the UK. And we have always made the point that CBAM is not a trade instrument. It is an instrument which is part of our climate agenda action. So I think all these elements should point towards a position of the EU where we are confident that we can address the issues that India has with CBAM, but outside the FTA.
The price band for HDB Financial's public issue has been set at 700 to 740 rupees a share. The company plans to raise 12,500 crore rupees and will open on the 25th of June and close on the 27th of June. The company's public offering will be the largest since Hyundai Motor India's 27,000 crore rupee IPO. 8 days after the Ahmedabad Air India plane crash that killed 241 out of 242 on board, 220 victims have been identified so far. 202 bodies have been handed over to their families. Air India has cancelled 8 flights, citing enhanced maintenance and operational reasons. 4 of them are overseas flights. Madiha Mujawar is here with more on this. Madiha.
Well, there are planned cancellations till mid-July, and then there are also daily cancellations due to the enhanced maintenance and operational reasons. So first, about planned reductions, Air India has announced a significant scale down of its international operations. The airline will be cutting 48 flights per week until mid-July, and this includes a complete suspension of routes like Delhi, Nairobi, Amritsar, London, Gatwick, and Goa, London, Gatwick until the 15th of July. 38 flights have been cancelled to routes including North America, Europe, Australia, Japan and South Korea, and these flights are operated by the Boeing 787 and Boeing 777 aircraft, the ones that are currently undergoing safety inspections following the tragic AI-171 crash that was also operated by the 787 Dreamliner. So besides the enhanced pre-flight safety checks, Air India says that reductions in flights is also to accommodate airspace closures in the Middle East and the Pakistan airspace closure, which is requiring Indian airlines to take longer routes to Europe and the North American destinations. Now, on daily flight cancellations, which are separate than the planned ones, Air India cancelled Dubai to Chennai, Delhi to Melbourne, Melbourne to Delhi, Dubai to Hyderabad flights on international routes. In domestic flights like Pune to Delhi, Ahmedabad to Delhi, and Hyderabad to Mumbai and Chennai to Mumbai have also been cancelled, and there could be more additions to these daily cancellations as we speak.
All right. Thank you, Madiha, for that update. On that note, we'll step into a short break. Coming up next, growing fears over the Dharavi redevelopment project as nearly 1 million residents could be pushed out along with their livelihoods. More on that when we return. Welcome back. Finance Minister Nirmala Sitharaman has flagged the growing gap between the detection of tax leakages and recoveries. Sources tell CNBC-TV18 that tax authorities have been urged to take steps to increase the amount recovered after evasion has been detected. Timsy Jaipuria has more. Timsy.
Well, that's right. Sources have told CNBC-TV18 that CBIC's two-day brainstorming conclave has ended, and Finance Minister, in her address to the field formations, has pushed officers to improve leakage recovery ratio. Finance Minister flagged the growing gap between detection of tax leakages against recoveries. Just to give a sense, what is this particular area? Well, the GST audit data pegs that pan-India recovery is at just 4,000 crore rupees versus a detection of leakage of about 34,000 crore rupees. Also, the GST audit data of the taxpayers which are under CGST regime is showing that the highest tax evasion was detected in Chennai, followed by Mumbai, Bengaluru and Hyderabad. Also, the data suggests that in FY24, enforcement arms under GST detected tax evasion, which was worth just a little over 10% of total tax collections. Further, in her address, Finance Minister pushed for faster cargo clearances by Customs Department across land, sea and airports. Also, she asked CBIC officers to identify pockets of high cash transactions and to convert them into formal economy. She also emphasized that the CBIC officers should ensure integrity of tax department is impeccable and unquestionable. She said that CBIC should speed up vigilance cases pending against officers for swifter justice. Also, Finance Minister asked CBIC officers to work towards addressing taxpayers' concerns, bringing in ease of doing business and grievance redressal as the key action points for the next coming quarters of this fiscal. Back to you.
Right. Thank you, Timsy, for that. Moving on, the master plan is now in place and the world's largest urban renewal project is ready to begin. But the 95,000 crore rupee plan to revamp Dharavi, one of the world's largest slums, is not being welcomed by everyone. CNBC-TV18 Shilpa Ranipeta reports that on the ground, there's growing fear that many of its nearly 1 million residents may be pushed out and their livelihoods with them. Take a look.
I'm standing in the heart of Mumbai in Dharavi, Asia's largest slum. It is a maze of lanes, by-lanes, alleyways. It has homes, it has workshops, it has shops. It is full of life. It is also one of the most valuable, fiercely contested and densely populated pieces of urban land in the world. And it is all set to change forever. Approved in 2022, the Dharavi redevelopment project promises to transform this city within a city. The entire project spans a gross area of 251 hectares. Of this, around 109 hectares have been marked as developable land. The remaining space is to be set aside for roads, public amenities and civic infrastructure like drains and high-tension power lines. The project is being executed by Navbharat Mega Developers, a joint venture between the Slum Rehabilitation Authority and the Adani Group. So far, over 4,500 crore rupees have been invested in both land acquisition and in the construction of around 1,000 homes and amenities on land handed over from the Indian Railways. At its core, the redevelopment plan is about the rehabilitation of Dharavi's nearly 1 million residents. But residents complain that the current master plan involves the construction of only 72,000 units. Around 58,500 of these will be residential units. This assumes that the population in redeveloped Dharavi will be around 4.85 lakh people, including the people who buy land or units that are eligible for sale.
यहाँ पे टोटल 1,15,000 से ज़्यादा रेसिडेंशियल और कमर्शियल है। यहाँ पे जो उन्होंने किया है वो अदानी के फ़ायदे के लिए जो 72,000 बोला उसमें रेसिडेंशियल भी है कमर्शियल में, वो उनका जो नंबर है वो बहुत गलत है।
खाली सुन में आ रहा कभी भी तोड़ना चालू कर देंगे, स्टैम्प मार के चले गए हैं तो हम लोग कहाँ जाएंगे? बच्चों का स्कूल कॉलेज यहीं पे है, कहाँ जाए कैसे सेटल करेंगे? सब बहुत प्रॉब्लम आ जाएगी, इसलिए हम लोगों का मतलब रिक्वेस्ट है कि यहीं पे दिया जाए।
The eligibility criteria of being assigned a home in redeveloped Dharavi is another bone of contention. Only people living in the ground floor residences with documents proving that their occupancy predates the year 2000 are eligible for free in-situ rehabilitation. Those on upper floors or those who do not have papers to prove occupancy will not get homes.
हमको नहीं चाहिए, हमको एक ही घर धराई में ही चाहिए, बाहर हमको नहीं चाहिए।
वहाँ देवनाथ डंपिंग में जाना तो वो हम लोग को गंवारा नहीं है, वैसे भी मरना है। डेवलपमेंट के बिल्कुल खिलाफ नहीं, लेकिन हमको हमारा घर धराई में मिले।
हम लोग डेवलपमेंट के कोई खिलाफ नहीं कि किसी लड़ाई हो रही है। मैं तो बोलो यहाँ पे इतना सारा फैक्ट्री चल रही है, काम है, यहाँ पे लोग इतना कमा धमा रहे हैं, यहाँ पे सबको उजाड़ दोगे, दगा भी नहीं दे रहे हो किसी को, सब उजाड़ के फेंक दोगे तो लोग जाएंगे कहाँ?
But SVR Srinivas, the CEO of the project, says residents not eligible for new homes have an option.
So for those ineligible, the government has decided they'll be given houses in hire purchase format, initially in the form of rental housing, but in the due course they can purchase the house also.
Dharavi is also a commercial hub for Mumbai. From leather to garments to food processing and recycling, thousands of small businesses operate here, forming an informal economy that's estimated at over 7,000 crore rupees. Residents fear that the redevelopment will destroy livelihoods that have thrived for generations.
अभी जो मास्टर प्लान बना कुछ दिया ही नहीं कि कहाँ देंगे जगह कमर्शियल की। अभी एक यूनिट में आप देखोगे ना तो कम से कम 30-30, 40-40 जन है। अब 40 अगर एक फैक्ट्री में 40 आदमी है तो उसके पीछे एक फैमिली में 5 जन पकड़ो
तो कितने लोग इस पे चल रहे हैं, लाखों लोग मतलब पल रहे हैं धारावी से। और ये धंधा कहीं और सेटअप जाएगा तो ये बर्बाद हो जाएंगे सब बिजनेसमैन लोग यहाँ से। नवी जगह जाके धंधा सेट नहीं होएगा।
The administration, however, says these fears are misplaced.
Those who are inside in the commercial units inside Dharavi, they are ineligible. They will be given tenements from out of a 10% quota commercial space we have kept in each building.
But as the ambitious project takes off, it's the lack of trust that's defining the mood on the ground. In Mumbai, Shilpa Rani Peta.
And with that's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
It gives me great pleasure to welcome here on Voices from the Valley, someone who's been a mentor to us, a mentor to Young Turks, and someone I've had the privilege and the pleasure of speaking to in the past. He is, of course, well known as the father of the Pentium chip, but more importantly, he's a man who's had his eye and his pulse on changing technologies, and we are at a crossroads at an intersection of a pretty big tech change. So it would be nice to hear his views on that. He's also just been awarded India's highest civilian honor, the Padma Bhushan. Vinod Dham, ladies and gentlemen, thank you so much for joining us here this evening. May I request you to join us up on stage and get the event started. Thank you so much, Mr. Dham. It's an absolute pleasure to have you here with us. Ladies and gentlemen, a big round of applause. So let me start with that. What was it like being in Rashtrapati Bhavan, getting the Padma Bhushan, Mr. Dham? You've got the microphone right next to you.
You know, I was getting goosebumps twice.
once when the President of India enters the Darbar Hall, and you're all seated, and they play the drum a little bit, and then all Jan Gan Man, our national anthem. Somehow, growing up in India, right from the first, second grade, like most of us, you had heard it, you had sung it, and now here we normally don't sing it. And when you go back and it happens, it really brings a lot of emotions back. And that's what happened to me. I mean, it's a beautiful building. I shouldn't call it a building. I don't know what the right word would be. And interior is, enormous. And the whole thing was done with a lot of pomp and show. The presence has a lot of these well-dressed, I don't know, they are Army, Air Force people standing behind. And of course, Modi ji is also there, and the Home Minister is there. And I must tell you, this happened on the day after or 2 days after the whole unfortunate incident in Kashmir. And I think maybe the same day. And I was just going to be taking my flight from San Francisco, and the limo was going to come pick me up. And my wife and I were going to go to this ceremony, and she just said, "What if they cancel it?" And I said, "Yeah, there's a chance that they might." And luckily for me, I called the Home Ministry, the contact I had there, and he said, "Please take the flight. There is no way it's going to be canceled." And I must say that even during the interactions that I had with Prime Minister Modi that evening, which the Padma Bhushan gets an extra time with him after the photography session, I was looking for some sign of stress or, concern or anxiety or rush. No, not at all. Not only he spent adequate time with each one of us, and we were in Ashoka Hall at that time taking photographs, but there was a annex where all the guests, like my wife and my brother who were there, were to wait for us to come have snacks. And they said that he made it a point to go to that entire hallway and meet all the guests as well, which is just remarkable. So I'm sold on that man. If there are people here who don't like him, I apologize to them. But I just always pray that he lives long enough and really puts us back on a track, because a country like ours has been off track for a very, very long time. And then sometime it felt like it's coming on track, and then he'll go off track. We need somebody to stay there long enough to really keep it on the track so it stays on track no matter what happens in the future.
Well, we'll talk about the AI track and the semiconductor track in India in just a bit. But, what a journey it's been for you, coming to the US with $8 in your pocket to now being awarded the Padma Bhushan. Did you imagine such a future for yourself?
Well, no, I didn't. But I must say, the reason I came with $8 was my stupidity. Not that I didn't have more money or I couldn't afford to have gotten a little bit more exchange if I needed to. I had applied, it was typical back in the 70s. You apply to the campuses, and once you pick where you want to go, and I picked University of Cincinnati because they had a semiconductor lab which had more sophisticated equipment than the semiconductor company I was working in India. You could go from literally cutting a ruby, which is almost like making a mask, to fabricating the entire wafer in the lab, on the campus, packaging it, and then testing it. I mean, it was unthinkable. So that's why I picked them. And they were writing to me for a year and a half, and somewhere I read that you have free tuition scholarship, and you have an assistantship for $325 a month. Then I told my mom, I said, "Oh, I don't need any money. I just need enough money to go from here to there." And the government of India could only give you $8 then anyway, although I could have probably used some contacts to get some more money exchange, but I felt no need for doing that. So I come down here, I go to meet with the foreign student advisor, Mrs. Mary Campbell, and by the way, like some of you, when you're that young, in your early 20s, and you come and you have corresponded with Mary Campbell for a year and a half, you have some imagination about who she would be, how she will look like. There's some kind of a secret about feeling. So I had this lot of expectation I'm going to meet Mary Campbell finally. And of course, she was a wonderful petite lady from South Carolina with the southern accent, and I had my Indian accent. You can imagine how beautiful this country is. They don't really mind any accent. And I sat down and she said, "How was your flight? How was your journey?" I said, "Everything was fine." And then she's expecting me to get up to leave because there are other foreign students too waiting to meet her. And then she looks at me and says, "Something wrong?" I said, "Yes, ma'am." She says, "What?" I said, "I just arrived yesterday and I found out that the efficiency will cost me $90, which is a room that you share with somebody. And the health insurance is $10 per month. That's 100. And I assume I'll need a little bit more money to survive with food, right?" So she gave me $125 from what she said to me, and I didn't know what the meaning of that word was back then. She went to the other room and came out and gave me in $20 bills and a $5 bill, $125 cash, and said, "Return it at $25 per month once you start making your money." And it's from the petty cash. And I had never heard of what a petty cash is, but I didn't care. I said, as long as I have this money and I can go eat a hamburger for lunch, hamburger for dinner, I am fine with it.
Well, speaking of petty cash, let's talk about what's happening with the AI race today. And I know that you were in India. You've been talking to the Indian government about what it intends to do as far as the semiconductor mission is concerned. We've finally gotten started. Speaking of putting things on track, do you believe we're on the fast track? Do you believe we're in the slow lane today?
You're talking about now
India.
the semiconductor
Yes.
mission or AI and semiconductor mission
Well,
and the general?
AI and semiconductor both, because they are kind of converging together.
So we started off with a bang on semiconductor. So we literally, my idea and suggestion that they followed was that we need to have a semiconductor fabrication facility, and we don't need 2 nanometer. At least let's get started with 65, 40, 20. And if you can get to 14, that's good enough because a lot of products can be built on that. And we should have one packaging capability. So to that extent, they have, by the way, 6 different programs going on at different stages of the thing. But I think we still need more, in my opinion. And somehow I feel we are not as aggressively pursuing it as we were initially because there was something new about it.
Yeah.
So maybe I need to go back and really push a little bit harder.
What would you like to push harder, though?
I think what we need, of course, this particular fund, we had an outlay of $30 billion. I think they consumed bulk of it. There's some more need to be done. And we are in the process of creating what we call ISM 2.0, which is India Semiconductor Mission 2.0, where we want to do things slightly differently now that we have learned what works and doesn't work, and allocate perhaps even more money for some of the program. And particularly AI is very dear to me. And I look at AI as part of really deep tech. To me, a lot of the engineers here are basically, I'm going to assume, are software people. And when they talk about AI, they only think of AI like the AI stack. And they talk about AI stack in terms of software and algorithms and applications. To me, they forget AI cannot exist without the underlying chip that we build, right? So I built the Pentium and 486 and 386, and now those are called Blackwells and Hoppers and things like that. Not much different, just a different breed of things in different time frame. That is a very essential element of really for India to succeed in AI race. And to succeed, right now we don't build those GPUs ourselves. Although I would love to see India make its own GPUs. And I'm personally quite engaged in that process of making sure we have that capability and capacity. As you know, AI has become an arm race. And
you almost liken it to a nuclear arms race.
That's right. It's even more specifically, the chip is the fuel, the uranium that's needed, which is hard to procure, and all the countries want to keep it themselves. And that is the GPUs. And that's why I think it's important that just like India finally broke out and created its own nuclear bomb, the atom bomb, they need to really figure out a way to make this own GPU. And clearly we need all the help from USA, because even to make the GPU, designing GPU is one thing. To fabricate GPU, we do need very advanced equipment at some point. And we would need okay from America to really, because America is the farthest in this race and really own, basically, I would say, bulk of the semiconductor world. Even though most of the semiconductors are made outside of America and they're coming back, the fact very few people know is that USA still holds key to the key elements of it, and not only in equipment, but the GPU intellectual property too. And that's why they are, waxing their muscle, flexing their muscle quite a bit with China, as you know, in terms of what they can get and not get.
Geopolitics is going to weigh on some of the decisions that take shape within this space, whether it's semiconductors or AI. You talked about the US and China and export restrictions and export controls that are currently in place already. But, you've got the rare magnet situation with China flexing its muscles on that front as well. Given how geopolitics is playing out today, do you believe that a world where we could see deeper collaboration, even between allies and partners like India and the US, is a logical way forward? Do you believe that we're now going to see more deterrence coming in the way of this collaboration and partnership that was expected, anticipated, and hoped for?
So there are two elements to this arms race in AI. One is the word arm itself talks about the military side of things, like with AI, you have these killer robots, you have drone, you have autonomous anti-missile guns, all kinds of things that literally will give an edge to one country over the other country in terms of fighting military war. To that degree, I don't think there will be protection. So the answer to your question is, I think the countries like USA will be very careful about who they give the most advanced technology to, so that it doesn't get into the hands of someone where it becomes a problem for them, rightfully so. But the other side is AI is also an economic force, because it's going to completely change the way we live, the way we work, the way we deal with every aspect of our life given a certain year period of time. We already are beginning to see some changes in that. To that extent, I think the whole world should benefit from it. And therefore, the restriction should be much lower, if any, and there should be more free exchange, especially with, I would say, trusted partners like India, who is a trusted partner today. But, the way the U.S. government is today, what happens today can change with a tweet tomorrow. So.
Or later tonight.
Or later tonight, who knows?
Yes, who knows? But one of the other debates that's raging today, and I think many governments across the world are grappling with it, India certainly is grappling with it at this point in time, is should we invest our capital, our resources, our bandwidth in creating our own large language models or not? And I know that you have a point of view on this. There are both sides. Some sides argue that, look, let's play on the application layer. Others believe that, no, we must invest back a sovereign model. Which camp do you belong to?
I personally belong to the camp that, the large language models have become almost a commodity. There are quite a few players who have developed them. And I think going at this stage and creating that type of capability, just for the sake of creating our own unique capability, I don't think it's worth it. And there are a lot of open sources. We can take one of those and really build on that and personalize it, because we do have multi-languages in our country and we have our own culture. For example, we make a statement that nobody will ever say that in English. We are like that only. There's a book somebody wrote, and I had invited her to my fund annual event, and the title book was "We Are Like That Only." And she's explaining to all my audience, which are all Americans who had given me $200 million to invest, saying why we are the way we are. So we are unique, and therefore we will need something unique in our models to really reflect upon.
What could that be?
I don't know what could that be. That's just our regular behavior of the way we deal with every issue in life. First, we are most talkative people. So I think data will never be a problem in India.
Yes, we'll keep generating
Absolutely.
more and
they
more.
are having difficulty. They're creating synthetic data. I think if they go to India, they will never have a problem with creating any synthetic data.
Yes, that clearly is not going to be a problem. But, you talked about the social consequences, the economic consequences as well. And you believe that this is going to benefit the world in the long term. But in the near term, the fear and the trepidation around displacement, around job losses, around what this could potentially mean and do to societies, to people, how do you see this playing itself out?
So I must say that I come from a chip side, so I look at things really far more from the chip angle as to how fast is AI penetrating. To me, it's not just the large language models and various algorithms. It is to me also how the chips are promoting. So if you follow, I worked with Gordon Moore for 16 years, and late Gordon Moore, and he created a law called Moore's Law.
Yeah.
And the Moore's Law was an exponential law, which was based on an observation he made just over a few years, that the number of transistors you can put into a chip or die doubles every 2 years. Okay, this was just an observation, and it held true. He made that in 1965. It held true till almost the end of the 90s, and became Moore's Law. Now, if you look at what's happening with the, let's call it, what's his name, Jensen Huang's law. Now, Huang's law is just mind-boggling. I had difficulty even building the chips that are plotted on Moore's law, trying to mentally get my head around exponential nature of things in real life. They are doubling their performance every 3.5 months.
Yeah.
That means they are 7 times more than Moore's law. And if I take a very simplistic idea, we started 386 in 1985. To me, there were chips before that, 8086, 8088 that IBM had, and before that, Intel started with 4004, which really was the inventor of microprocessor. But it really became more mainstream at 386. And then Pentium made it a household name, so people started buying it home.
Yeah.
It took 30 years for their journey to take place. What we did in 30 years, we are now trying to do that in about 4 to 5 years. Now it brings back, if it is true, if my math is correct, it means we could be truly, in this decade itself, begin to see some big layoffs, especially from...
I wouldn't doubt your math. I don't think anyone here would doubt your math either.
And my rationale and logic, people may disagree with me, but I truly feel very concerned about the fact that, of course, we'll lose jobs. That everybody knows. The question is how soon, and are we prepared for that?
Yeah.
And if we are not, what are we going to do about it? So there's all this talk about tariffs and trade and interest rates and dollar and blah, 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 but nobody's talking about both. If we are that successful, of course, we'll have significant productivity improvement.
Yeah.
So our GDP probably will be higher, but we will have corresponding less need for people. What are we going to do with that is a much more serious issue in my mind, because, if people are idling, that's a very serious problem.
You know, if you had to start over today, and you are in many ways starting over by putting your money into startups that you're investing in, but if you had to start over today, what is the one problem that you would like to solve using all that we have by way of AI?
And the problem I'm trying to solve is to make a GPU, because it will be very unique, if not unreasonable, to have only one company make a GPU for the entire world, right? That just is not very practical, I think. But I truly believe that there is opportunity for more people. So that's where I am putting a lot of my time, energy, and money on.
As you look at what is happening in India today, as you look at what's happening in the US today, what would you say governments in both areas need to be mindful of? But more importantly, what do you believe entrepreneurs in India as well as the US who are betting on this next big tech change need to be mindful and sensitive of?
So there's a lady named Ramni Manian. She's in Chennai. And I met her. She did a similar thing with me 15 years ago. I met her then. I was in Chennai, so she held that thing. I said, what do you do? She was, at that time, GM, Ford, and all these automotive companies were coming to India. And she was teaching the American CEOs and the staff cultural sensitivity about India to make them more understanding of our culture. I think we need her to do something like that with the government of the United States today, because there is a goodwill, but they need to understand the sentiments, deep sentiments, like, as most of you know, recently in that Pak-India war that lasted a few days, who knows what the reality is, but the fact is, however it came out, it hurt deeply the sentiments on India's side. And I'm not sure they really fully grasp the depth of it and how it really changes a lot of things. Similarly, I think Indian government needs to understand when US says, we need your help, they mean it. And you need to really deeply think about not just that moment, but long-term, short-term, and around, and not just every time be coming across as a unreliable partner or not somebody they can truly bank on. I won't say unreliable, somebody they can truly bank on. It's a very difficult puzzle to solve. I'm not a politician and I'm not a diplomat, but I think, if anything, if those two countries can figure that out, I think a lot of things will flow much more smoothly than they right now do.
And the entrepreneurs, what should they be sensitive of?
I think the entrepreneurs are very smart on both sides. Actually, entrepreneurs in India are very well versed with what's going on here, by the way. I think, if anything, they need to be more sensitive about that there's a huge market. So this other company that I waited 3 years for a software guy to come through, and his biggest orders are coming from Philippines. And I don't know how the hell he went there and what he did there. But there are countries like Philippines, Malaysia, and Indonesia that have large populations. They need all the same technologies that India has. And the Indian entrepreneur who's constantly looking at US to sell things can also, I think, go there and maybe get initially it validated and get going there, and then come here with a little bit more confidence and more value than they do right now. I think that would be my reply to you.
Well, Vinod Dham, we are ever grateful to you for joining us here this evening and sharing your passion for India, for semiconductors, for technology, and for the partnership between India and the US. Ladies and gentlemen, Vinod Dham, thank you so much for joining us here this evening. Thank you so much, sir.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host Surabhi Upadhyay. Now, India's retail investors are all set to get a brand new asset class to invest in. This new product will be a bit more sophisticated perhaps than regular mutual funds, but hopefully not as complicated as PMS or AIF products. I'm talking about an asset class that will be known as the specialized investment funds, an asset class that will look to bridge the gap between mutual funds and products like PMS, which is portfolio management services, or AIFs, which are alternate investment funds. Now, we have to discuss what the risks are, what are the tax implications, what are these new, more sophisticated strategies involved, and should we investors really care? Well, to do this, I have two very special guests with me in the studio, Radhika Gupta, MD and CEO of Edelweiss AMC, and Swaroop Mohanty, Vice Chairman and CEO of Mirai Asset Managers. Thank you so much, Radhika and Swaroop, for joining in. It's a pleasure to have both of you in person with me in the studios. And with your presence together, I know this is an exciting moment for investors. What are we looking at? Lady, let's start with you.
Thank you. It's lovely to be here. I think, I usually have more mixed opinions about new things that are launched. But with the SIF launch, I am reasonably bullish. You said it's a middle path between MF and PMS and AIF. I actually think that for the consumer, it brings the best of both worlds. And I came from an alts background, so perhaps this is closer to heart, but I think what PMS and AIF offered is flexibility in investments, flexibility in subscription redemption, how you use credit, how you use derivative. But what mutual fund offered was comfort. People are comfortable with the structure. You can do SIPs, huge sense of tax advantage. The consumer doesn't pay any tax. I think SIF gives you the flexibility that AIF and PMS had, with all the comfort that mutual funds have. And the 10 lakh ticket size, I really think, opens this up to consumers, a much wider range of consumers, because when you were talking AIF, you were talking 1 crore investor, which
Minimum
means someone with 10 crore net worth to hoga, because you won't put more than 10%. So that versus someone with a 1 crore net worth, I think the ambit of people that we can speak to is very good. So I think in India's asset management evolution, you saw the evolution of passives, multiple investment styles, smart beta. I think this is a welcome step in the evolution, and I'm glad the mutual fund platform has been chosen, because it's a platform people have gotten comfortable with.
Okay. Well, the objective is to make it as simple as possible for people to understand, because there are nuts and bolts and nuances of this new product. Swaroop, what are your opening thoughts? Do you see this as a big stepping stone, or well, it'll be one more product that AMCs offer?
No, it's a step forward, both for the investor as well as the asset manager. I mean, look at it, we are graduating forward into a slightly more evolved space. I won't say complicated or easy space, but for an asset manager, it's great to start expressing ourselves into new areas of investments. The regulations have made it far more broader than what we used to do. The risks are very different, so how we manage it, how we look at the whole space will be different to each fund managers. And I think it's the emergence of style-based investing coming out from each fund houses. So it's a great platform to express our backend to the investors. At the same time, from the investors' perspective, and I say this with all humility, when I look at the last 2-3 years in particular, when return chasing has become so blatant, risk understanding needs to go up. Finally, you start your investment journey thinking it's a process of return generation, but it's a process of risk mitigation. I think this will set the tone for people to understand risks more, and the safer or the better approach to risk will be a better approach to investing. So it's a great step forward, and I echo what Radhika says, and it's fantastic that mutual funds were considered to be this vehicle for the future.
To offer this new product. So I think the first checkpoint, I think we've all taken note of, that you need to have a minimum investment threshold of 10 lakh rupees, which is not too much if you're looking at the mass affluent, households of India. Most of us are investing, that amount or maybe higher across mutual fund schemes. But let's understand the nuts and bolts of this product. So what the original understanding was that this product, the SIF, will have more flexibility in terms of taking long short strategies, more derivative positions, something known as naked shorting in the market. Radhika, if you could just expand on this, what are some of the basic differences, say, or in architecture perhaps, between regular MFs and this new product?
So I think there are three differences that consumers should know about. One is derivatives. Now, mutual funds were allowed to use derivatives. It's a myth that they were not. Arbitrage funds use derivatives, balanced advantage funds use derivatives, but they use derivatives for the purpose of hedging. They don't use the derivatives for the purpose of expressing a view. So if I was long stock A by 50 rupees, I had to be short stock A by 50 rupees in absolute amount. Now I can be short stock B by 10 rupees up to the tune of 25%. So in that sense, I'm allowed to express a negative view or use derivatives beyond the purpose of hedging. So that I think is the number one flexibility. So suddenly, if you look at the SIF categories, you take a category which was a normal flexi cap category, but you are allowed to apply derivatives. You take a category, they've got one called X top 100 long short. It's like a mid and small category of the old mutual fund, but suddenly I can express a view that is negative.
And this is capped at 25%,
25%.
right? The total short position, so to speak.
Is capped at 25%.
Okay.
So that's one. The second flexibility is around exposure to credit. Now, most of the conversation around SIF has centered around equity, long, short, etc., which is okay. But there are substantially larger relaxations for credit, which is a good thing. And maybe you will see the revival of credit funds post 2018 in some format. We saw the private credit industry grow in a big way. The third, which is related to both of these, is that mutual funds are daily subscription and redemption instruments. Here, depending on the category, you don't have to provide daily redemption. The asset manager can choose to provide bi-weekly redemption, or in the case of a fixed income fund, weekly redemption. So many of the issues of the old of having illiquid credit but having daily liquidity perhaps can be mitigated more sensibly.
To simplify this, what it means for me, the investor, is that there could be products which don't allow me to redeem on a daily basis. It could be perhaps once a week or once a fortnight.
And which is why it's very important in SIF, and we can talk about this more, to read the risks and understand the fine print, because it will not be the same.
No, absolutely. In fact, we should try and flash that. I have that disclaimer that the regulator has also put out. I'll read this out since we're just starting the conversation. Here's what SEBI is saying, and there's a mandatory disclosure that will go with all of these new funds. Investments in specialized investment funds involve relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all the investment strategy related documents carefully before making the investment decisions. I've taken more than 30 seconds to say it for sure. So, Swarup, come in on this. I mean, and expand on some of these points, that there are more sophisticated strategies, some of the derivative strategies that Radhika alluded to. From an investor's perspective, I'll say, क्यों करना है? If I'm getting more return, तो ठीक है. Otherwise, why do it?
See, at this moment, forget SIFs. If somebody is not investing, it's that person's problem. It's probably the best phase of the country, and the best way to get that growth of the country into a person's portfolio is probably the capital markets, right? And this offers a far evolved position, like I've been using the word evolved, for the investor. Now, a lot of investors have different risk profiles, right? And this is a product which is catering to a slightly evolved, somebody who's been investing for 20, 25 years in mutual funds for that, can look at these in a far graded manner than they used to. Now, here's the thing. Now, suppose the flexibility is for 25%. We need not go 25%. Now, suppose the option is to go 12% in lower credit rating papers. We need not go 12%. Each fund will have its own way of expressing that same risk profile to the investor. And hence, the need for the investor to read a little bit more about this is very important at the beginning of this journey. And once that, and it's not rocket science to understand all this, okay? Guys like me will come and pose that it's a rocket science vehicle to make ourselves more important. But just a little bit of reading can ease out a lot of things. What can happen through these products will be far more evolved than what we've put on place in mutual funds is a submission.
So derivatives is one important aspect that Radhika touched upon. I believe that there is a greater exposure that these funds can take in REITs as well. For instance, REITs in REITs. Anything you want to add?
All those exposures have doubled. I mean, 20% we can go up to. And that's why the flexibility on redemptions. Some of the underlying assets need not be as liquid as we have to take on the mutual fund side, because we have to give redemptions on a daily basis. And that gives the difference of flexibility to the fund management. One can dig deeper into these papers and hence aspire to give a higher yield, right? And that's where the maturity of the product comes in, and it's up to the investor to understand why the need for periodical redemptions. It's for the betterment of the investors. See, in any portfolio, there are three types of investors. The investor who's coming in, the investor who's there, and the investor who's leaving. The fund manager has to be fair to all three at all point of time. Now, if the product is at the underlying is a little bit illiquid, then the person should be able to sell it, realize that value for the person who is going out, and also for the essence of investors who stay back.
We're staying back.
So all these have been thought through, and what has come out is a far suitable product for the underlying product, for the portfolio from an investor's perspective.
Okay, I want to quickly go over the categories, the
Yeah.
strategies that the regulator is allowing. Like you know that for mutual funds, there could be one large cap fund, one mid cap, one small cap. So regulators very clearly defined what kind of funds can be launched by AMCs on the mutual fund side. Similarly, now they're talking about very specific strategies that can be launched within an SIF. So let's start. So equity oriented strategies, debt oriented strategies, and hybrid strategies, similar to mutual funds. So Radhika, let's start with the equity oriented strategies. What are we talking about here?
So I would just break this if you just look at mutual fund parlance to simplify. They have equity.
Yeah.
Now they have three categories. They have an equivalent, or they have something called equity long short. What is that to me? That is a flexi cap fund in the mutual fund world with additional flexibility around derivatives.
Okay.
You can go everywhere, but
Yeah.
you can also use derivatives.
Okay.
Then they have a category called X top 100.
X top 100 long short.
Long
fund,
short. Now again, that is your mid and small cap. You used to have, we have mid cap and small
Yes.
cap. We used to have a mid and small cap category in mutual fund. We used to run one fund. That's mid and small cap. So you buy beyond the top 100, but you have the flexibility to short. I want to add one point to what Swaroop said. Just because you have 25% flexibility to short doesn't mean you're always 25% short.
Right.
You could like a stock for the long term, for instance, in the mid cap space, but have a negative view for a month because there's an event going on, and then take a short position on it. So
Okay.
it's not mandatory short, it's flexibility to short. So that's your second.
Right.
And there's a sector rotation category, which in my view is like a business cycles category of the old. But there you were expressing views, you were taking very concentrated bets on sectors. Here you can take negative bets. So I can be long financials, short technology. So that's your equity category in a sense. It's your old flexi cap, mid and small cap, and business cycles with the layer of shorting.
With the layer of shorting and the new nomenclature. Got that. There are debt oriented strategies as well. There's a debt long short, and there is a sectoral long short fund as well. So do you want to sort of explain
So
that a little
again,
bit?
same analogy. The debt long short is like your old dynamic bond fund, but you can use interest rate future. Flexible in debt in terms of where it can go in terms of credit and
Also
duration.
interest rate futures.
You
there
can
be
use
a play
interest
on
rate
that.
futures there. So it's
Okay.
dynamic bond fund with shorting. That's shown up.
Okay.
And then the second one is your sectoral. I think that will probably be used for credit kind of funds because you can do financial services. So all your HFCs and BFCs, etc., kind of exposure can come out. So again, dynamic bond fund and credit fund with shorting
Oh, okay. All right. So
and liquidity.
Okay, so those would be some of the debt strategies. Then in this SIF, there are also hybrid strategies, which the regulator is allowing. There is an active asset allocator long short fund and a hybrid long short fund. Now, these products will evolve as we go, but Swaroop, I mean, broad thoughts on how they could look like, what they could be like?
Like you said, I mean, early days, and the beauty of this product is, every fund house can express the same category very differently. Unlike, in the mutual fund side where the categorization has defined a lot of it, and ideation is somewhere taking a back step, and that's the beauty of this side. Radhika can take a completely different view of the same category than what we can take. Right, and both can be right.
25% short on that particular one sector and that sector fund. You could be long on it.
Yes, absolutely, and that is why I said it is evolving of the entire environment, and that's why we all have to go for a re-examination, passing thing of the whole thing. The environment will be reassessed. All of us have to go through
and a new name,
everything. And you see, when you look at the new name, it's very important that it's been given a completely new perspective with our parent not being, we can carry, say, Platinum by Mirae Asset, but Platinum has to evolve.
Well, which is very important. Let's tell that to our viewers as well, that we have two of these SIF identities that have been launched so far in the market. The one that Mirae has put out, as Swaroop is saying, is called Platinum SIF, and the one that Edelweiss has put out is called Altiva SIF, right?
Yes.
Individual identities.
Individual identities.
And that's how these funds are going to be.
No, but I think it's important to have the individual identity because mutual fund, especially with Sahi Hai and everything, and I'm sure Swaroop agrees, has a connotation that it's very simple, it's very standardized. So, with due respect, a Mirae Midcap and Edelweiss Midcap
there is not that
It's
much
the same
difference in what we
playground.
do.
You play in the
It's
same
the
250
playground.
stocks or- yeah,
and I
yeah,
know
yeah.
I'm going to get my money back in one day. There's that promise. So with SIF, I think for the consumer and the distributor, the challenge is the nuance will be a lot more. He's been
Absolutely,
saying evolved, I'm
absolutely.
saying nuance.
Yeah,
But you can't just rank sort to, you know, X top 100
Absolutely.
funds.
Yeah,
You really have to look deep.
Absolutely. And I really hope that viewers are listening, because viewers, if you want to be in these sophisticated products, you have to do more homework for sure and ask more questions. And we'll continue with our questions after a very quick break, because we need to understand taxation and also general sense of return profile when we're looking at these new SIFs. Back in just a moment after the break.
Let's talk money. Let's talk money.
Welcome back. Well, we're in the midst of a very, very interesting conversation on a brand new product that's about to hit the market for all of us retail investors. It's the Specialized Investment Fund, the SIF as it's being called, and AMCs are in the process of launching this out. Remember, minimum threshold is 10 lakhs. The strategies are a little more sophisticated than ordinary mutual funds, but then can the returns be enough to sort of, justify that higher risk? That's what we're discussing. As I was thinking about our conversation in the previous segment, Radhika and Swaroop, it seems very important to me that the knowledge building around this product is going to be critical, because these are sophisticated strategies. And let's face it, when we're looking at investments, 90% of the conversation with our advisor or distributor is focused on return. Milega kitna? So how will, this will have to be dealt with differently, won't it, Radhika?
It needs nuance. I've been saying that again and again. And, we as a brand under Altiva are spending a lot of time and effort in consumer training and in distribution training. I know distribution has to pass a certain set of exams, and many of them already are, but we are spending the effort on doing that. The greatest tragedy would be if SIF is seen as which PMS was, as a route to, I will get higher return.
Yeah.
Actually, SIF is not about that. What's the flexibility you've been accorded in the equity side? It's derivatives. Derivatives may be used to give better risk-adjusted returns. So, if in an arbitrage fund, in mutual fund, I was getting X return, maybe I can use some more sophisticated strategies to get arbitrage plus. Maybe I can get an equity-like return with lower drawdown than equity. But these are nuanced conversations.
Yeah.
And we've moved to a world, as I said, where we have this sorting investor. You go to a website and you sort which is rank 1 fund.
Past 3-year return.
No, past 1 year return.
Or past
Trust us,
1
we
year
know. And I'm saying that is not healthy in mutual funds, because all of us have different styles. It's even more unhealthy in SIF, because we talked about equity long short. He could run a fund with 45% net equity exposure, and I could run a fund with 0% net equity exposure. He may obviously have a higher return, but other risks comparable. So the conversation has to be about risk-adjusted return.
So, Swaroop, how will the investor navigate this? And, isn't there, I don't want to be negative, but isn't there a very clear risk of mis-selling as well if the distributor doesn't explain all of this nuance and the risks that Radhika is speaking of?
I say that the beauty is we are at the beginning of the whole thing, and a lot of that responsibility lies on us AMCs to form partners who will go out and propagate the risk. I mean, while we were discussing this, I was reflecting on myself as a salesperson. When I started my career, I was very afraid of talking about risks. But as I became more open about talking about risks, I developed better partnerships and better investors. And hence they stay with us longer, as simple as that. Till we are not afraid or think that risk is a bad thing, risk is actually the best thing that we can talk about. The more the customer understands, the bigger the wallet share will be. And so at the beginning, I think a lot of that responsibility lies with us. And like Radhika said, I think all of us will put our efforts to educate people. And more important, I think it's also to tie up with people who will understand and propagate it in the right manner. That responsibility lies with us, I think.
So now let me ask you, what do you think will the sales pitch be? I'm sure your teams are already working on this. And when we talk about risk-adjusted return, see, the mutual fund investor over the years is very clearly understood. Stay in equity funds, and I'm talking only equity right now. Stay invested 5, 6, 7 year period. 12 to 14%, maybe in good years, 15%, basically 12, 13% compounded CAGR. We've, come to understand this and internalize it. Explains how SIFs are still steady in volatile markets as well. So what is the pitch going to be to the SIF investor now? What should be a realistic risk-adjusted return to watch out for?
See, finally, there is a pyramid of the investor breakup. I mean, at the bottom is participation, where you come in and buy the market, right? Above that, you come into a mutual fund category, which is broadly I can say on the verge of being a commoditized product because it's very similar to each other. Above that, you come for these pretty specialized and very skill kind of products, which PMS AIF were reached to a certain extent, and we now come into that entire picture. An investor has to choose where he or she wants to be, right? And then it's that mitigation of risk which defines a better investor.
See, but Swaroop is not talking about the risk-adjusted
average
return expectation.
See, there is this cliched.
He should not talk about it.
There is that cliched statement that higher the risk, higher the return. The statement should be higher the risk, higher should be the return.
Absolutely.
Now, in these three parameters, if the risk-adjusted return is not higher, then why should the investor
go
come?
for it?
It's up to us to come and say that because you are taking this additional risk, hence the chances of this return being higher are there. And that's something which we have to demonstrate. Right now, it's not right to talk because we have to demonstrate it and build track record. I'm sure the talent of the industry is such, and we are coming to it after 20-25 years of doing that same business. But now, since we have the flexibility, maybe my initial thought is a lot of us will approach it with a little bit of caution, but then the fund managers will be free to express themselves. And trust me, the same manager will express himself or herself far broader than what we used to. So when this product unfolds and the communication becomes clear, clearly the need for a person to go up the risk ladder will also be justified is the simple point I'm making.
Almost running out of time, but Radhika, very quickly on this point of return expectations, and I'm saying compounding, 5 years if someone is in this product, it would be fair to expect, I don't know, maybe at least more than 13-14% because MFs are giving you 12-13%, right?
So here's where I disagree, and I'm glad Swaroop didn't answer the question, because when the question is asked in a normal mutual fund, what is your return expectation? Kitna return dega? This is India. I go crazy because I'm like, kaun sa mutual fund? Mutual fund can be small cap fund and it can also be equity savings fund. And expectations are very different. Now, mutual fund has a wide variety of categories. SIF is so much wider. So
the equity SIFs, let's
I'm
say.
telling you, in an equity SIF, which has 80% equity exposure versus an equity SIF that's long short and has 20% exposure, the return will be very different. So at least our intent with this is, under all TIPA, one, we're not going to rush to fill all 7 categories in one go. This is not NFO central. Each category, in my view, requires very different capabilities. It's not like you have a consumption fund and a healthcare fund and an IT fund and mid and small. Each category is a different capability. We'll launch a category, educate on the so if we're launching something in the hybrid category, we'll educate on the nuances of that category. What's the right time horizon? What's the risk you're taking? What's the return you could get compared to a traditional instrument? What could go wrong? And we'll do that for a while.
Okay. Out of time, I realize we need many more classrooms. The journey has only begun, right?
Yes.
But in 10 seconds, broadly, taxation is similar to what we have in mutual funds, right? As of now.
Fund product.
It's a mutual fund product with a new set of rules.
New set of rules.
Different category of mutual funds.
Okay, fantastic. I think this is a great starting point, and thank you very much, because now we have some, opening thoughts and understanding of what this new, lovely little animal is going to look like, and how it evolves is something that we have to watch out for. Thanks very much, and this is already an open invite for a round 2, maybe a couple of weeks down the line, when some of these strategies start coming to market, and that's when we really need to pay attention and understand what they are and whether they suit our risk profile or not. Thanks very much, Radhika and Swaroop, for joining in. Promises to be, the first of many, many conversations on specialized investment funds. Well, viewers, with that, we have to take your leave. Do keep sending us your feedback, comments, and queries. See you again next week.
Let's talk money.
welcome to this special edition of Voices from the Valley. I'm Shireen Bhan, and we're coming to you from the Cognizant office in San Francisco. And this is also home to Cognizant's AI lab. Now, remember, Cognizant has made a pretty bold bet on AI, $1 billion bet that is. Joining us now to talk about how that's paying off for the company is Surya Gumadi, the president of Cognizant for Americas, and also the man who is, of course, responsible for the AI lab, the CTO for AI, Babak Hojat. Thank you very much, gentlemen, for joining us here on this edition of Voices from the Valley. It's great to have you back on the program.
Thank you, Shireen. First of all, welcome to the Golden State. And thank you for taking time to visit our AI labs here in San Francisco today.
You know, and this is what I want to talk to you about, this big $1 billion bet that Cognizant has decided to make on AI. And I think it brings to bear the larger question facing Indian IT services companies today. In an AI world, how relevant will Indian IT services companies be?
I think, you know, they're going to be very relevant. First of all, the $1 billion bet that we made was in 3 dimensions.
Yeah.
You know, getting a talent ready for the AI era, getting the infrastructure ready, which is the AI labs, and then, you know, building solutions, custom solutions for our clients. The Indian IT services companies are right in the middle of building those solutions, whether it is getting the data ready for the AI era or building the AI relevant solutions. And the $1 billion bet we have made is paying off really well for us. And our clients are loving it, our markets are loving it, and you know, we like it, and we are doubling down on that.
You are doubling down on that. So the question that everyone is asking at this point in time, is this going to be an existential crisis for the Indian IT services industry? You don't believe that to be the case?
No, I don't believe that at all, because it's like any other technology revolutions that we have seen in the past. In the initial phases, it appears that it's going to take away a lot of jobs, or it's going to be a significant threat to the coders and things like that. But
or a disruption to the business model as it's existed.
Correct. And the initial thinking or the initial fear was that, but as we get deeper into the agentic era, so I think, you know, a lot of human intervention is needed to manage the agents, to build agents and orchestrate the agents. The jobs might morph into something different, but I don't think there'll be an existential crisis or existential threat.
No existential crisis or threat at this point in time, at least. But Babak, let me come to you now. You know, you're not new to the world of agents at all, going all the way back to 2011 when we actually saw Siri come into the picture. And, you know, I don't know how many people still remember this, but ChatGPT, if you don't, Babak, was the main inventor behind the natural language technology that Siri used. But, you know, how much has the world changed since then, Babak?
It's amazing. The world has changed, but also kind of come full circle as well. And not only was the original technology around Siri, something that we worked on in the late 90s, but not too many people know that technology was agentic. And agents were very popular in AI in the 90s. The first time anyone talked about an AI agent was in 1989.
Wow.
And now those were very different agents. Those were much simpler, and the reason why we had agentic AI back then was because it was very difficult to use AI more generally, so we simplified the domain in which the AI was applied, and we called that an agent. In some strange roundabout way, today, while we do have large language models and Gen AI is very generally applicable, we have to still put it in a box, give it a job description, give it a set of tools, and have it work with other agents. So in some ways, it's come back to agents and multi-agentic systems. Real quick, on just to build on what Surya was talking about, I don't think it's more, this is the most exciting time, in my opinion, to be in a services company.
Okay.
Because there's no one-size-fits-all AI system. AI has moved from be-all, end-all, there's one Gen AI system that does everything, to a multitude of agents that work together, that are specialized, have to be custom-built and tailored and safeguarded with human in the loop for every single business separately. And to me, that's, you know, job security.
Well, speaking of the job security, Babak, as you mentioned, this goes all the way back to the early 90s, the late 80s. Why is it that we're now seeing this big breakout moment for agentic AI then?
The more we have the domain expertise as humans. Our clients know where they want to apply AI and how they want to apply AI. And actually, as Cognizant, we often know better than our clients where the AI can be applied and how. And so I think that aspect of specializing and configuring these AI agents is something that is the new sort of expertise that comes in. The AI is very powerful. You don't have to, unlike the Siri days, you don't have to go code it to understand natural language. Out of the box, it knows that. And it can actually talk to other agents in natural language in a future-proof manner. Where it needs help from us as humans is to give it that expertise, to package that and say, here's what you need to do and how you need to do it. I think that's very important.
I think just to add one more point, probably the evolution of compute from 80s and 90s to now, that also has accelerated.
Absolutely. The evolution of compute, the ability, getting around the fact that we're not building one AI that does everything, I think is also very important. Getting to the fact that this AI has to be grounded and has to do something really specific with our data, with our processes.
So let's talk about the business outcomes, because that's exactly the question that Babak raised. What does it do? To what purpose? To what end? How does it benefit the company? How does it benefit your clients today? Now, in terms of adoption, what are you seeing, Surya, today?
I mean, we discussed this in Davos, Shireen, earlier this year. At that point, we said 2025 is going to be the year where many enterprises across the planet will pivot from experimentation to scale. That indeed is happening. Perhaps not at the pace and scale that everyone expected that too, but it indeed is happening. So the enterprises are pivoting from experimentation to scale. And we have defined 3 vectors from Cognizant lens. And we are so glad that clients are looking at it in the exact same way as 3 steps from their lens. The first step being unlocking the productivity using AI tools and AI platforms on the run part of their business. Then the second step is infusing AI across their tech stack, the data layer, the apps layer, the business process layer. Once they do that, they're thinking of agentifying the value chain. These are 3 steps in the process. Some clients are approaching it sequentially. Some clients are trying to do 1 or 2 simultaneously. But majority of the clients have started pivoting from experimentation to scale. And this is happening across all the industries, in financial services, in healthcare, which is supposed to be highly regulated. But we see clients making move there as well. And in retail and the manufacturing segments and CMT. So I think across, I think there is movement now.
I mean, is there a way to understand how much of that is being driven by AI spends at this point in time? Or is it still the largely bread and butter business that's driving spends?
No, actually, the spend is pivoting towards AI. I think there was a recent research by PwC, I guess, where 88% of the senior executives polled said that they're going to increase their budgets towards AI.
Seem to be at pains to point out that the move to neutral does not necessarily signify a change in the rate-cutting cycle. They seem to hint it is more a pause. The governor in particular says that a neutral stance can mean a hike or a cut, and Rajiv Ranjan saying that the neutral stance was adhered to because a 50 bips cut and an accommodative stance may have misled the financial markets to expect too much dovishness. So they seem to be hedging their position. However, one person who had always been rooting for a 50 basis cut, even in the April policy, was external member Dr. Nagesh Kumar. Dr. Kumar joins me now with his perspective. Dr. Kumar, thank you very much indeed for finding time for us. Well, I want, everybody has expressed some reservations of growth and confidence in inflation falling. But you have been particularly worried about growth. You think that 6.5 itself may be difficult under current circumstances?
Yeah, well, actually,
The point I have tried to make is that the external conditions, external environment has become highly uncertain and difficult and challenging. Very uncertain times, and private investments have been subdued. The consumption, urban consumption especially, has also been subdued. So we needed to support growth. And when you try to support growth through monetary policy, you need also the policy space. And fortunately, the inflationary outlook has turned very benign. The numbers that we had before us showed that the headline inflation had gone down to 3.16 or 18, which was lowest we have seen in last 69 months or so. So that provided the headroom. And my view, which I expressed in April also, was that if we can, we should do front loading of rate cutting, because I believe that 50 basis points at one go will be more effective than two bouts of 25 basis points coming one after the other. Because the magnitude of the cut will force the bankers to lower the deposit and lending rate, which is the purpose of rate.
Now, I take your point, sir. It appears to have even had its impact, because we hear a lot of home loans falling even below 8%, certain tenors. So perhaps some of the impact is already there. Would you believe that we got the core sector numbers, and that is a little abysmal. We've got a 0.7% core sector growth for May. So it does look like growth can be, not as strong. Your fears may be realized. So do you think there is more scope to cut if growth were to continue with such numbers?
Well, as the governor explained in his interview recently after the MPC, it all depends upon the numbers. So when we have the numbers before us and the inflation continues to remain benign, goes down further, it may be possible to take a call on the further cuts. So it is not, as the governor has said, that it doesn't mean anything that the stance has been changed. It really depends upon what numbers we get on the growth side and on the